third day of the third module, what we are having. This is on capital gains. We have CA Prakash Hegde to share his knowledge on this. I request Chairman to escort him to dais and greet him with the floor. So welcome to you and thank you for being there. A brief introduction of CA Prakash Hegde. He completed BCom and LLB from Karnataka University with second rank and with first rank in LLB. He is a fellow member of the Institute of Chartered Accountants, holds MBA in Finance also. He initially worked as an advocate and then with the Totagas Cooperative Sales Society SSC as a CEO, and he also had a stint of experience with PwC in Bangalore. He was working as a director at Deloitte and now he is practicing on his own. He has advised many leading Indian and multinational companies across the country on various tax-related matters, international taxation and Black Money Act. He also has experience in dealing with planning, compliance, advisory and litigation matters across the direct tax spectrum. He has conducted many seminar sessions for clients and professionals, authored many journals and publications. He is also a business and tax columnist for Mint, a national daily business newspaper published by the Hindustan Times Group. Ladies and gentlemen, it's a pleasure to introduce Prakash Hegde to you all. So over to you.
Good morning, everybody.
Good morning.
Thanks to the chairman of Bangalore branch of ICAI and the secretary Kavita madam for giving me an opportunity to discuss some information regarding the capital gains here in the series of lectures what is being conducted by the Bangalore branch. It's a great pleasure to learn and continue to learn. We generally stop learning unless there is a compulsion. That's the reason the institute has mandated the CP number of hours per year. Unless we are forced, most of the things are not done by us. Even in the legal parlance also, there is a saying that a herd of wolves is more at common than a team of men unless there is a law. Which means wolves may be more organized than men unless there is some rule or law which mandates a man to do certain things. Unfortunately, the most intelligent species need something to monitor them and regulate them. Be it as may, it gave me a good opportunity to get deeper into the matter. That's the reason I always look forward for getting engaged on these type of workshops, or it may be the sessions which help me to understand more and more about the subject. Now, for the next 1.5 hours, let us discuss certain provisions relating to capital gains tax. Section 48 to 55 would be the overall coverage for 2 sessions what we have, 1.5 hour sessions each. If you have any questions, we will take up, but if there are too many questions, I would like to defer it to a later point because many of the questions may get addressed during the course of the discussion. Also, since we just have effectively 3 hours, we may not be able to cover all the questions. Section 45 class 1 you would have already studied, but why I am discussing this point is capital gains will become taxable only if certain conditions are fulfilled and if certain exemptions are not available. If exemptions are available, you need not have to pay the capital gains tax. Say for example, it could be exemption at section 54, 54 EC, etc. To have a comprehensive understanding of taxation of capital gains, chargeability as well as exemption part you should be aware of. There should be a capital asset. Capital asset is transferred by the assessee. Such transfer takes place during the previous year, that means the financial year. Any profit or gain arises as a result of transfer. If such profit or gain is not exempt under section 54, 54B, 54D, 54EC, 54EE, 54F, 54G, 54GA and 54GB. Earlier there were certain other exemptions also, section 54E and some more, and with over the years they have been made redundant and they are no more effective. So we are going to focus our discussion only on these exemptions. Prior to that, we need to understand how the capital gain has to be computed. Mode of computation of capital gain has been discussed in section 48. In case you want me to refer to any of the specific clauses of the section or the provisions, please let me know. I have the soft copies, I can put it on the screen at any point in time. Section 48 discusses how the computation has to be done. It starts with full value of consideration. The full value of consideration has to be taken at the first go, and then certain deductions are allowable and there are certain provisos, and after applying all that you will arrive at the amount of capital gain. What do you mean by full value of consideration? What is full value of consideration? They could have used the word consideration. They could have used the word sale amount. They could have used the word transfer amount. Do you find any reason why they have used the word full value of consideration? Sorry?
Cash in kind.
Yeah. What other reason?
Maybe even indirectly related to consideration maybe.
In what sense?
Say for example, if I am any selling property, then if I sell under value and then alternatively if I arrange some rental like kind of installment.
Okay.
In case if any consideration is moved in any other way, that also should be covered.
Yeah, of course. Any other reason? This was a matter of debate in various courts. How the income tax officers initially interpreted was full value of consideration means the highest value of consideration one can imagine. Say for example, you have a piece of land and it might have been agreed for sale of say 10 lakh rupees. You have entered into an agreement. The guidance value or the sub-registrar guidance value, what we call as, or stamp duty value, in short I can call it as SDV. Stamp duty value is the value at which the state government has declared it should be registered with the sub-registrar, and below that registration is generally not permissible. That's the stamp duty value. Assume in this case the SDV is 9 lakh. Okay. The income tax officer may say that it is sold at 10 lakh, but the fair market value is 15 lakh, because he can argue that property adjacent to that property with similar features, similar conditions, similar facing or similar dimension has been sold for 15 lakh. as per the income tax department's interpretation, there was a debate that full consideration means fair market value. That is the highest consideration the property can fetch. The matter travelled to the Supreme Court in one case, Henderson Private Limited, way back in the 1970s. It's reported in ITR 66 ITR. There, the department's argument was, I have seen that similar properties being sold at much higher price, but these people have entered into the value for a lower rate. At that point in time, there was no requirement for sale of the property at stamp duty value also. There was no requirement. The court went through all the details. The court took the view that auctioning for the purpose of sale of the property to find out the best possible and the highest possible price is not necessary. Parties may agree depending on their requirement, depending on the confidence they have, depending on the urgency, depending on other concerned conditions. It would be sufficient if it is the appropriate consideration, but full value of consideration refers to the entire consideration has to be accounted for the purpose of taxes. Say you cannot make some ad hoc deductions. Ad hoc deductions in the sense which are not directly related to sale, or any other deduction should not be made, and full value should be taken into consideration for the purpose of computation. That is the decision which has been rendered by the Supreme Court. Now, since certain provisions have been added to the Income Tax Act to mandate, in case somebody sells the property at a price below the stamp duty value, still the stamp duty value will be treated as the consideration. That value can be treated as full value of consideration, or in case the seller has received a higher amount, he has to consider the higher amount. Now that's how it is interpreted. Also, that consideration, full value of consideration, obviously as one of you mentioned, it includes not only the cash part but also anything that has been given in kind, and the fair market value of that portion which has been given in kind has to be considered. If at all consideration is not at all determinable for any reason, then fair market value should be the full value. For the purpose of computation of fair market value, they have prescribed certain rules. If consideration is received in installments in different years, full value is still taxable in the year of transfer. Say for example, you sell a property and you agree with the buyer, maybe because of personal relationship or friendship, you may agree that the installment payment is possible over the next 10 years. But you cannot take a stand that tax will be paid in the next 10 years. The capital asset will still be treated that it has been transferred in the year in which the actual transfer has happened, and not based on the installments which has been received.
Sir, in this even today also, all the sales condition is received above the SR value only. But whatever the SR value is there, they will receive it in the cash, the check form. And above that one, they receive in the block cash.
Yeah.
They will not show any how the department will tackle that.
Department will come to know only if it's able to catch hold of the cash portion. Otherwise, department will not come to know. And also, department is under no obligation to treat that cash receipt as the sale value of the property. The department can treat that value as undisclosed income, in which case the tax rate would be 60% under 115 BBE. Because if the sale deed says that the property has been sold at say 1 crore, and at the same time the seller of the property receives cash, say 25 lakh rupees, and if that 25 lakh cash is confiscated by the department, then the seller of the property is unable to relate that 25 lakh to the sale of the property, because the sale deed has very clearly mentioned that the sale consideration is 1 crore. So 25 lakh has to be treated as unexplained money, unexplained income. And there are many instances. What we have seen is that even this unaccounted part, which is not shown in the sale deed, is being paid by way of check or bank draft or online transfer, and still the seller wants to claim that that's part of the consideration which is not disclosed in the sale deed. The income tax department usually do not agree to such a view, because it has to go by the amount mentioned in the sale deed and nothing beyond that. From this full value of consideration, what all are deductible? The provisions of section 48 says, expenditure incurred wholly and exclusively in connection with the transfer of capital assets. Note the language, wholly and exclusively, not remotely connected. It should be wholly and exclusively in connection with the transfer. And also, it does not say wholly and exclusively for the transfer. It says in connection with the transfer. Are you able to understand the distinction? Whole expenditure for the transfer is different. Expenditure in connection with the transfer is different. Do you agree? Do you agree? What do you mean by expenditure for the transfer? And what do you mean by expenditure in connection with the transfer?
For the transfer, since whatever expense has been done to execute that transaction. And in connection means maybe in case if they have to incur any expenditure so that the transfer can take place, like if they have to clear any legal proceedings or they have to give any clear any dues.
Yeah, absolutely. When we say that for transfer, it means it is directly relatable to the transfer and nothing around it, nothing beyond it. But when we say that in connection with the transfer, it is a wider term. So some more expenses which may not be necessarily directly related, but of course they have to be in connection wholly and exclusively with the transfer. So it gives a slightly wider meaning. I'll explain it a little more. Cost of the other deduction is cost of acquiring the capital asset and expenses related to its subsequent improvement. Once the acquisition of the property happens, after that, if any improvement has been made by the buyer, which are of capital nature, that will also be deductible from the full value of consideration. Anyway, cost of acquisition is also deductible. We have certain examples for allowable deductions. Say brokerage or commission paid. This may not be for the transfer, because transfer is not dependent on brokerage or commission. Even without brokerage or commission also, transfer can happen. If there is a direct contact with the seller and the buyer, the transfer is possible without brokerage or commission. But when they have used the word in connection with the transfer, this is a permissible deduction. Cost of stamp duty, registration fees, traveling expenses in connection with the transfer. Say the seller is exclusively traveling for the purpose of transfer, you can claim the expenditure. Litigation expenditure, if there is any litigation related to that property wherein the buyer or the seller has to exercise the has to take help of the courts or any other forum, the expenses related to that litigation is also deductible. Compensation paid, there may be a case where some compensation may have to be paid, maybe due to some litigation or disputes or understanding for better title. Such compensation is also a permissible deduction. These are all the examples of permissible deductions. Of course, there is no clarity whether and when you can claim this type of expenditure. Each case has to be studied and only the courts can interpret that. But in general, these are all based on the various judicial precedents.
Sir, one doubt, sir. They used wholly and exclusively, sir.
Yes.
You were mentioning that in connection, they can say that expenditure in connection with the transfer, but they used wholly and exclusively.
Correct.
Straight away, one example can you use it, because I was not able to quote.
Wholly and exclusively, see, I can give an example of a non-resident coming down to India for the purpose of sale of the property. Assume a situation, anyway he had already made a plan to visit India and had already booked the flight tickets to travel to India for some family function. Okay, during that visit itself, if he enters into a contract with somebody for sale of the property, he cannot claim that travel expense as wholly and exclusively for the purpose of sale of the property. But assume a situation, after the agreement is entered into, the buyer confirms a date on which he wants to transfer the property, and for that reason the seller has to book his flight tickets. Then it is wholly and exclusively. Non-resident is coming exclusively for the purpose of entering into that sale deed, and all the related expenses would be deductible. In this connection, there have been lot of litigation with regard to the expenses for portfolio management services provided by some of the portfolio managers, whether that amount is deductible as an expenditure in connection with the sale of stocks or mutual funds, etc. There have been quite a lot of decisions, both favorable as well as unfavorable. It is not yet concluded, but some of the tribunals, some of the courts have held that it is not a permissible expenditure from the capital gain. Cost of improvement. What is cost of improvement? It is the expenditure incurred to increase the value of the capital asset. Say for example, you have a house property and every year you have to pay the municipal taxes. Can you call that expenditure as cost of improvement? No, it's not going to increase the value, it's only going to maintain the value. What other type of expenditure you think can be treated as cost of improvement? Yeah. Some unique type of expenditure if you can think of. Conversion charges. Say an agriculture property may be converted into non-agricultural. That conversion expense should be treated as cost of improvement because it's going to increase the value of the property. It's going to be capital expenditure. Sorry? Addition of lift. What else? Say for example, there may be a possibility that there might be a family dispute. Two brothers may be fighting for the same property. The litigation expenses or the compensation paid to the other person to settle that litigation so that the property becomes the sole property of one of the parties, that can be treated as cost of improvement. There could be quite a lot of examples we can give.
In case of litigation expense, it is only clearing the titles, it is not increasing the value of capital asset.
It's clearing the title, but there are instances where even during the litigation, property might be sold, but if there is a property, obviously the value will be much lesser. And from that perspective also, a litigation-free property will obviously fetch a higher price. One is clearing the title, the other one is increasing the value. Say, if I have to come to that point, I can give a different example. You have a house property, you have a tenant who has been staying there for the last 20 years. Okay, and he may get into some kind of a dispute or litigation, and you may have to ensure that that matter is closed and the tenant evicts the property so that you can sell it conveniently and comfortably. Even if the tenant is there, it might be possible for you to sell the property, but it will not. It may not fetch the same higher price. Interestingly, any expenditure regarding the cost of improvement cannot be considered if it is incurred before 1st April 2001. You know that for the purpose of the arriving at the fair market value of the property, we need to compare the cost of acquisition versus fair market value on 1st of April 2001, right? So in that context, if the property has been acquired before 1st of April 2001, if there has been cost of acquisition, it will be counted. If there is any cost of improvement or any expenditure in connection with the cost, then that expenditure will not be considered. You have to compare the actual cost of acquisition with fair market value, and whichever is higher you can consider. Also, from assessment year 24-25, double deduction for the interest which is paid on the loan borrowed for the purpose of acquiring that property is not allowed. There are certain tribunal decisions. The first one was from Chennai Tribunal, which stated that if an individual has a housing loan, he can not only claim deduction under section 24 clause B of the Income Tax Act for the interest under the head income from house property, but he can also consider that as a cost of improvement for the loan expenditure. Loan was essential for him to purchase the property, so expenditure in connection with that is also an addition that can be made as a capital expenditure. But now with assessment year 24-25, this law has been clarified. Earlier it was ambiguous and it was taken to the benefit of the taxpayer. Now it has been clarified that double deduction is not permissible. And similarly, the contentious issue is with regard to deduction. If deduction has already been made under chapter 6A, then double deduction is not permissible, which is slightly confusing and going to be litigative. Can somebody explain what does this mean?
Whatever we took the principal is deducted in the ATC.
Yeah.
So when I am paying principal to the bank, I will take a deduction. But when in future when I am selling that property, that cost of property, that should be excluding ATC. Actually.
No. In any case, repayment of housing loan will not be treated as cost of the property.
No sir, I bought a home for 50 lakhs.
Correct.
Now I took a loan for 40 lakhs. Now already this, whenever I am paying, now I am deducting that amount, no sir, 40 lakhs.
Right.
So over years together I will deduct that. That 40 lakhs, there may be contention by the department, already you reduced something like that.
But it's possible that somebody may dispute that, definitely. But my view is, by taking the loan, I am not going to add a cost to the property. Cost of the property is already decided, it's going to be 50 lakh.
Yes sir.
If I take a loan of 30 lakh, if I repay the loan of 20 lakh or whatever it is, cost is going to be fixed, 50 lakh. But if I claim the deduction under section 80C, it's going to get adjusted against the loan and not against the cost. Not against the cost of the house property. But by this, they have created some ambiguity which can lead to litigation. You wanted to? Yeah.
So in this example, double deduction, in case I bought a vacant land by taking a loan, interest on that, can I take a cost of improvement? Because I am not taking deduction.
It's possible. Now, it's a very good difference that we can treat that interest as a cost of improvement. Because prior to this clarification, it was ambiguous. Now, with the help of this clarification, when they are saying double deduction is not possible, if single deduction is claimed, it should be permissible.
But how about if I already purchased the building and that I have taken a mortgage loan, interest payment on that, can I take deduction? I have already purchased, I am not on loan. But after some years, I got a loan by fetching this building.
What is the purpose of the loan?
Loan is personal purpose.
Sir, I think cost of it cannot be treated as cost of improvement, I think so. Cost of acquisition, I think so. Whatever
I agree. You can treat it as cost of acquisition. You can treat it as cost of acquisition. Yeah. While we proceed, I am covering certain parts of section 55 as well. I may not have much to discuss when we come to section 55. As and when it is necessary, I have included certain provisions of section 55. Say for example here, cost of improvement in relation to goodwill or any other intangible asset. When the asset is self-generated, it's going to be nil in any case. Whether it has come to me by some mode, say it might have been acquired by some previous owner, or it might have been generated by some previous owner, and it might have been passed on to me. When there is no cost, I cannot claim any cost. Similarly, when assets are purchased later on transfer, when these assets are purchased and later on transferred, cost of improvement would be nil. Only cost of acquisition will be counted if it is purchased from a third party for a payment. Cost of improvement in relation to any other asset, it could be some tangible assets. Before April 1, 2021, in the second column, when the capital asset was acquired by way of gift, will, etc., under the provision of section 49(1), cost of improvement incurred by the assessee and or the previous owner would be considered. But if it is incurred before 1/4/2021, that will not be considered. Similar is the case with any other case. That means whether you have acquired it in any of the modes specified in 49(1). I hope you are familiar with 49(1), how you get the acquisition. It could be by way of gift, will, inheritance, or partition of HUF, where you are not going to incur any expenditure directly, but you are getting it, and somebody has incurred some expenditure to acquire that. Those modes of transfer or transmission, they are strictly not called as transfer. Those modes of acquisition may be considered as modes specified under 49 subclause 1.
What are the documents that we can show to support these expenditures?
Actual bills, receipts supported with bank statements.
Sometimes it is very difficult with construction workers. They will give just cash receipt like receipt, which are very pakka. So is that admissible?
Generally, the income tax department at the lower level will not accept unless it's very clear that you have made the payment. Say for example, there could be some handwritten vouchers that I have received 20,000 rupees as labor cost, etc. They may not agree. So generally we advise that you collect a copy of Aadhaar or PAN of that worker or contractor, so that anytime if somebody wants to get a confirmation, or if you have to reach out to him, or if you have to give it as an evidence, it would be helpful. Secondly, cash expenditure has been discouraged, of course. There have been quite a lot of amendments with regard to the cash payments in excess of 10,000. For the earlier period, if you want to still take a position that an expenditure has been done, it could be litigative, but the higher courts, could be the tribunal or the courts, generally go by the valuation. But again, it is subjective. Somebody may value it as say X, or somebody may treat the value as X minus 20%. Completely subjective. So
2016, I think this cash expenditure was allowed.
yeah,
That time, if somebody has claimed around 2 crores expenditure like this, cash expenditures.
in 2016,
14.
2014, you don't have any receipt. What exactly is the expenditure?
Same construction.
Construction. Then to some extent you may be able to justify if there is a cash withdrawal, and also a parallel proof of construction, maybe the permission what you have got for the purpose of construction, supported with valuation. But I don't think that you will be eligible for deduction for entire 2 crore, because valuation will be conservative. But to some extent you can defend.
But this cash expenditure is that is only for the purpose of business. If I want to construct a house, even cash expenditure is allowed. 48 will not affect the construction of house.
It will not affect, but if there is a cash expenditure, how are you going to justify unless the recipient comes and explains that he has received it, number one. Secondly, if it is a business asset, for example, okay, if even if it's a building, if I remember, they have made amendment in I'll tell you, they have made an amendment that the depreciation is not counted and for the purpose of cost of acquisition cash expenditure is not counted. I am not able to recall the exact clause. Sorry?
48.
No, 48 is a regular revenue expenditure.
This is not actual cost. In case of business as well, it will not be added as cost.
Okay, let me clarify. Amount paid to tenant to obtain vacant possession is cost of improvement. There are a couple of decisions on that. In this context, I hope you are all aware of the indexation relating to cost of acquisition as well as cost of improvement. Recently, the inflation index for financial year 24-25 has been declared and it is 363. In the context of indexation, there are certain court decisions, I will come to that. Now, while we are discussing the mode of computation of capital gain, we need to discuss how the capital gain on transfer of bonus shares has to be computed. There are few situations I would like to take you through. Situation 1. If capital gain on transfer of bonus shares is taxable under section 112A and bonus shares were allotted before February 1, 2018, in that case, you can take the cost for the purpose of computation to be fair market value on 31st January 2018 or sale price, whichever is less. Situation 2, where bonus shares are allotted before April 1, 2001. Fair market value on April 1, 2001 can be treated as the cost of acquisition. Situation 3, any other case where bonus shares are allotted on or after April 1st, 2001, where it is not covered in situation 1, it has to be treated as 0. So, bonus share may become 0 in certain situations. Say for example, it is allotted after 1st February 2018, it becomes 0. But if it is allotted before 1st February 2018, you can consider fair market value on 1st February 31st January 2018 as the cost of acquisition. Capital gain on transfer of rights, shares and right entitlement. Situations and cost of acquisition we are discussing, where the original shares, on the basis of it the taxpayer becomes entitled to rights shares, amount actually paid for acquiring the rights shares will be the cost of acquisition. Rights entitlement, if it is renounced and if some money is received out of that, cost of acquisition is going to be 0. Rights shares are acquired by the taxpayer. He himself purchases those rights shares, then the amount paid by the taxpayer to the company will be treated as cost of acquisition. Rights shares purchased by the person in whose favor the rights entitlement has been renounced. Say rights, a shareholder got a rights entitlement, he renounced it and passed it on to somebody else, and that buyer of those rights has paid some amounts to the renouncer, then for that buyer, the amount paid to the company for purchase of the shares plus the amount what he has paid to the renouncer for getting the entitlement will be the cost of acquisition. And there are certain situations where the consideration value has to be counted on notional basis. You will not be able to get the actual value of full value of consideration. There, the notional value has to be considered. Say for example, money received under any insurance due to damage or destruction of capital asset. The value of money or fair market value of the asset has to be treated as the full value of consideration. Conversion of capital asset into stock in trade. Fair market value on the date of conversion has to be treated as the full value of consideration. Transfer of capital asset by a partner to his partnership or by one individual to the body of individuals or association of persons, amount recorded in the books of that firm or association or body of individuals will be treated as the consideration, and it's not the fair market value. Distribution of capital asset by firm or AOP or body of individuals, fair market of value of such asset will be treated as the full value of consideration. Transfer by an individual HUF of land or building under joint development agreement, and this is applicable only from financial year 2017-18 JDA under clause 5A of section 45. This new provision has been introduced. SDV refers to stamp duty value on the date of issue of completion certificate of share of the owner in the developed property plus cash consideration will be treated as full value of consideration. This particular item was a matter of litigation for several years, and to reduce the litigation on that count, only in the case where the ownership of the land belongs to individuals or HUF, they have brought in clarity. But where the piece of land belongs to partnership or companies, litigation still continues. In case of transfer of land and building, and if stamp duty value is greater than 110% of actual consideration, then full value will be stamp duty value under section 50C. We are going to discuss this in detail. Transfer of unlisted shares in a company for a price less than fair market value. The fair market value should be treated as full value of consideration, section 50CA. If consideration received or accruing as a result of transfer of a capital asset is not ascertainable or cannot be ascertained, then fair market value on the date of transfer will be treated as full value of consideration. Again, this last item was a matter of dispute. Think of a situation, for some reason you are not able to find out the consideration accruing as a result of transfer of a capital asset. How to find out the capital gain was a dispute, and now you have to go by the fair market value under rule 11 UA, UAA, etc. Any questions so far? Yes.
Sir, you mentioned that wealth management fees is not allowed as deduction.
Portfolio management fees.
Portfolio management.
In the context of certain situation, there is a Karnataka High Court judgment which is favorable. Again, there is a controversy because there is the Bombay High Court judgment, tribunal judgment which say that they are not allowable. It's not resolved yet. You might have got that 2013 Karnataka High Court judgment which says that it's permissible.
So, connecting that with the interest also. Say sometimes this portfolio managers of agents give interest loan interest. Okay. Whether the interest component can be claimed as cost of acquisition in case of securities.
For the purpose of purchase of the securities, you borrow a loan.
Yes.
It should be possible.
Say to
Yes.
trade in derivatives.
Yes, without that loan you could not acquire those assets. And because of the loan, you got it, and whatever profit you made, the deduction for this interest should be allowed.
Okay. Applying the same analogy, can I borrow interest and do trading securities and claim the deduction?
Trading in what sense? Whether
Equity market, futures, futures options. I borrow loan from my friend
yeah,
and trade.
similar, possible. As long as you call it as a capital gain. If you call it as a business, it's very clear cut. A deduction is permissible, but the head of income will be different. Yeah.
and it is of say some property is there, due to some problem, say unit, high tension wire line is there in the back, nobody is buying. There is a necessity, clear necessity that it has to be shifted. So whatever the amount is incurred to shift the unit like shifting, whether it can be considered as cost of improvement or cost of selling expense.
It would be cost of improvement. Yes. Because it is not wholly and exclusively in connection with the transfer of the asset. But it's going to improve the value of that asset. But see, ultimately whether it comes under cost of acquisition, cost of improvement, or it's if it's it can be convinced that it's deductible, doesn't matter, because everything comes under section 48 only. For our purpose, academic interest, I may call it as cost of improvement.
This process takes long time. Indexation matters.
Okay. Understood.
And one more thing.
Yeah.
Say on slum sale, I agreed and I acquired some assets
Yeah.
and I sold it later.
Okay.
At particular individual asset. What would be the value of the asset acquired on slum sale when no value was fixed at the time of purchase? Fair market.
Usually, when a slum sale is done, a proper valuation of each of the assets is advisable to keep in the records. You may not necessarily declare it, but identifying the value of the assets to arrive at if there is a goodwill or not, valuation is always advisable. So you can, based on that, you can treat the value as the cost of acquisition.
You put fair value on the date also.
It would be the fair value.
And in the case of immovable assets, the cost of fittings, permanent fittings, is allowed as cost of acquisition.
Yes. Permanent fittings.
Apart from building.
Yes, apart from building. In 2023, there is a Bangalore ITAT decision which says that even interiors, the fixtures should be treated as the part of the building for the purpose of claim of exemption or for the purpose of claim of cost of acquisition.
So permanent fixtures,
Permanent fixtures.
not movable.
No.
So in case of slum sale, a company has acquired proprietorship concern from
Yeah.
all the assets, including an immovable asset. They have fixed a consideration. But while paying his capital gains, he has to go as per rule UAE and he has to value the immovable property at fair market value, and he has paid his taxes.
Yeah.
Now in my books, like while if I am selling that immovable property, I will not be able to take that benefit of fair market value which the proprietor has already shown.
Fair market value you can, but valuation is always advisable in the sense, see, how we do is, in case somebody has sold a particular undertaking as slum sale to us, we get the valuation done for two purposes. One means we may not have access to the fair market value what he has considered and the basis and a proper report to substantiate that. If he shares, well and good, but anyway that valuation report is something which is given to the management of the company or the seller, right? Secondly, valuation would be required. It's quite subjective, as you know, unless it's very clearly defined in the rules. It's necessary to ascertain the value of goodwill as well, because I might have paid a lesser amount or I might have paid a higher amount than the fair market value. But fair market value, assuming that it's properly defined in the rules. In the case of immovable property, it's quite clear that SDV has to be the fair market value, right? So there would not be deviation. But if there is some other asset valuation to be done, it has to be done to ascertain the exact value. And in case of immovable property, as you mentioned, SDV, if it's considered by the seller, then you can take that also. Anyway, there is a gazette notification which defines the SDV. Computation of capital gain. Of course, you would have already attended sessions on what is short term, what is long term, all that. I'll straight away jump into the mode of computation. First, we start with full value of consideration. On the left hand side, I have the computation for short term capital gain. On the right hand side, I have the computation for long term capital gain. from the full value of consideration, we deduct expenditure incurred wholly and exclusively in connection with such transfer, whether it's short term or long term. These expenses are allowable. Next, in case of short term capital gain, we deduct the cost of acquisition. In case of long term capital gain, we deduct indexed cost of acquisition. In case of short term, again cost of improvement. In case of long term, indexed cost of improvement. Then certain exemptions are allowable even for short term capital gain. For long term capital gain, whatever exemptions are listed in the chapter, all of them are available. Say for short term capital gain, we have exemption under section 54B, 54D, 54G and 54GA. Whereas for long term, additionally we have 54, 54EC, 54F, 54GB. These are the deductions. After all these deductions are made, you will get the short term capital gain or long term capital gain. And depending on the nature of the capital asset, the rate of tax would be applicable. It would be 10%, 20%, 15%, or 20% with indexation, or without indexation, or 30%. So it depends on the category of the long-term capital asset. Certain long-term capital assets do not get benefit of indexation, even though when I say that index cost of acquisition has to be reduced and index cost of improvement has to be reduced, you will not get indexation in this situation. For bonds or debentures, indexation is not permissible, other than capital index bonds issued by the government or sovereign gold bond. Shares or debentures of an Indian company acquired by utilizing convertible foreign exchange. We will discuss that in a while. Equity share in a company or a unit of equity oriented mutual fund or a unit of a business trust, section 112A, with effect from 2018. Depreciable asset, you won't get indexation. Market linked debentures, indexation is not allowed. And also specified mutual fund, which refers to debt oriented mutual fund, indexation is not allowed. Undertaking or division transferred by way of slum sale, units purchased in foreign currency, global depository receipts by a non-resident or GDR by a resident individual, securities given in section 115 AD specific to foreign institutional investors. Yeah, now let us go through just the summary of the provisos to section 48. Section 48 refers to the mode of computation, and the provisos limit or define the way the computation has to be done. There are 7 provisos. The first proviso is applicable to a non-resident, and this is applicable in the situation where the non-resident has acquired shares or debentures in an Indian company, and those shares or debentures have been acquired in foreign currency, and in such cases this provision is applicable, the proviso is applicable, and indexation benefit is not applicable, but he will get the benefit of depreciation of the value of rupee. I'll give an example. Say somebody has purchased shares in India through foreign currency. Assume he has invested $100 in the Indian company shares, and after 10 years, assume he sells it at $150 after 10 years. Okay, when he invested, $100 was worth say 10,000 rupees. Okay, in Indian rupees. When he sold, that 150 might have become say 25,000 rupees. So in Indian rupee terms, 10,000 was the investment, but in Indian rupees terms, when he sold it, it was 25,000 rupees. he cannot be taxed on 15,000 rupees. We have to go by the foreign currency what he has invested and foreign currency what he got. And if he has invested $100 and if he got 150, $50 will be taxable and it will not be subject to indexation. But the catch is, investment should have been made in foreign currency. So how do you decide whether the investment in foreign currency or not? One way of interpreting it is, if somebody has remitted foreign currency into his NRE account and then got it converted into rupees and invested in those shares. That is one way of interpreting it. But interestingly, there is a Bombay High Court judgment in 1994 on this precise issue which says that if the cost of acquisition of those shares and debentures are given in Indian rupees, then you cannot say that he has invested foreign currency, because conversion into Indian rupees was a must. It's as per the High Court's judgment, it's possible only when that price itself is quoted in foreign currency and he remitted that foreign currency to purchase it, which is a very remote chance in the Indian situation as the things stand now.
So the relevance of this provision it will not applicable, sir, in practical scenario.
For general purpose it's not applicable, but there could be specific funds or specific institutions which may be getting investment through this. Sorry, FDI.
But there also they will be quoting shares and everything. FDI they will in INR only, no, sir?
In INR, usually they will still be passing resolutions in dollar terms also. Are there any instances which you are aware of? I have some time back have seen that they had quoted the value to be invested in dollars to avoid this litigation. But for the Indian purposes, they will be quoting the Indian rupees. There has been a lot of litigation on this particular proviso because many of the investors who have invested from foreign countries, they want to take this benefit wherever it is possible. Say where the value of dollar has gone up too much, they want to take this benefit. And also there was an interesting decision of Authority for Advanced Ruling in 2011 in the context of Kern Energy, where they wanted to apply this provision to arrive at the capital gain. And for the purpose of applying the tax rate, they wanted to go with section 112(1)(c), which says that in case a non-resident investor invests in shares and makes a long-term capital gain, it would be taxable at 10% without indexation. But the Authority for Advanced Ruling held that both the provisions cannot go together, and they applied section 48, this proviso, and the long-term capital gain should be taxed at the normal rate is what they held. Recently, in 2023, Bombay Tribunal, in the case of Legatum, they took a different view. They held that section 112(1)(c), which says that if a foreign investor has invested in Indian shares and earned long-term capital gain, it should be mandatorily taxed at 10% without indexation, and this proviso's benefit is not available. So they held that this provision is redundant because section 112 overrides all these provisions and says that 10% tax is applicable, and that has to be calculated in the Indian rupee terms, and that Legatum was supposed to pay the taxes. Second proviso, it's plain and simple. In case of long-term capital assets, cost of acquisition and cost of improvement have to be indexed. I have made this as simple as possible because we have quite a lot of things to cover. And also, I have not put in so many litigative issues or the reference to litigations because I know that someone else will be discussing on the judicial precedents with regard to capital gains. Third proviso, indexation is not applicable for long-term capital asset being an equity share in a company or equity-oriented fund or business trust referred to in section 112A with effect from 2018. Fourth proviso, indexation not applicable to bond or debenture other than capital gain bond. I had referred this earlier. Fifth proviso, gain to a non-resident due to appreciation of rupee against foreign currency. Appreciation of rupee against foreign currency usually happens only if it's a Pakistani currency or Sri Lankan currency. I haven't seen it happening against European currency, UK currency or USD. Anyway, there is one proviso. Sixth proviso, where debentures, shares or warrants are transferred under a gift or an irrevocable trust, market value on the date of transfer shall be deemed to be the full value of consideration. Seventh proviso, no deduction allowable for securities transaction tax. We will quickly move on to the next provisions. I am feeling that we are slightly running behind schedule.
Only one question, sir.
Yes, please.
Indexation. You mentioned that no indexation is allowed to MLD, market linked debentures.
Correct.
There are two types of MLDs, protected and unprotected.
Okay.
There are these that unprotected MLDs are still considered as debentures and indexation should be given and taxed at 20%.
Okay. Please go ahead.
So what is the correct standard? And when all MLDs are without indexation or unprotected?
They have given a definition there which says that it is linked to the market performance. This protected, unprotected, I am not very familiar with. If you can explain, perhaps we can then refer to that provision and discuss.
So what happens in unprotected is it is pure debenture. Though it is traded in the market, it is unprotected. There is no fixed return there.
Okay.
Yeah.
That is linked to the market performance, right?
Yeah, it is linked to market.
Right. Protected means capital is protected,
Yeah.
and only appreciation will be shared, but the capital deduction is okay. That may not fit the definition what they have given, because market linked debenture, if there is a protection, it's not directly linked to the market performance. When it is positive, it will be linked to the market. When the market is negative, capital is protected. So in that term, I feel that the definition and the conditions specified there to qualify to be MLD does not get fulfilled. That's what it appears. Let us move on to section 49. When the acquisition of certain assets have been made in certain specified modes, how do we arrive at the cost of acquisition? I mentioned if somebody has gifted you a bungalow or a huge set of jewelry, how do you find out the cost of acquisition? Or somebody has willed, somebody had a HUF partition, we will discuss that. These are the situations which are referred to in 49.1. Of course, they have given a huge list. I have picked up the easiest and the simplest one to discuss. And there are many other modes of acquisition which are not called as transfer under section 47. Say could be shares of the amalgamated companies, later it becoming amalgamating company, or it could be say the distribution of assets on the dissolution of a firm, etc. In all these cases, the cost to the previous owner should be treated as cost to the present owner. That is the way it has to be interpreted. So whatever exercises we need to do to find out the cost of acquisition in the normal parlance has to be done with regard to the cost of acquisition for the previous owner. It's as simple as that. But even in these situations, there are lot of litigation. Let me give one example which is always a burning issue. Say somebody has got inherited house property and assume that property was acquired in 1990. The father who was owning that property passed away in 2015, the son got that property through inheritance and he is going to sell the property in 2024, right? The cost of acquisition will be the cost as whatever has been incurred by the father in 1990 or fair market value on 1/4/2001. It's up to the owner, present owner, to decide which cost he wants to consider. Either of these two he has to consider. Now that's plain and simple. The question is from where the indexation should be done, whether from 1990, which is now to be counted from 2001, or whether the indexation should be done from 2015. Because in the way they have put it across for the purpose of indexation is indexation has to be done from the date the property is held by the assessee. The assessee has been holding this property from 2015, but it got acquired by his father in 1990, which has to be counted as 2001. There have been favorable judgments by various high courts now, even Bombay High Court, Delhi High Court. There are several judgments which say that property held by the assessee has to be counted from the date the property has been held by the previous owner. Otherwise, for the purpose of cost, you want to consider the property, the value of the property from that date. But for the indexation, you want to consider from now, which is beneficial to the revenue, and it's inconsistent, discriminatory. It's not permissible. So for that purpose, the indexation should also be from the date you are going to consider the cost. There is Bombay High Court judgment in the case of Manjula Shah and Delhi High Court judgment in the case of Shanglu Trust. And many tribal decisions have come. I hope the matter will get resolved soon before the Supreme Court. And this is a practical difficulty which we face whenever we have to file the income tax return by declaring this capital gain. Also, in the case of shares allotted as perquisites to an employee, could be ESOP, fair market value considered earlier at the time of allotment will be treated as the cost of acquisition. In case of property which has been subjected to tax under clause, that means undervaluation of the property below the stamp duty value, and that difference value has been taxed by the income tax department, you are going to consider whatever value as per section 56(2). Am I clear, or you need any clarification on this? Capital gain in case of depreciable assets, section 50. Calculation of capital gain or loss arising on the sale of depreciable assets can be divided into following: where some assets are sold from the block of assets, where all assets of the block are transferred and block of assets ceases to exist. Both these situations have been discussed in section 50. Clause 1 discusses one situation, clause 2 discusses another situation. These provisions are not applicable, that's provisions of section 50 are not applicable for transfer of depreciable asset by a power generating unit claiming depreciation on the basis of straight line basis. For an assessee running vehicles on hire who declares income under section 44AE, this ruling will be equally applicable for somebody declaring income under section 44AD or 44ADA. That's why I have put it here. Deemed depreciation at the applicable rate shall be treated as allowed. That means when he sells something, it will be treated that the cost of acquisition will be the written down value, and for this purpose the depreciation for all those years have to be factored and WDV has to be arrived at. Here, computation of written down value is 0, then we will have to, only in that situation, clause 51 will be applicable. First we will find out the value under step 1, and then we will find out value under step 2. We compare that and then decide what will be the taxable value. Say in step 1, full value of sale consideration of depreciable assets will be factored, will be counted. In step 2, we will total up the written down value of block of assets, the actual cost of any new asset which has been purchased during that year, plus the expenditure incurred for the purpose of sale, in connection with the sale. All these will be clubbed together. If full value is higher, then difference is treated as short-term capital gain. You may be holding that asset or the block of assets for several years, but if you have a gain, it will still be treated as short-term capital gain and it will be taxable accordingly. If in step 1 value arrived at and value arrived at step 2 both are equal, or full value is higher, then section 51 is not applicable. Now situation 2, which is clause 2 of section 50, this is summarized here. When block of assets itself ceases to exist, section 52 is applicable. Here find out the WDV of block of asset at the beginning of the previous year, add actual cost of asset falling within that block, and this is how you arrive at the cost of acquisition, and full value of consideration has to be counted. Then you will arrive at the short-term capital gain. This is the situation where entire block of assets is sold. I'll simplify this. See, if there is a block of asset, there may be some 10 assets in that block. A block of assets refers to a particular category of assets subject to depreciation at the same rate. It may be, say, the block of buildings, block of residential buildings, block of plant and machinery which are subject to depreciation as 15% or 30% or any other category. Of course, in the rules you can find the depreciation blocks. In that block, if there are many assets and if you sell off one asset, then even if there is actually a gain, if you individually count the depreciation which has been given in respect of that asset, profit will not be taxable. And it's going to reduce the value of the block of assets, and next year onwards, depreciation what you are going to charge against the profit will get reduced. But if the whole block of assets gets exhausted and if there is a gain, then it is taxable. It may so happen there may be 10 assets, you may sell off only one asset, and the sale value may be higher than the WDV of the entire block of assets. In that case, the gain will be taxable. From next year onwards, you will not have from the same year onwards, you will not have the depreciation, and unless that new asset is purchased, you will not be able to claim the depreciation for that particular block. It's quite plain and simple. The section has been made quite complex as usual. Yeah.
So this applies to even 44 AD cases assessed also.
44 AD case also it would apply.
And in that case, 44 AD, it is a direct present income, where he will not have any effect, no?
But he will have capital gain if he sells the block of assets.
In case part of asset, out of 10 assets, in our example, one asset is sold. Then he will not deduct that from block of asset, no?
No, for the purpose of accounting, I feel he has to still maintain the track record of all the assets added, deleted, everything. And also, for any reason, if one asset is sold and if the block value is still positive, there is no capital gain. But assume the entire value of block of assets is reduced because of the consideration being higher, then that differential has to be treated as capital gain. Because what he is offering as income is under 44 AD is for income from business. Here, if the sale value full consideration is higher than the WDV of the block of assets, that will be treated as short-term capital gain.
So indirectly in 44 AD also I have to maintain books of accounts literally in certain times.
It appears so, because even if you refer to the provisions of section under 44 AD as well, they say that if the assessee claims that his gain is more than 8% or more, then he has to offer that. Yeah, it's a matter of dispute, and there are many instances where they are saying, and there are court decisions which say that it is not necessary, he has to prove that he has spent 92%. Parallelly, there are decisions also which say that he has to declare a higher income if he has earned a higher income. Unable to comprehend which is right or which is wrong.
At the same time, they gave an exemption for books of accounts maintenance.
Yes.
For 44 AD.
Yes.
Which is common.
There is an argument further. If there is income and he has not offered the higher income, the balance is stated as unexplained.
Yes. In the context of 44 AE 2012, there is an Allahabad High Court judgment which say that it is not necessary that he has spent the entire amount. He might have saved something, but to reduce the burden of maintaining the books of account and to reduce the litigation, disputes, etc.
Which I maintain, in which case how will I report it in the tax return?
See, you will have to go by the date of purchase of each of the assets. In any case, you will have to maintain the records for purchase of the asset, bills and receipts. Based on that, you can apply the depreciation rate, and you should be able to justify the WDV.
But that will be outside the book for the first 3 years and outside the return, outside the tax return for the
That's
first 3
true.
years. How do I put it into the 4th year's return? Will that not again create a...
No, you are not going to again report it in the return, because you are going to report it in the under the head capital gains.
Only if there is capital gains arising, only then you...
Yes, yes.
Depreciation is due to be and if depreciation is due to
Sir, otherwise when I sell, I will receive certain receipts on sir. Whether that will fall under the gross which is of 44 AD.
Sale of assets, capital assets will not be treated as gross receipts.
Gross receipts, no.
No,
They will
only
not-
sale of business stock or business assets will be treated as turnover.
Because the gross receipts we have to read in connection with the turnover, I feel. Turnover.
Yes.
Gross receipts of turnover.
It has to be turnover. And in the section, in the act, you won't find this definition. You will have to refer to the guidance note issued by the institute for the purpose of audit and section 44A. There they have explained what is gross receipt, turnover, etc. Yeah. Section 50A, special provision for cost of acquisition in case of depreciable asset. When a capital asset has been subjected to depreciation under clause 1 of subsection 1, section 32 in any previous year, calculation of capital gains upon its sale is modified. The modification involves using the adjusted WDV of the asset as defined in clause 6 of section 43 as the cost of acquisition. This is the point I was stressing. For the purpose of computing capital gains. This ensures that the depreciation claimed on the asset is factored into the determination of capital gains, aligning with the principles of fair taxation. It's what we discussed. Should we have a break? Some of you may be too tired and it would be not justifiable if I continue doing this exercise for long. Yeah, we'll take a break. Welcome back. First thing I would like to clarify with regard to that cash expenditure in the context of capital asset. Section 43 clause 1 refers to actual cost in the context of profession and business only, and there it says if somebody has expended any cash for the purpose of acquiring an asset, then that amount in excess of 10,000 will not be counted for the purpose of actual cost, which means that in case that particular asset has been sold, the cost of acquisition will get reduced to the extent of the cash expenditure in excess of 10,000, and also depreciation won't be available. But for the purpose of cost acquisition for a capital asset falling under capital gains, that provision is not applicable. Just clarified. Now, section 50AA. This is a new section which has been inserted with effect from financial year 2023-24, wherein the specified mutual fund, which is a debt-oriented mutual fund, wherein 35% or less, not more than 35% of its total proceeds are in equity shares of the domestic companies. And if such debt mutual fund has been acquired by the investor on or after 1st April 2023, then the gain made out of that fund will be treated as short-term capital gain, and indexation benefit is not available. Similar is the situation with the market-linked debentures, and they have defined the market-linked debentures where they say market-linked debentures means a security by whatever name called, which has an underlying principal component in the form of a debt security, and where the returns are linked to market returns on other underlying securities or indices, and include any security classified or regulated as a market-linked debenture by the Securities and Exchange Board of India. So there could be two types of debentures. One is where the SEBI itself has classified or regulated as market-linked debentures. The other one is where the returns are linked to market returns on other underlying securities or indices. In the reference what you gave, I don't know whether it falls under MLD as defined under the SEBI. If it falls, there is no need for any further discussion, but if it is not getting covered there, capital protected may not fall under this MLD. And therefore, cost market protected indexation and the capital gain tax at the lower rate might be available. Yeah, how to calculate the capital gain? It's plain and simple. Full value of consideration minus cost of acquisition minus expenditure in connection with transfer. Then you will arrive at a short-term capital gain. No indexation, nothing. Straight away, whatever is the tax rate applicable for the individual, that would be applicable. Capital gain in case of slump sale, section 50B. In this context, somebody wanted me to explain a little bit about this taxation of employees' stock options. I'll explain in just 2 minutes. See, in the case of an employee stock option plan, if the shares have been given to an employee which are not listed in a recognized stock exchange in India, how to tax the benefit, how to tax the capital gain is the question which has been raised by one of the persons sitting here. Here, if the shares are listed in a foreign country, the shares at the time of allotment, which is exercised, or at the time of transfer of those shares, have to be valued by a SEBI category 1 merchant banker, and that valuation will hold good for 180 days. It need not be done on a daily basis by the SEBI certified merchant banker. Stock options or stock benefits, if I want to call it simplified, stock benefits may be of 3 or 4 types in general. One may be restricted stock units, where the employee will get the stock grant and he will get the shares only upon fulfillment of certain conditions, and he need not have to pay anything for that. Say for example, the employee may be granted a restricted stock unit on first day of year 1, and there may be a condition attached that the stocks will be transferred to him, or the stock units will be transferred to him, both will be the same, will be transferred to that employee say the first 25% after completion of 1 year of employment, second 25% after completion of 2 years. In this way, it may be getting transferred in different tranches after a particular period. In that situation, when the shares are getting transferred to him after that particular period, at that point in time, we need to apply the fair market value, which has to be the certified by the SEBI merchant banker, and that value will be treated as perquisite under section 17(2), and it comes as taxable salary. It will be treated as taxable salary. That is the first stage. Similarly, instead of RSU, there may be employee stock purchase plan. In the case of employee stock purchase plan, the employees will be paying a certain portion of the stock on a regular basis, and company will be granting those shares at a discounted rate. That discount will be treated as the taxable perquisite. There may be a third category, employee stock option plan, ESOP. In the case of employee stock option, the employees will be informed that after a particular period, he will get a right to exercise the option to get the shares for a price which will be agreed upfront. Say, when the employee joins the organization, he may be given the employee stock option with the condition that now we are giving you certain number of stocks as grant, and they are not going to be transferred immediately. They will be transferred after a particular period, and whenever that period gets completed, the employee may decide to go for those shares, in which case he is required to pay a certain price which will be agreed earlier, and usually it will be a much lower price, and employee will pay that price and get the shares transferred to his account, and he is free to sell it whenever he wants. And in case of ESOP, again the fair market value of those shares will be determined. That will be the value from which the amount he has paid will be reduced. The balance amount will be treated as perquisite, and it will be shown in Form 16. These are the usually found three types of stock benefits. Once the share comes to the employee, once it gets taxed as salary at the time of transfer, it becomes a capital asset for him, as good as any other shares. So whenever he sells, if he is going to get a higher price than what was the fair market value at the time of transfer, then that difference will be short-term capital gain or long-term capital gain, depending on the case. In the case of overseas stocks, they will be treated as long-term if it has been held by the employee for more than 24 months. For Indian shares, we treat it as 12 months, Indian listed shares. But foreign shares are treated as unquoted shares, and 2 years is the period for them to treat them as long term. If the employee sells within 2 years from the date of acquisition, that's the transfer, then he has to pay the tax as short-term capital gain at 30%, depending on the tax slab, of course. In case it becomes long-term, he is entitled for indexation also, because indexation is not allowed for Indian shares which are treated if they qualify to be long-term, because indexation provision has been withdrawn under section 112A, applicable only for Indian stocks listed on the recognized stock exchange. This is how it is done. The first part, how it has to be treated as perquisite, that is the slightly complex part. Once the employee gets the shares and that perquisite has been taxed properly based on the fair market value, that fair market value becomes the cost of acquisition. Somewhere I explained that earlier. And from there, when you sell it, it becomes a foreign stock. Of course, one important thing is you need to declare that in the IDR. Once the foreign shares get transferred to the employee's account, it becomes a foreign asset, and he is required to declare in the foreign asset schedule in the income tax return. There was a question whether the grant given by the employer that grant is an assurance that at a later point in time certain shares can be given to you if you stay with the company. Whether that itself has to be reported in the ITR, because that may also create a right. There are different schools of thought. I am of the view declaring or reporting that grant is not necessary because it is not transferable and it is contingent. Nobody knows whether the employee will be able to fulfill the conditions, including the term of employment, to get that benefit. Moreover, it doesn't have a market value. So for that reason, it may not be necessary to report in the ITR unless the employee gets the shares in hand and becomes the complete owner of those shares. Last year, there were many instances where the income tax department, particularly the foreign assets investigation unit, had issued thousands of notices to employees of multinational companies where the employees of multinational companies had received the notice. The employees had not reported these foreign stocks or the foreign bank accounts in their ITR. The foreign governments had shared information of Indians having bank accounts or foreign stocks to the Indian government, and Indian government through the income tax department wanted to know whether all these people have declared that. We had instances where somebody had a bank account for the last 7-8 years in some foreign countries and he had even forgotten. The bank balance was hardly some 30-40 euros, but he had received a notice, he had forgotten to declare that in the return. So be careful with all these MNC employees and make sure that they report the details of foreign accounts and foreign stock options when the stock has been received by them appropriately in the ITR.
Sir, in case of non-resident, they will go for employment outside India, but they have some small amount of interest. We will file a return with respect to that. Even in that case also I have to...
No, this is applicable only for residents, ROR, resident and ordinary resident. If they qualify as non-residents or not ordinary resident, declaration of foreign assets is optional.
Irrespective of value.
Irrespective of value. Even if you have one share worth, say $10, if you don't report, under the Black Money Act, the employee can be caught and they can levy a penalty of 10 lakh rupees only.
Only?
Per year.
Only.
Yes. And there has been recently on Bombay Tribunal decision where the employee had not evaded any tax. She had forgotten to report for 3 years, and the tribunal did not accept the explanation that her CA did not include it, that she did not know it, and she has not evaded the tax. They simply went by the language of Black Money Act and they have levied 10 lakh per year.
So if they have forgotten, can they add it this year and then file it? Like
They can do that, but that mistake which is done for the earlier year will still be mistake.
Can ITRU be filed for that situation?
ITRU is possible only if there is additional tax payable. If you don't have tax payable, you cannot file that.
Then 1 rupee
so
or
how
something
do we
we have to
rectify
add.
it for the previous years?
Rectif-
Just simply to this year add it and put it, or?
That's the way. Perhaps you can file a letter with the assessing officer. That can also lead to some some issues, but that is the better way, is what I feel. Saying that this has been misdone and I am declaring it by way of letter. At least somewhere in the litigation you may be able to defend that there was no intention and you have declared it.
Sir, now few banks they are doing a international mutual funds, sir. International mutual funds.
But they are Indian mutual funds
No,
which have been investing there. Basically they are Indian mutual funds, global investments.
So in this capital gain case of employees ESOPs, employee working in India, getting shares of their parent company in overseas, and offering capital gain, again we have to compute in foreign currency and then translate, or in INR we can convert.
How it has to be done is, we will find out the capital gain in the foreign currency terms, and as per rule 115A, if I recall correctly, capital gain has to be arrived at on that basis and converted applying the previous month and SBI TT buying exchange rate, and you have to declare it.
Because purchasing would have been calculated at the time
There will be, there could be some mismatch, some gap. There could be some gap, but make sure that that gap is properly offered to tax. Even you can offer it under income from other source also. To be on the safer side, offer it under income from other sources.
So the catch here is the fair market value which is offered to its perquisite should be converted to foreign currency rate for another cost.
Yes, yes, yes. That is the way it has to be done.
So in some cases, ESOPs, as soon as they are granted and as soon as they are vested or given to the employees, they don't have a time period to hold on. They have to exercise it immediately or sell it immediately. So there are cases that they give it today and they, in 2 days automatically they get sold. Then there's always a short-term capital.
Yes, there will be short-term capital gain. There has been one Hyderabad ITAT decision, I can't recall the name, where they have told that if there has been a grant of right to get those shares, even that can be treated as a capital asset, and the time has to start ticking from the date of the grant itself, and there could be situations where it may become long term if the period of grant is more than 2 years, but I don't think that has been accepted by many people.
What happens in this case usually is the perquisite that is accounted in your salary. That is the same thing that is your capital gain. And when you do minus, there's actually no much capital gain. It's just a differential forex that comes in picture.
But what happens, 2 things I need to tell you. One is the taxation of perquisite. That anyway, your company will take care of it. But parallelly, it is necessary for the employee to report it in the capital gain also. It may be say 10 rupee plus or 10 rupee minus, but you have to declare it because it's a capital asset what you acquired. There are exercises which happen by the which are made by the employee. He just clicks the button, I want to exercise. If it is say the trading is going on, for example, immediately the shares will get allotted to him. Next second, a part of those shares may get sold to cover the tax cost on that perquisite part. 30% or 35% would happen that way. Even that 30-35% which might not hit the bank account of the employee should still be reported as capital transaction, the sale of capital asset, and the cost has to be reduced. It could be few rupees, but you have to report it. Parallelly, you need to report in the ITR, in the foreign asset schedule, because you became the owner of those shares for a few seconds. That has to be reported there. It is not the year-end balance which has to be reported in the foreign asset schedule. If you are the owner of a foreign asset, even for any day or any part of the day, you still need to report.
But we usually report what is the voting balance given the RSU, ESPP, everything, whatever is consolidated voting balance.
In the foreign asset schedule, if I recall correctly, in the last column you have to show the closing balance. But there is an acquisition, transfer and closing balance. There you have to report.
So in continuation of this example, if it is a foreign share, ESOP allocated, can we take that foreign tax credit what they have deducted?
You can claim the foreign tax credit. You should have adequate proof. Possible.
So what will be the period for this foreign tax? Will it be Jan to December or April?
Most of the countries follow Jan to December, and based on the date of the transaction, you have to take the credit. For the purpose of reporting of foreign assets in the ITR, we need to follow the last date of that country. It's so confusing. Let me explain. What they have done is, say, if you are filling up the ITR of an employee, you need to have the details of the foreign assets as per the closing date of that country's accounting year. Most of the countries follow calendar year. So in most of the cases it will be 31st December balance is what you are supposed to report in the foreign asset schedule in the income tax return. For the purpose of capital gains, you have to follow this. It may be the same asset. It may be the same asset. But for the purpose of capital gains and taxation, we have to follow the Indian accounting year. That's from April to March.
For dividend received also Indian accounting.
Yes, because it's taxable.
Only for closing balance we will follow the foreign accounting.
Foreign accounting year. And in case of say Hong Kong or UK, foreign accounting year is April to March. Simple, easy for us. But Australia it's July to June. For most of the other countries, April to December.
So what happened to the investigation into the one of the cases given we have received? So what is the next steps that they are?
It's in the freezer. Thousands of notices they had issued. Many of the people have responded, and many people did not get the notice also, because many of the notices had gone by post, and the address would have changed. And at the moment, even for the notices what they have issued 1.5 to 2 years ago, I haven't seen any further movement. And you never know. They have unlimited time.
This is about 8 years ago. I had a share, and we didn't know if same thing happening. Like what? I don't know from where this information is coming. And then that's when we questioned him about the other transaction. He's like, yes, I used to hold shares that time.
Yeah. Capital gain from slum sale. Long term, it's a long term capital gain if that undertaking has been held by the seller for more than 36 months. Otherwise, it's going to be short term capital gain. Here you are not going to identify each of the assets or the value and when that asset was acquired or when how much it has been used. All those things are not considered. We go by the period for which the undertaking or that unit has been held by the taxpayer. Based on that, it will be treated as long term or short term. The net worth of the undertaking shall be treated as cost of acquisition. They have given how the net worth has to be computed. It would be the WDV of the block of assets. The in case of goodwill, which is self-generated, it would be nil. In case of all other assets, it would be book value. The benefit of indexation is not available. If net worth is negative, the cost is taken as zero. There are many companies which want to take a different view, but there is one tribunal decision which says that if it is zero, you have to take it as net worth as zero, and whatever sale consideration is received in respect of that undertaking for the slum sale, entire amount will be taxable, long term or short term.
Sir, from this slum sales, can the gain from the slum sales be set off against business loss and depreciation accumulated?
See,
the benefit be available?
Capital loss, if I recall correctly, it depends on whether the short-term capital loss or long-term capital loss. If it's a long-term capital loss, you can set up only against long-term capital gain. Short-term capital loss, you can set it off either against short-term capital gain or long-term capital gain. You have an option.
This is a gain from slum sale only.
Slum sale, ultimately it will be treated as capital loss only. If there is a loss, capital loss. If it's a gain, capital gain.
So can it be set up against depreciation only of the business?
No, it can't.
Cannot.
No. It's a capital loss, it can't be set off. Yeah, that's what I remember.
There are decisions in favor of allowing depreciation.
In favor of?
The setting off in the case of some Nandi Steels Karnataka tribunal decision.
Okay. I can't remember. Yeah. Maybe you can raise this question when somebody is dealing with section 72, all that.
Sure.
So, in the case of a slum sale, when the net worth is negative and we're moving it to it's sold from one company to another company, what is the value that we need to put in our assets and liabilities? How do we account it also?
Practically, we need to do a valuation of that done. Each of the assets have to be valued, and based on that, we have to show that in the balance sheet. That's the way we generally do.
And the valuation is done by?
Valuation usually is done by the registered valuers who are registered with the income tax authorities. You can find the list. Full value of consideration for land or building, section 50C. Section 50C is applicable only for transfer of immovable property. It will be a land or building or both. And in case the stamp duty value of the property is higher than 110% of the sale value, this section kicks in. Please remember that. Many a times, many of us advise that there will be a 10% margin, or what we call a safe harbor, at the time of sale of the property. So if the SDV, the stamp duty value is say 1 crore, we may advise that the seller can sell it at 90 lakh rupees. But it is not the case. It will be slightly around 91 lakh, because it's going to be 110% of the stamp duty value which has to be factored, and not 90% of the sale value. That in some cases, I have seen this transaction happening that way and ending up in issues. Yeah.
110% of sale consideration.
110%. Sorry. SDV is 110% of sale consideration. 110% of sale consideration. If above conditions are satisfied, the value adopted by the stamp duty authority shall be taken as full value of consideration. SDV on the date of agreement, assume the stamp duty value on the date of agreement and stamp duty value on the date of sale are different. It happens when the immediately, that happened in Karnataka also. October onwards, they suddenly hiked it by 30, 40, 50%. So agreement might have happened sometime in September or earlier. Then the seller may be put to questions why you have sold it at a lower price. If he has a written agreement, and if a part of the consideration has been paid through banking channels while entering into the agreement or after the agreement, then it is possible for him to justify. Sorry, on the date of the agreement or before the date of the agreement, he should have transferred at least a part of the consideration through banking channels, and it should be supported with the agreement. Then he can say that at that point in time, I went into an agreement based on the SDV at the time of agreement, and there was a hike later for which I am not liable to pay the tax.
TDS will be an actual value.
TDS is going to be actual value.
Sir, agreement means sale agreement only or MOU, something like that?
Should work. Yes. Full value of consideration for land and building. Of course, the same thing. In the interest of time, I would like to proceed a little faster. Whatever I explained, we had just put it in summary form. 50C is not applicable when the transfer is made to defined relatives, because that part which is lower than the stamp duty value will be treated as a gift, and therefore it is not taxable both for the transferor and the transferee. 50C is not applicable to charitable trusts governed by section 11. 50C is applicable to urban agriculture land, but for rural agriculture land itself will not qualify to be a capital asset, so 50C is not applicable. There have been a couple of decisions also on this. 50CA, slightly similar provision, or for transfer of unquoted shares. Here they have given the fair market value as the value at which the shares have to be transferred. If the transfer is below the fair market value, in that case this section will get attracted, and both the transferor and the transferee will get taxed. Transferor will get taxed under 50CA, transferee will get taxed under section 56. FMV deemed to be full value of consideration. this is a new section. When consideration for transfer of a capital asset is either not determinable or not ascertainable, in such cases, fair market value shall be deemed to be full value. Advance money received under section 51 until assessment year 2014-15, if at the, under an agreement to transfer some property, if the transferor had collected some advance money and for whatever reason that amount has been forfeited, then the seller of that property was required to reduce the forfeited amount from the cost of acquisition. This was applicable until assessment year 14-15. Now that provision is redundant, this section is redundant. Now, in case that advance money has been forfeited, it has to be offered to tax under the head income from other source under section 56. So, in case any of our clients have collected advance in that year and forfeited, and if they are selling the property now, you need to reduce it from the cost of acquisition. Yeah, to that extent, that provision is still applicable. Meanings of certain words, we have covered most of the contents of this section. It could be relating to fair market value of property purchased, acquired before 1/4/2001, or it could be fair market value of equity oriented fund or shares which are purchased before 31st January 2018, etc. These are the things which we discussed already. Yeah. Now, let us have a look at exemptions under section 54 to 54JB. There are about 7-8 important sections which can give the benefit to the taxpayer for income under capital gains. Some of them are available even for short-term capital gain. Most of them are available for long-term capital gain. What we have done is we have used some tables just to summarize the provisions. Of course, I should thank many of the authors from whom I have immensely borrowed in this discussion. I have compiled based on some of the commentaries. Exemptions under the head capital gains. Here we are comparing with section 54 and 54F. Both appear to be similar, but they are not identical. Who can claim the exemption? For both the sections, exemption is permissible for an individual or HUF only. Companies, partnership firms, etc. cannot claim this exemption upon transfer of assets. What is the asset for which this exemption is permissible? It should be long term. Upon transfer of which asset the exemption is possible? Exemption is possible under section 54 if a residential house property is transferred. It should be a residential house property. But in case of section 54F, it should be any other long-term asset other than a residential house property. And 54F is available only if the taxpayer does not own more than one house property on the date of transfer of this property. Is it clear?
So in case if the property is residential, but it is being let out for a commercial purpose.
If the intention is residential, you can still claim the exemption, because if all the records documents say that it's residential, temporarily it may be given for commercial purpose. There is some decision also. Yesterday when I was going through the commentaries, I could find out on the exact issue. What they are saying is, it's a high court decision. What they say is, even if it is let out for some temporary period for commercial purpose, it does not alter the nature of the property. It will still be residential. Which asset the taxpayer should acquire to get the benefit? Upon transfer of that earlier asset, in case of 54, the earlier asset should be residential house property. In case of 54F, other than any long-term asset other than residential property. So that we call as original asset. What is being sold, let us call it as original asset. The original asset, if it is transferred, the new asset being acquired should be one residential house property in India. One residential house property in India. This amendment happened in 2014. Until then, they had mentioned house property. So many people purchased property in foreign country and claimed this exemption. And of course, Bangalore Tribunal and many other tribunals have also accepted that if they have purchased the property outside India, it should still be allowed because there is no restriction that the property has to be in India. For that reason, they have made the amendment. What is the time limit for acquiring the new asset? In case of purchase, 1 year before the transfer of the original asset is also possible. In case of then 2 years forward, that's 2 years after the transfer is permissible. In case of construction, it has to be 3 years from the date of transfer. So there was a question, if somebody has started the construction before the transfer of the original asset and construction is completed after the transfer, whether they are eligible for the exemption. They are still eligible because what we look at is the date of completion of the construction. We are not looking at the date of start of the construction.
Sir, if only land is purchased prior and then sale is made and then construction is started, can the land cost also can be?
Usually, you want to, sorry, I couldn't get it.
So first the land is purchased and then we are selling it, the property, and with that proceeds we are building the house property in the land which is purchased. So is that also can?
Cost of land can also be treated as the for the purpose of value of the new asset, provided all the activities of the construction gets completed within the 3-year period. Cost of land is accepted as the
Even
new
if it is
investment
prior,
cost.
even if it is prior to the
Yes,
sale.
yes.
So, I purchased a house property from a construction builder 10 years back. I sold the property today, and in the same year, the construction of that house was also completed. So, would I still qualify here as for my exemption that it is property purchased?
You purchased the property 10 years
10
ago
years back.
and you sold it in this year.
No, I sold another property.
Okay.
But, and that construction of that particular property, I got the handover from the builder also in the current year, and in the same year, I have made a sale of another property.
Okay.
So will I still be eligible to claim the exemption? Or
Did that contractor take 10 years to complete the construction?
Yes.
Date of construction, date of completion is what matters.
I have the completion certificate also taken in the current year.
And registration happened?
Yes, registration also in the current year. Earlier it was just an agreement to sale, but now I got the absolute sale date and the flat is in my name in the current year.
You would be eligible for the exemption under 54.
What becomes, okay, I will be eligible, but what becomes the period of holding on this asset? Will it be 10 years back since I paid the advance 10 years ago, or will it be from my date of registration?
Ideally, it should be counted from the date of registration itself. Because until the date of registration, what you held was not the property, it was the right to acquire the property. Once the property is registered, then you got the property itself and you got the right on that property.
Sir, I think there is a different view. So the date of agreement, there is a intent that I will get I will get that house property, flat. So I heard somewhere that yesterday, so that from the date of agreement, initial agreement will be my date of acquisition.
Okay. Of course, let me tell you that these sections 54, 54F, etc., they are interpreted liberally depending on the situation. For example, if it has to be for her benefit, she can still argue that I have been holding it for 10 years. But taking that view that she has been holding, the possibilities, what she had was only a right. I can still give some more example. Assume instead of getting the property registered, she had sold that right itself through another MOU or agreement to somebody else. Then that was possible. The profit what she would have made would have qualified as a long-term capital asset, but for that the asset would qualify to the long-term only if she had held it for 3 years, and also it would be not treated as the sale from, the capital came from sale of residential house, it would be considered as profit from sale of a right. So from that perspective, if you look at it, that is a separate and distinct right. And once the property comes to her ownership, it is a different one. But in case it is going to be beneficial in her case, in this, it is possible to stretch that when she entered into the agreement itself, she was looking at a house property and she got certain rights on that. For that, there is one circular which says that allocation of a particular flat under the Delhi Development DDA, Delhi Development Authority, that itself can be treated as acquisition of the property, if you want to justify that. But if she is going to plan that, I would still suggest that let her consider from the date of registration as the new asset.
So continuing your example, if the right is sold to a third party, 54F is available or 54?
54F would be available, 54 is not available.
It is not a residential property.
Yeah.
There is a sale of plot and there is an existing house which needs to be demolished and then constructed. Can we claim that demolished?
You acquired a new asset. I couldn't
No,
follow.
sir, there is a plot which needs to be sold and there is an existing house, one residential house, which we want to demolish and then construct. Invest in that.
Okay.
So that can be, the demolition cost can also be claimed.
Demolition cost cannot be treated as the acquisition cost for a new property.
So only the construction.
Only the construction.
Sir, unless I demolish, no, I cannot
I
construct.
cannot
Sir. It is a part of construction.
But for demolition, to my knowledge, you will get money. You may not even spend the amount. That's what I have understood from many people. Because you will contract somebody to demolish and take away whatever waste, everything is there. At least in 2-3 instances, I have seen that they pay some 50,000, 1 lakh, and they will do everything and clear up the place.
And the cost of the land which was earlier purchased, that can be claimed.
Cost of the land,
Land which is now, after demolishing the land is there, on which we want to construct. It's a very
I
short-
doubt whether you can claim it. I think her question was also similar. Yeah, what I may be contradicting, but what I'm thinking is, say, if it is 20-year-old land,
Yes.
okay, it is not a new acquisition or a new investment. It may not be possible. I am sorry if I am contradicting, but that is the thought I am getting.
I think the purpose of 54 is to give an exemption whenever they do an investment from the same.
Whenever they do the investment. But say, assume a situation, somebody has purchased the land very recently for the purpose of construction of a new house out of the investment. Say somebody has done it maybe 1 year or 2 years ago. I still feel that it might be possible to claim the cost of land there. But if it is too old, where the investment might have happened long ago, it is not directly connected to the recent sales happening, it may not be possible to defend. But having said that, all these provisions are always interpreted to the benefit of the taxpayer. That is the best part of it. Sorry?
54 it is mentioned, it is for new asset.
It is for
New asset.
new asset. Okay.
So land will be
Okay, if it is purchased prior to that, it's not possible. But if somebody has purchased 1 year before, then it might be possible.
Yeah.
Okay.
Construction I will 3 years after.
Yeah.
For construction, it is 3 years after.
Yeah.
Because of that reason, purchase here only.
But construction gets completed 3 years after. Construction may start much before. And to start that construction, the investment might have been made in the land.
Sir,
Before the sale of land.
can I use the sale proceeds of a residential
Within 1 year, I think.
for anything, any capital asset and construct a residential property in the land owned by my spouse and claim?
For the house property, you can still claim if the property is getting registered in that person's name itself. Whoever is the person who has sold, the new asset is going to be registered in that person's name, it should be possible without issue. But there are many instances where the husband sells the property, purchases the new property in the name of the wife, Still, it has been liberally interpreted and exemption has been given. Many tribunals are taking liberal views on all this. But there is an instance where somebody sold the house property in his individual name and purchased the new house property in the name of a major daughter. The exemption was denied because she is a major and not a family member. But if it is between husband and wife, they have accepted that exemption is possible.
But that is not clearly specified in this exemption sections, that family, in the name of the family.
Nothing,
But
it's all left to interpretation.
Liberal view, that's it.
Yes, liberal view. That's the general way it's happening.
So it's very on the demolition of the property. So what if I structure a transaction that I buy the land with the inhabitable structure, even though it's a house on paper, it may not be habitable. So can I call it a residential property purchase, and then I'm satisfied with the condition of 54F, and then I demolish and I'm free to do whatever I want to do.
Two things. One is it has to be habitable, because unless it is habitable, it cannot become residential. For becoming habitable, you should have a kitchen, you should have a toilet, electricity, water supply. These are the minimum things you need to have.
Agreed. So I'm saying when I say inhabitable, I mean an old structure, let's say 100-year-old building or 80-year-old building, which I may not want to live in. I want that
got it.
particular property.
Yes.
So I would obviously have to demolish it and construct it back.
So I'll come to that question. I wanted to explain that. Assume under section 54F, you acquire a piece of land with an old building, and you want to demolish that and construct. As per the conditions of section 54F, once a new property has been purchased, it should not be transferred within a period of 2 years. 3 years. Within a period of 3 years. Okay, and whether demolition of the property which has been purchased, which is an old one, is transfer or not. Because transfer under section 2 subsection 47 includes extinguishment of a right. Whether demolition of a house tantamounts to extinguishment of a right in that house, and whether it can lead to transfer. And because of that, can we call it that you have violated the required conditions under section 54F, and whether 54F can be denied because you have demolished it?
No, is it not exercise of my right? It's my right.
Extinguishment of a right.
I understand your point. I'm saying the fact that I can break the house, I can demolish it. It's in fact my exercise of my right to demolish the house or do whatever with it. It's not extinguishment of right.
Extinguishment of a right in the sense, you have a property gives you a right. Extinguishment of the property or extinguishment of the right is what I mean. And in this context, there is a Bombay ITAT decision, if you are interested I can share that with you, which says that if somebody has demolished, then it should be treated that he has transferred that property because it's extinguishment of right under section 247. But after that, Bombay High Court has taken a view that it cannot be treated as extinguishment of right if a new property has been constructed within the given period. If somebody immediately demolishes and within 3-year period if a new house property is constructed, you cannot say that he has transferred and therefore the exemption should be withdrawn. But everywhere the discussion has been on extinguishment of right because that property has been completely demolished, extinguished.
House property sold in the current year, and I have invested the full consideration in capital gain account scheme, and I have paid advances to the builder over a period of 3 years. Will that be considered in construction?
If the entire amount of capital gain, are you referring to 54 or 54F?
54.
Yeah, either. In case of 54, it's the capital gain amount which has to be invested in new house property. In case of 54F, it is the amount of sale consideration which has to be invested. That is the distinction.
Period of construction, I have not constructed. I have paid to the builder, and builder is constructing over a period of 3 years. Will that be considered for 3 years, or it should be acquired 2 years?
If construction is done even by the builder, it will be treated as construction done by you. There are decisions, and also In the context of apartments also they have held that even if you have booked an apartment and construction is going on, it cannot be treated as purchase, liberal interpretation has to be given, still you are constructing it, one. Secondly, construction might not get completed within that 3-year period. The builder or the contractor may take a longer period if you have paid all the amount within the period, within the 3-year period, and if the constructor or contractor has delayed it, still you should be eligible for the exemption. There are quite a lot of decisions. Of course, all these are left to the courts and the judges to interpret. We can only discuss and debate.
In two cases where you're paying an installment basis, indexation, what do you recommend? You go based on the particular installment from that date, or you go for the date of handover?
I would suggest you go by the date of handover. There are decisions which say that you can go by the installment as well, because to that extent you are increasing your right on the property, but hardly there are 1 or 2 decisions on that.
Even one decision which says you move on the date of allotment itself, not at the sale agreement.
Yeah, Bombay Tribal Decision, quite an old one. After that, I haven't seen any recent decisions on that. I think 2014-15 I have seen one decision exactly on those lines. From which date time limit shall be determined? From the date of transfer of house property, but in case of compulsory acquisition, from the date of receipt of the compensation. See, if the government has compulsorily acquired, then date of transfer is not counted. It's the date of payment of the compensation. Even the Income Tax Act has been drafted in such a way that they were aware the government will never pay on the date of transfer. It may take several years, and if there is any increase in the compensation later because of court orders or decisions or appeals, then that increased compensation will be the date of transfer for this purpose. How much is exempt? In case of investment in new asset, the amount of new asset or the amount of capital gain, whichever is lower. And it means if you are going to invest the entire amount of capital gain as per provisions section 54, entire amount will be exempt. But in the case of section 54F, unless you invest entire sale consideration, you will not get the exemption for the entire amount of capital gain. If you invest some amount lesser than sale consideration, the exemption will be given on a pro rata basis. This is going to hit in a different situation. I will explain that later. Is it possible to revoke exemption in subsequent year? If the new asset is transferred within 3 years of its acquisition, in case of 54, interestingly in case of 54F, if you construct or purchase a new property also, they are going to withdraw the exemption. If the new asset is transferred within 3 years, or if another residential house is purchased within 2 years of transfer of original asset, or if another residential house is constructed within 3 years of the transfer of the original asset. So you should not do any of these things if you want to retain the exemption. There was a thought process with one of my clients. He was wondering, for applying 54F, I already have 2 house properties. How if I transfer one of the house properties to my wife, so that I will have, if I transfer both the house properties to my wife and I will acquire a new one, whether the exemption will still be withdrawn. But my view is that exemption can be withdrawn and it may be a gift, but we don't have any decided cases on that. Any views?
One more twist to this.
Yeah.
Some of them say that we are holding jointly 2 properties. So I hold only half.
Yes.
So it's not 2.
Correct. Right. There is a Supreme Court judgment, quite an old judgment. I think I have referred somewhere, which says that even joint holding has to be counted as holding of one property.
That's what I told.
Yes.
So 1 plus 1 in that case 2 houses.
Yes. If 2 properties are jointly held, both of them will be holding 2 properties. It amounts to 4 properties in that sense. 2 for a husband, 2 for wife. But while selling, it will be 2 only. You can't sell 4. When the exemption is revoked, it is taxable in the year in which the default is committed. So notional income will be short term or long term in the case of section 54. When the exemption is revoked, taxable in the year in which the default is committed. It should be long term capital gain. I am sorry if there is any typo error. It should be long term capital gain. Whether the scheme of deposit is applicable, that capital gains account deposit scheme, wherein you need to deposit the amount which you are planning to invest with the nationalized bank on or before the due date for filing of the income tax return, and you have to mention the details in the income tax return as well. In most of the cases it will be 31st July, which will be the due date under section 139(1). In some cases where they are subject to audit, etc., it will be 31st October.
So after 3 years, you have to take settlement from
After, when you want to close the account, you have to approach the income tax jurisdictional assessing officer, and you have to get his certificate in form H or something, submit it to the bank, and then only they will close it.
after construction or purchase.
Yes. At the time of withdrawal, they don't ask for income tax officer certificate. Based on the documents that you give, they go on releasing. When you want to close it, then you have to approach. There are many instances where people have completely done everything, but they have not approached the income tax department to close that account. The banks would be reminding them to close it.
It's compulsory.
It has to be closed.
But once the amount is deposited to capital gain scheme, sir, they will not again credit it to our bank account. They will disburse that amount to vendor's account only.
Okay.
They are insisting only to
But in many cases I have seen where these people pay out of their bank account, produce the bills and get the amount back.
in my one of the case, they will not pay this amount to our bank account. They insisting vendor's account only they pay.
What if the taxpayer has directly made purchases to several parties? He himself may be constructing, for example, individual laborer, cement, steel, everything he may be running around and paying. Practically, that might not be possible.
Practically, it is happens. They will not pay it to our account.
Okay.
India, everyone wants to control it. That's why. Without jurisdiction.
Maybe highly knowledgeable officer. Highly knowledgeable officer.
Yeah. Any further discussion 54 or 54? Yeah, with regard to 54 and 54F, I wanted to tell you something. In section 54, I think from assessment year 2024-25, that's the financial year 23-24, they have put a cap of 10 crore for the new asset what you are going to acquire. In case of 54, if the capital gain is higher than 10 crore, say for example, let us take the example under section 54. Sale of residential has happened. Capital gain what has been received is say 15 crore, and the investment in the new property, house residential house property, is say 20 crore. Then because of this new clause from 2023, 10 crore would be the maximum value of the capital asset for the new investment. So 15 crore, even if it is the capital gain, because investment, even the investment is higher, exemption would be limited to 10 crore. On balance 5 crore, he has to pay the tax. To some extent it's fair. But think of section 54F. In 54F, he has to invest the entire amount of sale consideration to get the capital gains exemption. Assume a situation where the sale consideration is say 30 crore, okay, and capital gain amount is 10 crore. New property purchased is 15 crore. If it is a situation of 54, exemption of entire 10 crore is possible. If it is situation of 54F, 50% of 10 crore is the benefit he will get. He will have to pay the tax on remaining 5 crore because it's on a pro rata basis. Even though he has made an investment of 15 crore, he will not be eligible for exemption of 10 crore.
If it is a joint, then can you claim
full exemption. 2 persons owning that.
2 persons owning is possible, but if it is, if the investment has been made by one of the parties and other party is only for, say, administrative convenience or what they call as cosmetically they have added the name. If it is husband and wife, should not be an issue. If it's a third party, I feel it could lead to some issues. (54B) and 54D. Any further questions on 54? 54F? 54B and D. 54B pertains to agricultural land, sale of agricultural land. 54D relates to compulsory acquisition of industrial undertaking. In case of sale of agricultural land, individual or HUF only they can claim the exemption, but 54D, any person can claim the exemption, including companies, firm, whatever. 54B or D, both exemptions are possible whether it is short term or long term. In case of agricultural land, it should have been used for agricultural purposes for the last 2 years. 54D, it should have been used at least for 2 years for industrial purposes. You may have a question, why agriculture property is still getting exemption when it's already a capital asset? It is not a capital asset on section 214, exemption is available. This applies mainly to urban agricultural land. For rural agricultural land, we need not have to discuss 54B. It's anyway out of taxation. Time limit for acquiring new asset is 2 years after the sale. If somebody has acquired just before the sale also, is not eligible for exemption. For land or building for industrial purpose, 3 years after the date of transfer. From which date the time limit shall be determined? From the date of transfer of agricultural land. But in case of industrial, it's compulsory acquisition, so it has to be by the government, and you never know when you are going to get the amount from the government. So they have relaxed it. From the date you receive the compensation, the time will start ticking. How much is exempt? Investment in the new asset or capital gain, whichever is lower. Here there is no pro rata concept, or there is no requirement for investment of the entire sale consideration. It's sufficient if you invest only capital gain amount. If the new asset is transferred within 3 years of its acquisition, then exemption will be revoked. It may become short term or long term depending on the period of holding. Scheme of capital gain deposit is permissible here as well. Next sections 54G and 54GA. Here in 54G, this refers to shifting industrial undertaking from urban area to rural area. In 54GA, it's shifting from urban area to SEZ. Again, short-term or long-term benefit gains are also subject to exemption if all the conditions are fulfilled. Time limit for acquiring new asset is 1 year backward or 3 years forward. Date will be counted from the date of transfer. Here again, the exemption is allowable for the entire capital gain amount if the capital gain amount is invested. They are not asking us to invest the entire amount of sale consideration. If the new asset is transferred within 3 years, then the exemption will be reversed. When the exemption is reversed, it will be treated as short-term capital gain. Capital gain exemption is, deposit scheme is available for both these. The last type of exemption what we are going to discuss is section 54EC. This exemption is available for all persons, even for companies, firms, etc. Individuals, HUF, anyway, they enjoy a priority. Capital assets should be long term, and for the last, I think, 5-6 years, they have made it that only if the long term capital gain is from transfer of land or building or both, then only this exemption can be availed, not for any other asset. Earlier, even the employees who would be selling the stock options, earning huge amount of capital gain, they would invest in these bonds and they would get the exemption. Now it is not possible. Investment has to be made in bonds of National Highway Authority of India or Rural Electrification Corporation. Time limit for acquiring the new asset is 6 months from the date of transfer. What will happen if the investment is made before that? Generally, the exemption is not possible, available. But assume the sale consideration of that property has been received before the date of transfer and that money has been utilized for the purpose of investment in bond. There is one decision which says that exemption should be allowed. From which date the time limit shall be determined? From the date of transfer of long-term capital asset, but in case of compulsory acquisition, from the date of receipt of compensation. How much is exempt? Here again, restricted to capital gain amount. Entire sale consideration is not required to be invested. If the bond is transferred or any loan is taken within 5 years, then the exemption will be reversed. When the exemption is reversed, it becomes long-term capital gain of that particular year.
Sir, here deposit scheme you said, no, sir, there are certain time where that bonds are not available for investment.
Then it is relaxed.
It is relaxed. I can deposit in the scheme and then I can take exemption.
No need to deposit in the scheme. You can. There is no capital gain deposit scheme for this. No, I have mentioned it.
So after end of 5 years, we need not.
You need not pay tax.
No condition.
No, you can. You need not have to deposit the capital gain account scheme. Assume there is one interesting tribunal decision. Somebody had an option to invest in National Highway Authority bonds, but he wanted to go for only REC bond. Of course, that is an afterthought. He told that I wanted to wait until REC opens, and he invested in REC bonds, which was beyond 6 months. Tax officer asked me, I told I wanted to wait only for REC and it was not available during the 6-month period. Then National Highway Authority bond are available. He told I have no faith in that. Tribunal agreed that it is fair enough that he waited until REC bonds are open and exemption should be granted. There is no scheme for capital gain deposit here, capital gain accounts.
And then 50 lakhs also within a year, I mean any point of time.
Now, in that year of transfer and the next financial year.
Total, cumulatively 50 lakhs we have to say.
Cumulatively 50 lakhs. What happens is if you have transferred 2 assets, one in this year and one in the next year, you will be stuck. Because this in deposit of 50 lakh is available for say the year of transfer of the first asset and next financial year. And yeah, I can give an example. Assume you sold one piece of land sometime in say January 2024.
Yes.
Okay, and you have window till July 2024 to deposit it capital gains bonds. And you deposited in March, that 50 lakh rupees you deposited in March. And you sell another property sometime in September 2024. Okay, you cannot deposit another 50 lakh relating to that second property in that financial year. You will have to wait for the end of 2025 March for the new financial year to begin, and then only you can deposit, but by then the 6-month window will get over. So if you are planning to sell the second property in September, push it to October or November, So that 6-month window from the date of transfer will be open until the beginning of the next financial year, and deposit one more 50 lakh in that financial year. But if somebody is in a hurry to sell before September or say before this 6-month period, they cannot get this benefit.
Sir, there is no restriction for end use after 5 years.
No restriction. You can share it with us. No restriction, absolutely. For personal use, you can use it.
Can it be clubbed with any of the earlier resolutions?
It is possible. You can club it. You can go for 54, you can go for 54F. Still, you can go for 54 easy. It could be any combination. There is one decision which says that exemption under section 54 and 54F in a peculiar situation was possible even for one single house property. Somebody had sold one house property, had a capital gain. He had sold some shares, he had capital gain. Sale from residential house was eligible for 54 exemption. Sale from shares was eligible for 54F. He invested in one single property and he was granted the exemption.
Sir, what about interest? Interest are included on that for easy part. It is taxable, sir.
It is taxable, but there will not be any TDS. It is taxable. I think they give around 5 or 5.25% annual interest, but it's fully taxable.
Cases are there where more than one unit, for example, if I take 2-3 apartments, that is considered as single property.
Only if it can be, it has been converted into single house. Say some people go for 2 units in 2 floors, and if they are connected and they are treated as single house, then it will still be treated as one residential house. But if you take 2 houses which are away and they are not adjacent to each other, maybe vertically or parallelly, if they are not adjacent and if they are not converted into single unit, they will be treated as 2 different houses.
But in one side, if I construct 4 floors, then it could be treated as single property.
Possible. If you treat that as a single unit and you continue to enjoy it, it is possible.
This 50 lakh cap is a single assessment, particular investment in a 1 year, or I can get 50 lakhs over the period. Suppose I invested 50 lakhs today, and in the next assessment year I can get invest 50 lakhs, or it is one time cap.
First, it is the investment is restricted to 50 lakh in that financial year and the following financial year. Earlier, they had made it as 50 lakh per financial year. So, people would prefer to sell the property after October, so that in that financial year, they would invest 50 lakh. As soon as the new financial year starts in April, they would invest one more 50 lakh. Government wanted to restrict that, so they told, now for that financial year, in the year in which you invest, 50 lakh is the limit. Next financial year also, you cannot invest. So for 2 financial years, the limit has been put at 50 lakh.
So after 2 financial years, I can still invest 50 lakhs in the same exemption. In case of another asset.
Even if it's for another asset, you cannot invest. Even if you sell 2 assets, that 2-year window will still be applicable.
No, the question is 3rd year.
3rd year. Third year will be different block. 3rd year will be different. You can go ahead.
So what is the restriction for end user? Once in lifetime something.
Sir?
End user, the assessee. What is the restriction? Upper limit.
For which section?
For in these exemptions, some 2 crore limit is there.
Under section 54, there is a lifetime limit of, I have that, I'll come to that.
Sir, if a house property is jointly owned by husband and wife, and they are selling it, can we invest 1 crore in property before AC?
Yes, it's allowed. It's allowed.
Sir, a house property is being sold. Can we invest both in 154F and
Possible. 54F is not possible. 54 and 54 EC, yes, it's possible.
So
So there is no restriction on number of properties to buy. So 54 is 50 lakh limit is there. So if I am selling, let's say 3 flats, so together I can invest. So as long as I am getting the entire acquisition, 50 lakhs I can invest. The
Yeah.
number of property there is no restriction.
No restriction. No restriction. I have some more slides on this section 54, 54F, etc. I take you through that, where I will clarify on 2 crore, etc. The extension for investment into a new asset was extended due to COVID. Whatever was supposed to be invested during March 2020, that's the first COVID lockdown which was done from between that period to September 29, it was extended up to September 30, 2020. And if the time limit expired during April 1, 2021 and February 28, 2021, it has been extended to 31st March 2023, where assessments are going on or where the assessments may be reopened. This one, these are the dates you need to remember. There is one more section which has been introduced 2 years ago, section 54EE. They have told that they will notify certain assets where you can make the investment of 50 lakh, but they have not notified. A few months ago, somebody went to the High Court to claim that 54E has been brought in, but the government has not notified. High Court has held that it cannot insist the government to notify. If the government, in the interest of the finance, interest of the economy, if they want to notify, they can notify, or they need not notify. We should appreciate the tax payer who has gone to that extent.
After court, they will notify.
Yeah, I'll quickly take you through this. I know that you have a separate session for discussing the case laws, but to have some completeness for what I have discussed so far, I am running through this. New assets should be situated in India. I am discussing about section 54. Some of these are equally applicable for 54F also. Acquisition of 2 side-by-side flats combined by the builder to be used as a single residential house, exemption is available. This is a Karnataka High Court judgment, Anand Basappa. Construction may commence before transfer. Construction by a third party can still be treated as construction. Construction by cooperative societies, case of allotment of flat under self-financing scheme of DDA is treated as construction of house for this purpose. Legal title of the house is not necessary. They have gone to a different tangent. Holding of legal title is not necessary for the property if the taxpayer pays full consideration or substantial portion of it within the period given above. The exemption under section 54 is available. I think you had a question. This rule is applicable even if the possession is handed over after the stipulated period or the sale deed is registered later on. Even if the payment has been made within 3-year period, getting the legal title may be pending, but still exemption is available. Time limit in case of compulsory acquisition shall be determined from the date of receipt of compensation, in case we have discussed that. Live link between capital gain and investment is not necessary. This is one of the contentious issues. In many of the cases, the taxpayers try to claim that the investment in the new house property what you have not made is not from the proceeds what you got. It's from loan what you got, or it's you have done it before you received the proceeds. But many high courts have held that live link between the amount what has been received versus the amount what has been invested is not necessary. Otherwise, why they would have given the exemption when the investment has been made 1 year before the date of transfer? There is some logic, right? Development agreement. Acquisition of a new flat under a development agreement in exchange of an old flat amounts to construction. See the way they have interpreted. Land was long-term capital asset, but superstructure there was constructed within 3 years. When land was already there and house was constructed, they both have to be treated as separate is one view. And in some cases, the tribunals have taken a view, if land is more than 3 years old, even if the house is constructed later, if they are sold together, they can still be treated as long-term, which appears to be slightly an extreme view. But generally we take a view, if land is long-term and the building is short-term, we find out the value and identify them separately and tax them separately. The court held that assessee is entitled to claim benefit of exemption in section 54 in respect of capital gain arising on transfer of land as well as building. When name of assessee's wife is included for cosmetic purposes, benefit of section 54 should be allowed on entire amount invested in new property. Exemption under section 54 and 54F are independent provisions, and the assessee can claim exemption under both sections for investment in the same house. Residential house means a habitable house. If an assessee chooses to purchase a house and incurs bona fide expenditure on improvement for making it habitable, it would be eligible as investment in new asset for the purpose of section 54. Construction not completed by the builder for delay beyond the control of the assessee, exemption is still permissible. Karnataka High Court judgment. Investment in residential house would not only include cost of purchase of house, but also cost incurred for making, I think we discussed this. There is no requirement for claiming exemption under section 54 that the assessee should file his return of income before due date prescribed under section 139(1). Some income tax officer went to the extent of denying the exemption for belated tax returns. But under section 139(1), a person who wants to claim the exemption has to file the tax return now. That condition has been put, and there is a requirement under section 139(1). Earlier, many people would take the claim, say if the reassessment proceedings are started under section 147, they could take a claim, I had sold the property, but meanwhile I had purchased a new property, so I am eligible for the exemption. And as per the earlier law, that was accepted. But now, I doubt whether that would be accepted, because under 139(1), to declare that exemption, he has to file the return.
Should we find within the due date or
It should be possible even beyond the due date. They have not specified that it has to be within the due date. They have told that it has to be filed.
So for claiming exemption.
Yes. See what it reads. I tell you, the following assessees have to file, have to mandatorily file the income tax return. If the gross total income before considering the exemption under section 54, 54F, etc. exceeds 2.5 lakh, they have to file the tax return. That's how it reads. It does not say that exemption will be denied, but the officers can view that tax return filing was mandatory and it has not been filed. To that extent, some litigation can take place.
But it is under 139(1), no sir? You are
139(1).
139(1) talks only within the due date, no? If it is beyond the due date, then it will go under 139(5), no?
139(5), but it does not say that exemption
does not restrict.
Okay. Yes, it does not restrict. But it calls for filing of the return.
So if you go to a year authority like High Court or Supreme Court, normally they will be allowing that.
Generally they will allow. These are very liberal, because there are many instances where people have not deposited the money into capital gains account scheme, but they have utilized it happily even after 2-3 years for construction, and exemptions have been given. It's only a technical breach. It's not the breach of the substance of law. If it is transfer by a compulsory acquisition, one may claim exemption under section 1037. Here 54B we are discussing now. If the assessee is unable to cultivate an agricultural land due to vagaries of nature and non-availability of resources, exemption under section 54B cannot be denied. Again, liberal interpretation almost everywhere. If the new agricultural land is situated in a rural area, gain arising on its transfer is not chargeable to tax. It shall not be a capital asset. We discussed this. 54EC. Investments made during the financial year in which the original asset or assets are transferred and in the subsequent financial year should not exceed 50 lakhs. So it refers to year of transfer of the original asset and the subsequent financial year. Is it possible to claim exemption on section 54 EC in respect of depreciable asset?
Which building?
Yeah, again there are favorable decisions. Depreciable asset.
So, the business is short-term capital.
But the courts say that it may be treated as capital, short-term capital gain for the purpose of taxation. If the asset itself is long-term, it doesn't lose its character. Those are the decisions which have been given here. Even there are High Court decisions, Bombay High Court, Guwahati High Court, Tempo, Supreme Court decision also there. Here there are some more interesting decisions. Pune Bench of Tribunal in case of so and so held that where assessee received sale consideration of a property in installments and he invested amount in specified bonds within a period of 6 months from the date of receipts of each of those installments, he was entitled to deduction. If the assessee wants to invest in bonds of REC which are not available throughout the period of 6 months, time limit of 6 months should be extended. If income of minor child or spouse is clubbed in the hands of an individual, minor child and spouse can separately invest up to 50 lakh rupees. But all these are litigative. For the purpose of planning, don't advise all this. Only if you have such cases, consult somebody and get into litigation. That's what I would advise. Because most of these individuals would not like if it gets into litigation. They would be happy to pay the taxes, comply with the law and get out of it. But where you have a case, maybe because of ignorance or wrong advice given by somebody, these case laws may be of reference. Where assessee purchased specified bonds prior to date of sale of property, exemption under section 54 AC is not available. In one case they have held. Investment made of advance money is qualified for exemption even if investment is made before the date of transfer of long-term capital asset. Each case goes by the facts. Construction may commence before transfer of capital asset. This is section 54F. I am referring to construction. It may commence before transfer of capital asset. Mere non-residential use, somebody had a question, would not render a property ineligible for benefit under section 54F if it otherwise is a residential house. Temporary usage is not going to change the character. Additional expenditure incurred by an assessee on interiors, renovation and furnishing of new residential property is still eligible for exemption under section 54F. Residential house constructed on agricultural or commercial land, cost of such house is exemptions. Investment made within the time limit but construction not completed, exemption under section 54F cannot be denied. Cost of new house includes cost of land. I think I need to do a little more research on the queries what you raised. Somehow I still have a belief to some extent it may be possible. Let me think.
It only talks about construction also. It doesn't talk about whether land is old or new. It never says.
Never says, but somewhere as you mentioned it says new asset, new investment is something.
It talks about new construction. Construction only. There is no usage of the word land.
Our question is, what if somebody has purchased the land 2 years ago and house is constructed on that within the given 3-year period? Why that cost of that land which is 2 years old should not be claimed? I haven't seen any such decisions, but somehow I feel might be possible. Yes. This circular we may have to study in detail.
In case of an assessee who is in the business of buying and selling houses, he makes a sale of a house which he held as a capital asset. Would he still be eligible to claim the exemption of 54F, or does it differentiate between business assets or capital assets, not owning more than one residential house?
54F will come into play only for capital assets.
I sold a capital asset, but I am holding more than one house property, even though they are my business assets. Would I still be eligible?
Stock in trade.
Stock in trade.
I sold
You
a capital
mean to say
asset,
that-
but I am holding
It's a good question. I don't think I have an answer, but might be allowed because that may be treated as property for the purpose of sale, which comes under stock in trade, and not as something which is being or intended to be retained for him for the purpose of his use. I feel it might be allowed. That distinction should be possible. Assume somebody has 10 house properties, but what is the intention? They are stock in trade. If he is showing that as stock in trade in his books of account, and it is not going to be a residential house property for his use, then I feel exemption should be allowed.
We told held, no sir, held residential property, whether it is for business purpose or my cap asset, doesn't differentiate.
That's right. But liberal interpretation is something what we need to look. If somebody has declared it in the balance sheet as a stock in trade, even if I have to go by the literal interpretation, I may have to accept. But if I go by the liberal interpretation, when intention is to sell off all that as a stock in trade, might be possible.
Maybe that.
Don't find the return.
Is there anything exemption is not allowed?
No, I mean you said that, right? Under 9 months
They have put that they have to file the return. They are not saying exemption will be denied.
Yeah, so if I have done that procedure but not filed return for whatever reason, I agree there may be a penalty for not filing return under a good computer, but the exemption should be
Allowed is what I feel.
okay. So if you file 148 returns, meaning 147 is response to that,
Yeah.
claim it there,
Yeah.
it should be allowed as long as you input.
Yes. (54G). This is hardly used and hardly discussed. I'll just run through. Where plant and machinery, land or building, or any right in land or building used for purpose of industrial undertaking situated in urban area is transferred, this exemption is applicable. 54GB is something which is also applicable only for transfers happened up to March 31st, 2022, and this is anyway. There could be impact because of this section, but presently this is not effective. This is with regard to transfer of residential house and investment in a new company, and new company should be into innovative activities, production, manufacturing, or innovative research, etc. Then the exemption is allowable, and if the shares are transferred within 5 years or assets are transferred by the company within 8 years, exemption will be withdrawn. I haven't seen anybody selling residential house and starting a new company with the investment for the purpose of claiming the exemption. But where somebody has done that, you can explore the option, but that was good until financial year 21-22. Yeah, if you have any more questions, I would be happy to address. I don't know whether I was able to address the questions or create more confusion. I would be happy if there is more confusion and more questions so that you can think about it more and read little more on that.
The sale of shares, 54F is eligible, where we take the partial deduction. So we have a good amount of capital gains that we pay now, and that balance only the 54F we use in the capital scheme.
Yes.
Sir, the land is purchased somewhere around 19,080 or 70 before 2001. Now, for the purpose of cost of acquisition, when I am selling now, if I am selling now, cost of acquisition should be taken as on 1st April 2001.
Yes.
Now, for that, for the land I have to take the stamp value and also registered value. I have to get a valuation from the registered value or not acquired?
Two things you need to do. When you have any immovable property acquired before 1/4/2001, the first thing is you need to have the valuation done. The valuation has to be necessarily done by a registered valuer.
As on 1st
April 2001. Secondly, you need to ensure that the value as per the valuer is not more than the stamp duty value. If the valuer has given a valuation certificate below the stamp duty value, that value will hold good.
Whichever is lower.
Yeah, and if you face an assessment without the valuer's valuation report, it is not, assessment cannot be completed, because assessing officer will not be sure that the valuation is equal to or higher than the stamp duty value. Only then stamp duty value will be factored. If valuation itself is below stamp duty value, then the valuer's report has to be considered.
On that land, no sir, there is a building which are not using, just walls are there.
Yeah.
So that either seller or buyer, they cannot use it.
Yeah.
So we will not take into consideration that value, right? That building value.
Building value should also be considered for the purpose of fair market value. If there is a building, the value has to be.
So whether buyer demolishes or not doesn't matter. If there is a building, I have to take into consideration.
You have to take into consideration.
Whether it is usable or not usable.
No, you have to factor it. Yes.
Sir, sub-registrar office will do one chart where stating that this is the value of land on that date and the value of building on that date.
2001 April.
That is not enough. Valuation is compulsory.
Valuation is compulsory to convince the assessing officer that the valuation is equal to or higher than this SDV, stamp duty value. See, what they say is you have to do the fair market, you have to show the fair market value. And if fair market value is higher than the stamp duty value, they are going to consider stamp duty value. So how will you prove that your valuation is higher than stamp duty value? Only when you have the valuation certificate. Otherwise, the comparison is not possible. Of course, practically you may have to go with the stamp duty value only, because valuers usually give a higher value. But you have to prove that. Have we done? Yeah.
Case of section 54F, I have sold any other asset and I am investing into a residential house property by way of construction. So before my due date of filing, how much amount should have been invested? The entire sale consideration, or because I will be investing part by part every year for the next 3 years. How will I claim exemption in that scenario?
You will claim the exemption in the year in which you have sold the house property. Entire exemption you have to claim, and you have to deposit the capital into the capital gain account scheme. Whatever balance you are supposed to utilize. If you have used some part before the due date for filing of the return, that amount anyway will be counted for exemption. Whatever surplus left with you has to be deposited there. Yeah, CGS. Yes. All right. Thank you for. Yeah, please. Please.
In case of sale of flat, there is a view there. You are selling flat, apartment, and undivided share in land.
Yeah.
Separate. But should we take a view that saying it's sold together and 54 should be applicable in both and then in another property? Or should we compute separately for undivided share and flat separately?
Generally, that breakup won't be applicable in the case of apartments. Usually, the entire cost will be defined in the purchase deed itself. In the sale deed also, we go with that. And 54 is very much acceptable.
Sir, because one logic also, sir, 54, no, if I take, I cannot sell residential property without land, no. Normal land, standalone building is there, sir.
Correct.
So I can.
But the issue will arise when one is long term, one is short term. That happens only in the case of person who has purchased at, under two different purchase deeds. That happens only then. In case of apartments, everything will be in one single deed. And of course, in Bombay, there is a practice, or rather in Maharashtra, where the sale of the apartment is done under two agreements. One is sale of land, and it happens usually immediately while they are entering into the construction agreement. And construction agreement where they say that construction will be done in next 4 years, 5 years. So there will be two deeds. Of course, in Bangalore also, Purvankara and some other companies followed that for a while. That system is prevalent more in Maharashtra, less here.
Even here, the sale deed will be for land also. for a flat, it will be a construction.
Not necessarily, not everywhere. Only some of the builders are following. Most of the builders go with only one single sale deed, that too at the time of registration after completion. Not otherwise, not before.
For villas, mostly it is like one.
Yeah, villas usually independent houses. The piece of land will be separate and the construction will be separate.
Even though it is sold as villa, it is under construction.
Yeah. Thank you so much. I thank the office bearers of Bangalore branch as well and the staff for support. Look forward to interact more. Thank you.
Thank you, sir. Prakash Shekte sir has been kind enough whenever we invite him. He has agreed, consented and come here and shared his knowledge with all of us. So on behalf of Bangalore branch, we thank you and request our chairman to hand over token of appreciation to him. Thank you so much, sir. So we'll have lunch break now and assemble at 2:30 back here. No voice. Good afternoon.
Good afternoon.
Good. You're all awake. Confirming ones. Okay, welcome back to the last session of the third module, which is about tax planning under capital gains and also the case laws under capital gains. We have two speakers, CA Vivek Meherwade and Surya Prakash. I request SICASA chairman Shripad to welcome them with a floral bouquet and also get them to stand us, please. Let's go. Vivek and Surya Prakash, thank you and welcome to both of you. Please be seated. I'll take a minute to introduce you. Vivek has more than a decade of experience in corporate tax and M&A transactions, primarily focused on deal advisory, deal implementation in real estate mainly, acquisitions and exit structuring, inbound and outbound investments, cap table structuring for startups, business modeling and so on. He enjoys outdoor activities and successfully completed multiple high altitude treks. That's something interesting which we'll have to talk after this. And he believes that learning is a continuous process and the experience is the best teacher. So it's a pleasure to introduce Vivek to all of you. Welcome to you, Vivek. And his colleague Surya Prakash is from Eka Consultants Advisors, and welcome to you also, Surya. Thank you. Over to you.
Thank you for the introduction, that was lovely. And good afternoon, everyone. I hope the session that you guys have had so far has been great and you have had great learning so far. And I know over the last 2-3 days, probably you've gone through what capital asset is, what transfer is, and what different forms of capital assets you have, long term, short term. I think the previous session was all about how do you save taxes in terms of when you make gain, how do you deploy that gain, and how do you make benefit out of it. And I think you also guys might have gone over the real estate transactions yesterday with another speaker. So today, and I was a little confused when they said tax planning in capital gain, because there isn't any chapter called tax planning in capital gain per se. So I'm sure most of you here are either working with corporates or you're also into practice. So we might have come across tax planning in one or the other forms. There isn't like a formula to it. But we have 54F benefits which are already stated in the law today. Apart from these, there are also other stated parameters under which you can avail capital gain tax exemptions and benefits. So, for instance, we have 47, Section 47 under the Act, specify like a few transactions which are transfer, otherwise taxable, but it gives you an exemption in terms of not qualifying as a transfer itself to start with. I'm sure you guys have gone over the transfer definition and seen when the tax trigger happens. It's on accrual basis, you'll have to pay taxes immediately upon transfer trigger and all of those, right? But 47 gives you exemptions on various transactions stated there. A few transactions, for instance, let's say we do a merger, we do a demerger, we do, let's say, transfer to a business trust of shares in an SPV. We may convert a partnership firm into a company, which seemingly looks like can't be a transfer, but there's also an exemption given under the Act for it to not be qualified as a transfer subject to some conditions. So, apart from these, let's say we implement a transaction which is inherently under Section 47, which qualifies for the exemption. Let's say we meet those criteria. This is an exemption that we can avail, and that's part of tax planning, capital gain tax planning. But what happens in case your transaction doesn't fit within the 4700? Are there other ways to maybe go about then doing the same transaction in another alternate way, which can also give you the tax benefit? I mean, I don't want to use tax benefit often because, again, we are also discussing about GAR later. So, these are structures through which you can plan your taxes better. That's what I like to put across. I'll pause here for a minute if you guys have like specific points that you wanted to cover in tax planning, or what your perspective is about tax planning. If you guys are fine, then I'll continue with what I have. Take a minute here. Anyone who wants to take a stab at what you think tax planning according to you is in capital gain?
I'm basically looking out for if a private limited company wants to close its business and it wants to get merged with another company, what would the best way
Got it.
can be done?
Anyone else who has some similar thoughts of what you want to take out of this session? Cool. So yeah, I'll cover that point maybe in the due course, but largely what I've tried to do here is I've categorized like 3 separate modes of transfer. So obviously we're talking about capital gain tax planning, so it has to involve a capital asset and a transfer of such capital asset, be it a long-term asset or a short-term asset. Now, if we need to transfer that asset, there could be multiple modes of doing the transfer. One is an outright sale of that asset. If you don't want to do an outright sale, then are there different modes of doing it? Yes, you can do a slump sale if you want to transfer the asset. If not slump sale, then can we do it through a demerger, through a merger? Yes, that's also permitted. So these are different modes of transfer. Now, how do you plan your asset transfer through these different modes? For instance, if we were to talk about, let's say, an immovable property, I want to transfer an immovable property, which is an easier example because you guys have already gone over, different taxabilities of immovable property. So, if I were to simply sell like a building, I'll end up paying stamp duty. I'll end up paying tax on that building sold. It could range between, let's say, 39% to, let's say, 22 to 39%, depending on whether it's a corporate selling it, whether it's an individual selling it. You'll have long-term and short-term gain on sale of a building. I said long-term and short-term simply because if it's a business asset, it could qualify for depreciation for the building component. Land, of course, you don't have depreciation, so you'll end up paying long-term if it's there for 24 months and above. Now, if we were to simply sell this without any, let's say we have other assets and we really can't go to the 54 ambit to claim exemptions, then what happens? We end up paying taxes at, let's say, the highest rate that's applicable would be 39% for an individual. And we'll end up paying 6%, 7% stamp duty if it was in Karnataka. And GST, of course, is not applicable, but this is not tax planning. So what if I were to do this by way of a slump sale? Can I still do it by way of a slump sale? Can I achieve the same outcome? I would think so. So if, let's say, it was a short-term capital asset that I had, it was less than 24 months, but I have various other assets. And this building has tenants, it has identified revenue stream. I also have someone who is managing the asset, for the entire leasing operations or maybe maintenance. So what I would do, I would rather package this together and I would sell it as a slump sale. What happens in that case is you will treat this asset as a long-term asset. Because you are in the business of leasing, you are in the business of construction. So undertaking can be either the entire business or could be part of the business. So if my building qualifies as an undertaking, so the various parameters that you will look at whether undertaking test gets satisfied or not, but there isn't a definition per se for an undertaking. Yes, it's defined under the Act, I'm not saying there's no definition. But it simply says undertaking could be the entire undertaking or part of the undertaking, right? Now, it has to be a going concern. Does it qualify a going concern? Yes. Why? Because I have assets and liabilities stacked to that building. I also have identified a revenue stream that's coming from that building. I have tenants for that building. I have someone who's managing as well. So if I package it together, it qualifies for a business undertaking. And because I already have other assets, I have a legacy of running that business, and therefore this qualifies for a long-term capital asset when a building is sold. And therefore I'm in a better off position, because if I were to sell this as short-term, it's a higher tax. I package it as an undertaking, so it's a lower tax value. So this could be one of the modes that you can plan your exit or a transfer. Now, can I do it by way of demerger? Yes, you could. But demerger again will qualify for a tax exempt. So slum sale is not a tax exempt transfer. Slum sale will still be taxable for us. The only differentiating factor would be that you can tag liabilities along with it. You could also qualify as a long-term capital asset if you were to package it together. But if, let's say, we were to do a complete tax exempt transfer, don't want to pay taxes at all, because that's what everyone wants. So then we do it through a demerger. Right? So what happens in demerger? We end up issuing shares to the shareholders of who's demerging it. If, assuming this was in a company, company can demerge its asset. What happens in the process of demerger? We need to either go to RD, who's a regional director, to get my demerger approved, or I go to NCLT, which is more of a court process scheme. In that, what happens is I will have to issue shares to the company that is demerging the asset to another company. So the company which is receiving, which is the resulting company, recipient of asset, will end up allotting shares to the shareholders of the transfer. So they need to unwind that leg of transaction. So they'll also involve a secondary sale of shares. But what happens in demerger? You're kind of exempting the entire transaction itself. Demerger, if you're allotting shares under a demerger, and because it's also qualifying as an undertaking, business undertaking, there's an exemption under 47, which will then entitle you to transfer the asset in the most efficient way of not paying taxes or not triggering transfer under Income Tax Act. So I could also merge the company if that was the only asset that the company had. To merge the company, I could again go to either RD, which is the fast track route of clubbing the businesses together, or I could go to a regional director. Now, how will I get money out of it? I obviously am doing this trade, or I'm selling the asset because I can cash out of it. I could rather tag liabilities with it, which are attributable to that building, because I wouldn't want to be in a situation where I sell the asset, I pay taxes, and I use my post-tax money to pay off those liabilities. It doesn't make sense. Then what one would end up doing, they would club attributable liabilities along with the asset, sell it at a nominal value or at the top of value. If I were to sell the asset, let's say the building entirely was valued worth 1000 CR, and I also have liabilities which I can associate with that building, and that cost, that liability is about 800 crore. And if I were to sell the building as is, I would end up making a huge gain because my cost base is low. The fair value is 1000 crore though. But if I'm packaging it together, selling it, I would take equity consideration, which means the transfer value of that building, which is the enterprise value or the total value of the asset, minus the debt. So that liability gets reduced, and I'll only end up selling it for 200. That's another mode of, or another way of looking at doing trades. That's how most corporates will do their transactions, where they wouldn't sell the asset, pay taxes, and then pay off the liabilities. They would rather package it together and sell it at an equity value, which is much lower than the actual value of the asset. So I'll take a pause here again. I hope you guys are all awake. I see you guys nodding, and I also see some of them, maybe just listening, hearing, I don't know what to call it. Yeah, any questions, you guys? Or let me know if I'm too fast or too slow. I can also modulate that.
Oh, in your example, 1000 crores minus 800 liability, so 200 will be my gain.
Correct.
So 800 CR is used for building only. Even in that case also my cost of acquisition is 800.
So again, the example which I gave, let's say that land was historically held by you. You invested money in constructing, but you want to sell the asset for 1000 crore. That 1000 crore is a gain that, let's say you have 400 crores that you've invested entirely, land and building put together, with historic cost and today's cost. But the value of the asset today, the market value is short up, you want to sell it at 1000. And you also have attributable debt because there's something called IDC, right? Interest during construction, not idli dosa. So there is interest during construction period, which you will also capitalize in some cases. Some cases you wouldn't have paid off your liability, so it starts getting evergreen. So you will end up carrying that borrowing cost in your balance sheet. So when you sell this together post building completion, this is actually a typical case that most of them are into today, because most corporates would have interest during construction period which they capitalize, post which if there is a moratorium period for your leasing, if the lease has not commenced, you will end up carrying that interest cost in your balance sheet, right? So this is a typical case where you would want to club together and sell the asset. Another way of doing the same transaction would be to put this in a company. If this was already in a company, I would rather sell the shares of company if that was the only asset that the company had. Because it makes more commercial sense in that case, because you will not pay stamp duty on sale of the asset, because slump sale you still end up paying stamp duty on the guideline value. While the equity consideration is going to be nominal for us when we sell, but there's still stamp duty that you will end up paying on the entire guideline value of the building when you sell it even through slump sale. So I would rather keep it in the company if that was the only asset and sell shares of that company, right? So when you sell shares of the company, you naturally will only sell at the equity value, which is 200, even if that debt was not attributable entirely or exclusively towards construction of that asset. So when you move at equity value, you only pay very nominal stamp duty, 0.015% if I'm not wrong, is the stamp duty on sale of shares. And once you pay that, there is essentially nothing but tax that you will pay if it's long term, then long term or short term. But you're cutting your gains by half then by doing this. As opposed to sell the asset, pay tax, pay off your liabilities, and then you are left with very limited or residual amount. Yeah, so any other questions with respect to these three modes of transfer? Any other things you want to add or want to chime in?
From the buyer perspective, it is not so lucrative to buy shares and assets at the because
Good.
he has to draw money finally just to
Sure.
pay the tax.
No, good question. So from a buyer perspective, I look at what's the end use for that asset. If I'm only buying the asset, again, I'm going to make reference to the same example that we had. If I was buying the asset only for investment, I would rather prefer it to be in a company, because I would not want to keep buying and selling the asset on a standalone basis and end up paying huge stamp duty or taxes on it. So I would much rather prefer to keep it in a company if my objective was to only make an investment. But let's say it was only land. There's nothing that's, there's no return that I'm earning out of it. It's only the capital appreciation that's happening. Then I will see if I need to actually construct something on that. And if I'm constructing something on that piece of land, I would still prefer it to be in a company model, because it's easier for me to get construction finance in a company. It's also easier for me to exit to a structured fund or a REIT. Let's say it qualifies as a REIT asset. We have a concept of business trust. It could be a full-blown business trust, it could be a SME trust. So we also have a concept of small and medium REITs, right? So depending on the asset class it is, I could also sell this company to a REIT, a SM REIT, or to a PE investor who's interested in this asset. It makes more commercial sense to keep it in a company format as opposed to holding in personal capacity, because depending again on what is your intent. So I hope that answers the question. Yeah, you will have to do your diligence when you make an acquisition. So usually when there is more history in the company, and let's say there's a legacy in the company that's already there, when you do your diligence process, let's say you do a finance DD, you do a tax DD, that's when you will technically flag off the issues, and that adds to the valuation again. So you will use as a lever to then negotiate valuation with the seller. If there are inherent issues in the company in terms of, let's say, its past history and legacy. So these are something you can ring fence again, right? So I'm going to be digressing a little from capital gain. Then what you'll have to end up doing is, when you drop the share acquisition agreement, you'll also have to have indemnities that you will agree with them. So you can agree for a tax indemnity, get a 281 certificate, so on and so forth. You'll have like a couple of safety measures that you can implement. Sure. Guys, any other questions on these three? Great. So I'll move on to some case studies. So I mean, these could be simple and some complex ones. I've kept mix of both. I'm sure some of you have already dealt with these situations, but for the benefit of all, let's start with some easier stuff. Let's assume Mr. A and B hold 50% shares in a company. It's a private limited company and both are individuals, and so therefore they fall into the highest tax bracket plus the short-term capital asset. So it could be about 39% tax rate for them if they were to sell these assets. Now let's say they find another buyer. They have Mr. C who wants to acquire, let's say, 10%, 20% of the company. Now, if Mr. A and B sold their shares as a short-term capital asset, they end up paying taxes at either 39% or 42.72% depending on what tax bracket they fall. Super rich guys, therefore the highest tax bracket for them. Now, if I were to sell this to Mr. C, what is the best way I would think of making this sale? Because there is no specific provision under 47 to exempt this transfer, and also at the same time there is no provision under section 54 or the series under 54 and 54F to give me an exemption. So how would someone at best do this trade? Take a guess, you guys can. Sorry? Sure, but the intent here is to cash out. So when you do a primary into a company, you will not be able to take money out of that company. And go take a crack at it, it's okay. Whatever you guys think the answer will go. Private placement and then buyback, that's a good one. So that's what we'll end up doing in this case as well. So the most viable way that a lot of them today implement is you get money into the company itself. Because getting money in the company is tax neutral. There's no tax to pay when you get money unless you are breaching some valuation norms. So I'll keep that aside. So assuming your valuations stack up, it's not at a super premium, you can get money into the company and you can implement a scheme of buyback. So under Companies Act, you can buy back shares of up to 25%. 10% you can anyway do with board approval, so you will end up doing a buyback, assuming the company has enough reserves and it's positive. So there are certain criteria you will have to satisfy before you implement the structure. Company needs to be solvent, company needs to have adequate profits to implement buyback, you need to get board approvals, you need to get shareholder approval. And there is also a limit on how much you can buy back. That's a maximum 25% that you can do. Now, a best way and a most tax efficient way to do this is, if A and B were to sell shares, they pay 39% tax and that's gone to the government. If company does a buyback, you will not look at whether it was long term or short term. You will look at the shares. If those shares were originally invested through a primary issuance, then you get the cost benefit of those investments made initially. So if, a simple example, if A had subscribed those shares for, let's say, 50, and now he wants a 10% buyback, which means his shares, 10 rupees of his shares will be available as a deduction for the company when they do a buyback. So the profit that gets distributed by the company to the shareholders on buyback will get taxed at 20%. So it's 20% vis-a-vis 30%. 20% surcharge says you'll still end up paying 23% tax, vis-a-vis 39% tax in case of direct sale. So this is something that gets implemented more often than not in case of startups and smaller companies, where the shares are held for short term. Now we could also look to do the same structure if there was a bonus issue, right? I want to salvage the cost base. But at the same time, I also want to save taxes. So what I would end up doing is, company can do a bonus issue. Let's say they do a 1:1 bonus or they do a higher bonus ratio. So the number of shares will go up. What will happen is that the shares which were originally held will consolidate the cost base. The percentage shareholding gets spread across the original shares and the bonus shares. There's a consolidation of cost base that happens. When buyback is implemented, there's a benefit of higher cost base that the company can enjoy in the buyback process, which means there's more distribution happening to the shareholder. There's lesser tax that gets paid because you're cancelling higher number of shares which have higher cost base. So that's another variant of if you were to do a buyback. I'll pause here if you guys have questions on this case study, or we can maybe go to the next one. So we go to the next one. Yeah, so the second case study is more of again divestment. If let's say Holdco, there's a Holdco which has two subsidiaries. One is a highly profitable one, and the other is not so profitable. And there is substantial investment that's gone into Holdco, Subco 1 and Subco 2. So that's typically what ends up happening in most startups or in companies which is thriving on market penetration, right? There is enough value that gets created for the brand, but the company essentially is not showing profits in the books. But there is enough, recognition, brand recognition, market penetration that ends up happening. So there is, Subco 1, which is actually a meaningful asset for Holdco. But it's not throwing up profits today. It's gotten enough investments that's made. Subco 2 is actually profit making, and Holdco wants to monetize Subco 2. They want to sell Subco 2 shares. If they were to do that, there is a huge gain that will arise to Holdco, and Holdco will end up paying tax. A simple way or simple fix would be to simply sell company A, which is Subco 1, at a loss, and use that loss to offset against the gain that you will make from sale of Subco 2. But if you were to sell Subco 1 as well, then you will lose the benefit of losses, right? 79 gets triggered. If a company or if the shareholders drop their holding below 50%, then the benefit of losses are not available. So one of the ways you can probably structure this is by doing a cap reduction. If you file a scheme of capital reduction, and if you kind of cancel majority holding that Holdco has in Subco 1, and there's no distribution, or if there's a very nominal distribution that happens to Holdco, then the entire cancellation of shares essentially can come to you as capital loss. Now those capital losses can be used to offset against the gain that Holdco will make from sale of another asset. Now this is a case where you have actually booked losses from Subco 1, and at the same time you also enjoy the benefit of carrying forward and utilizing losses of Subco 1. So this is slightly, I would say, time-consuming process. While it's not complicated, but you still have to go to the NCLT, get an approval from NCLT when you float a scheme of cap reduction. Cap reduction under Companies Act, if you were to cancel shares, will have to happen through a scheme. Section 66 provides for cap reduction. You will have to approach the NCLT, make an application to the NCLT, get shareholders' consent, get creditors' consent, and then implement the scheme of cap reduction. It's a doable process, not difficult. You can do it about 6 months' time. Depends on which bench, which jurisdictions, and where have you find the application for cap reduction. So this is another way where you can transfer the asset, make benefit of losses that you have in the other entity. Any questions on this so far? Sorry? Yeah, I have implemented a few on this, so it's doable. But let me maybe cover another 1 or 2 aspects here that you will have to consider. While it's seemingly very simple structure, under tax, what happens when you do a cap reduction? There are 2 ways of doing a cap reduction, right? One is you either cancel the entire shares that someone holds, or you cancel 100% of that share, or you pro rata cancel let's say you reduce the face value of that share. If it was 10 rupee per share, you would reduce it to, let's say, 3 rupees or 2 rupees per share while doing a pro rata cap reduction. Now the benefit of loss, fortunately, is justifiable only when you're cancelling 100% of the share. If someone held 1000 shares, I cancel 900 shares, that's still okay. They hold 100 shares, which will still make them 100% holder. Now, when we do this, while it's beneficial for you to claim losses when you do this 100% cancellation of shares, there's also buyback provisions under Income Tax Act, 115 QA, which gets triggered, or someone can allege that the section gets triggered. When I say someone, we know who that is. The tax guys can always come back to you and say, what you've cancelled now is actually not a capital reduction. It's a scheme of buyback. Now, what's the difference? What happens if it's a buyback? How does it even matter? Is there a difference between the two? Am I better or worse off one way or the other?
Buyback, there is a outflow of money.
Yeah.
Capital reduction, there is a need right off.
Partially right, and also I can add to that. So in a scheme of buyback or in a capital reduction, it's not always necessary that there has to be consideration that's payable. And at the same time, capital reduction doesn't mean that we simply cancel the shares. It also may entail distribution of profits or distribution of cash flows. So you can undertake a scheme of buyback, and for having cancelled those many number of shares, the company can also give a consideration to the shareholders. So both are possible, both are doable. But the fundamental difference under the Act, under Income Tax Act, between capital reduction and a buyback is when it's a buyback, company ends up paying taxes, which we just discussed some time back, right? So company ends up paying tax at 20% plus surcharges, 23% essentially, if there's a distribution and if there's a profit distribution to the shareholders. Assuming I don't distribute anything, which is what we are planning to do in this case study, is there any difference? Will it make any difference?
Will be a capital loss in the hands of the shareholders.
Yes, there will be a capital loss, but the difference is, in a scheme of buyback, if there's a distribution happening from the company to the shareholders, the receipt is exempt from tax in the hands of the shareholders because the company's already paid taxes, right? In case of a capital reduction, there are two things which will end up happening. One is, to the extent of accumulated profits in the company, the company will withhold tax and will be deemed to be dividend distributed by the company to its shareholders. So if there is accumulated profit in the company, there is distribution of cash flows on cancellation of shares, which is capital reduction. There is deemed dividend that gets triggered if the company has accumulated profits, and any receipt that's over and above accumulated profits that are there in the company, it becomes gain or taxable gain for the shareholders, assuming that the receipt is more than the cost base that they have. So the fundamental difference therefore is, if it was a buyback, if there's a loss, then the loss also is not available to the shareholder, because if it was a gain, the gain would have been exempt in their hands. Similarly, if there's a loss arising from the transaction, it can't be available to the shareholders for offsetting it against the gain. And that's a fundamental difference. If profit is not taxable, loss also will not be eligible to be carried forward or utilized, right? And therefore, it's important for us to then justify in a scheme of capital reduction that it is a capital reduction scheme under the Companies Act and not buyback under 68 of Companies Act. So today income tax doesn't talk about a particular section to undertake buyback. It just says any buyback. The reason why they do this is because earlier it did refer to 77A of the erstwhile Companies Act, but they took it down and they made a very generic statement saying any buyback implemented under any law will be subject to 115QA. The rationale to introduce this was because a lot of them would implement a scheme of buyback through a court process. So someone could file a 232-233 scheme and say it's a scheme of buyback. So today Companies Act also kind of prohibits you to do buyback other than by way of section 68, but the erstwhile Companies Act did not have that provision. So it was a code in itself. Section 390 was more of a code, and everyone would end up doing buyback under the court process scheme. And therefore, to curb this practice, what they did, they introduced, or rather they took down the reference to the Companies Act buyback and they said any buyback. So in a capital reduction, someone can also allege that this is a scheme of buyback, just to deny you the benefit of losses. So this is one point that needs to be borne in mind when the structure like this is implemented. And another nuance here, or another point which we can kind of discuss is, we also spoke about capital reduction being a court process, right? A court approved scheme. What if I were to do this in a real quick time? I don't want to wait next 6 months to get the court approval or go through the entire court process. I need to get this done ASAP. That's how clients like it. So what we do then, we take a call on trigger of section 79. So section 79 is the genesis or the premise on which we are doing a capital reduction without transferring the loss-making entity and booking losses. Because then I lose the benefit of carry forward of loss. Now, under 79, what happens is, what's prohibited? What you're prohibited to do as a shareholder is, or as a company is, you can't carry forward and offset those losses if the shareholding has changed. It's a dual condition in my view again. It is carry forward and setting off of losses which are denied. It's not the mere carry forward of losses which are denied if you're triggering 79. So therefore, I would rather prefer to sell shares of Subco 1 to a group company at, let's say, a nominal value, book losses, do my trade, offset the loss in Holdco against the gain that Holdco is making, and subsequently reacquire those shares from my group company. So again, so that's one view someone can take, again subject to doing your own diligence, where you can still benefit from the losses without having to go down the path of capital reduction. So again, I'll pause here if you guys have any questions. Guys, I hope it's interesting. It's something that I do for bread and butter, so I'm sharing my perspective. You guys let me know if you want me to speak a little more about other provisions, other sections, other acts, or stick to income tax and go slow. All good so far? Yeah, we move on? Yeah. Classic example of, doing all these transactions, right? Let's say everyone wants to have a startup, everyone wants to have their own business. And I have my own startup now, I'm doing great, but I want to get a strategic partner. I want to get someone to partner with me, give him 3% stake in the company. Let's go through the example here. So, I hold 100% of, India company. And, I want to sell 50% to another strategic partner, a JV partner, who's very meaningful for me because if I partner with that shareholder, then my business grows twofold, threefold. And, the cost base of my shares is essentially 100 crore. I've invested 100 crore in the company. I wish I had that much money. So, consideration that I'm proposing to get out of selling 50% of my shareholding in India is 120 crore. But I hold these shares as, let's say, long-term, short-term doesn't matter. For we'll just go through this. Let's say if it was long-term, I pay 24% taxes. If it was short-term, I pay 39% taxes. Now, how will I ensure that I do this transfer in a best possible way? I know we spoke of something similar in case study 1. We can't do a buyback in this case because I'm buying 50%, not selling 50% stake. So, the best way to maybe implement this, if a client approached me and gave me this problem statement, I would say, let's look at doing a bonus issue, right? I'll do a 1:1 bonus because company is of course profitable and therefore I'm selling my share at substantial high value. So shares which cost about 50 crores, I'm selling at 120 crores. So 70 crores become my gain, I'll end up paying taxes on it. So what if I do bonus issue before I transfer my shares to the new investor? I do a 1:1 bonus. In 1:1 bonus, if I held 1,000 shares, I'll get another 1,000 shares, so I'll have 2,000 shares, which will still represent 100% of my holding in the company. What's the benefit of doing this? Bonus is not taxable. I can do a bonus because as a shareholder, I'm having equity shares. When I give bonus to equity shareholders, there's no team dividend, there's no tax payable. And therefore the cost base of the bonus shares becomes zero. So while you have zero cost base to the bonus shares, you don't pay taxes when you get bonus shares. When I do this 1:1 bonus, I'm consolidating the cost base of my 100% shareholding into 50%. So 100 crore which I invested earlier, and I would have gotten 50 crores cost base benefit if I sold 50% shares. After bonus, what's happening is 50% of my original shares are actually having 100 crore cost base. The balance 50% have zero cost base. So I sell my original shares to the new incoming investor. I get 120 crores from him. I only end up paying taxes on 20 crores. Whereas I've recouped my capital, I've also made gains, but that gain from 70 crores is cut short to 20 crores. I might either pay long term or short term depending on the holding period, but essentially this scheme gives you an advantage of consolidating the cost base, selling it at the same commercial value and pay lesser tax. The downside I would say is the shares that you're left with 50% will have no cost base going forward. So what you're doing is time value of money. You've gotten more money today, and you deploy that money, you make more money out of it. But when you eventually exit 100%, you'll end up paying taxes when you make a gain out of those bonus shares. Interesting, any questions here?
So it is like the original shares selling means it is like a FIFO method.
Correct, FIFO. Yeah, let's talk through that also, right? So today, Companies Act requires every shares in a private company also to be in a demat form. We have time till September 25, so 24. So we can devise a structure. So earlier people would keep it in physical form. They would choose what shares to sell, what lot shares they want to sell. In our case, given that's FIFO, I'm still okay. But assuming I want to cherry pick what shares I want to sell, what lot of shares I want to sell, I can also do multiple demat accounts. That doesn't, that's not prohibited. So as a shareholder, I can have another demat. I can transfer my initial shares, or I can sell 50%, which will be on a FIFO basis. So I have 50% shares held in one demat, 50% some other demat. I can do that with another demat if I need. I can have 3 demats. So then I can choose what shares I want to sell from which demat. The ones with high cost base, the ones with low cost base. That choice will be available if you kind of split this between different demats. Because now the benefit of having physical certificates are not there, you could probably adopt this as a method to choose what you want to sell. No questions? Again, I have a few examples on share transfers and capital gain structuring, but these can also be implemented for asset sales, any other asset sale. Mr. A and Mr. B are the shareholders in IndiaCo. Now, they found Mr. C, and Mr. C is, let's say, a scientist, a genius, very, very, known person in the community. If I get him as a shareholder, then it's a statement. Probably I can land better deals with my customers. I can, maybe get a higher valuation on my exit. That's how a lot of these startups operate, right? They want to have like a key personality on their cap table to just demonstrate that someone like this is also interested in my business. So, because these are real scenarios, every company today wants to kind of part with 5%, 10% to maybe key employees or a key investor, and they don't want to collect any money against transfer of these nominal stake. Then how do you at best do? Because if the company is profitable and has substantial assets, you have Rule 11 UA kicking in, you have Section 50 CA, you have 56(2)(10) that applies. So, it can't be simply palmed off or transferred to another shareholder for no consideration. It has to be at minimum guideline value, that will have to come to under 11 UA. And the recipient also gets taxed if he is paying inadequate consideration. So how do we ensure that we have transferred, let's say 5% each between Mr. A and Mr. B to the new incoming shareholder?
You give appreciation rights and a separate institute.
Sure, but then that person will have to be your employee.
I can give share appreciation right to even consultants.
So advisory stake is separate, but what happens there is you get taxed on the entire amount that you receive. Right? So the point is to ensure there is no tax through and through on sale, because I don't want to trigger taxes for the recipient, because I need that person to be on my cap table. So I can't expect him to pay taxes because I've given him shares.
No tax or no higher tax?
No tax at all.
No tax at all?
Yeah, no tax.
Do a bonus issue.
Isn't it better?
Give those shares.
Sorry?
Do a bonus issue to the extent and give those shares.
I can gift, but they're not relatives. So if I gift, it becomes taxable.
Less than 50,000.
No. So the values are quite high, right? They're significant. So if the value of, let's say, it's a really high value asset, because 50K is very nominal. To be very honest, to get an exemption of 6 to 10, it's a very nominal amount for you to claim that kind of exemption. So I can do a bonus issue, and I can transfer those shares at, let's say, I'll have the previous example which we spoke of, right? But that works if commercially you need to get consideration from the recipient. In this case, there's no consideration that you will get from Mr. C. It's for free, right? It's free, and there's no tax on it. You don't want to pay tax because A, you're doing charity, you're giving someone stake, and then you end up paying taxes for doing charity. And the recipient also ends up paying tax because he's a genius and that's his fault, or being a genius and someone wanting to get him on a capital. So then this is, I mean, this structure could be a bit questionable, but these are fairly prevalent and also can be implemented well. Mr. C can actually, Mr. A, B and C all together can form a partnership firm. Mr. A and Mr. B can actually contribute, let's say 5% each into this partnership firm as their capital contribution. And that capital contribution can be at, let's say, their nominal value or their investment value. So when you do the contribution, there's already a deeming provision that is in place, right? 45(3) is a deeming provision, which deems what the full value of consideration should be for the partner, contributing a capital asset into the firm. So therefore, I will say this deeming provision, being very specific, is prevalent over 50CA, which is a deeming provision in all other cases, which is more of a residuary category of a provision. So it's a specific rule that applies to me under 45(3). I contribute at, let's say, below 11 UA value or below tax guideline value into the firm. I take a rescue under 45(3) because that's a very, very specific provision to deal with determining what the consideration will be for transfer of a capital asset by a partner to the firm. Now, they can hold nominal stake, that's perfectly fine. There's no rule for them to have proportionate stake in the firm. Given that the contribution itself is happening at a nominal value, there's no reason why you need to give them a substantial stake. So Mr. C can continue to be the majority partner in the firm, and at some point of time we could maybe look to retire Mr. A, Mr. B both from the firm, where C can continue with maybe one of his relatives who hold a very nominal stake in the firm. We can also look at converting this into a company later, or he can continue to hold it as a firm itself because it would be beneficial for him to do so. And if it's a long-term capital asset, when he's exiting anyway, it doesn't matter. Tax rate in his hands or in the firm would be almost same. Probably he's still better off doing it in a firm itself because of the surcharge rate being applicable. And this is one way where Mr. A and B will be able to transfer 10% to Mr. C, though not directly in his hands, but through a wire media, which is a partnership firm. Any questions? Yeah. So you had a question? So 45(4) implications are only when the firm distributes an asset to the partner, cash or assets to the partner, right? So if it's continued to be held by the firm itself, then there's no 54, 4 implications. Sorry, 45(4) implications.
On reconstitution, when they exist,
Yeah. So again, on reconstitution of firm, there has to be certain events that trigger 45(4), which means there has to be distribution of cash flows or distribution of assets held by the firm to its partners upon reconstitution. And reconstitution could mean retirement, induction of partner, could be change in partnership ratios, but all of these reconstitution definition can get triggered, but there wouldn't be any corresponding distribution of asset by the firm to the existing or continuing partner. So therefore, 45(4) will not be triggered in this case, even as a reconstitution. Sorry? Yeah, good question again. 56(2)(10) could be potentially the applicable provision here, but in the hands of the firm. Yeah, correct. So, but the argument here is on receipt of shares. Is there an inadequate consideration that the firm is discharging? The answer is no, according to me, in my view. What it's recording and what taxes the contributing shareholders are paying is vis-a-vis their full value of consideration under a specific deeming provision. What the firm is giving to the partner is partnership interest. Can you quantify that partnership interest? Is it representative of mere value that you're recording in the books? The answer is no. So 56(2)(10), you need to first justify or demonstrate that there is actually an inadequate consideration that is discharged by the firm on acquisition of this asset or this share. When the discharge of consideration is by way of partnership interest, is there a mechanism to quantify what that partnership interest is? I am essentially entitled to the economic value that would be derived from that asset held in the firm. So I am the beneficiary of the underlying assets in the firm still. My ratio may change, that ratio could be different, but I'm still the beneficiary. Can you quantify the partnership interest in terms of, or for 56(2)(10)? I would say no. Even if, let's say, if there were shares being allotted, one could always say I'll apply 11 UA, I look at the fair market value of shares for tax purpose, that will be the benchmarking. But here there's no 11 UA corresponding applicable for a partnership interest that is received by the partner or given by the firm to the partners who are contributing.
I understand that you are suggesting that the 50% are held by AMP. So saying the 5% each will be transferred to the firm.
That's right. Will be contributed.
Okay, as capital.
That's right.
As capital.
That's right.
So the asset that is being received by the firm, so saying that even though the 56(2)(10) doesn't talk about 11 UA as the, but then in general the valuation rules.
Yeah.
You're saying that still even though the shares are received as capital, which will also reflect on the asset side of the balance sheet. You're saying you don't have to value them for FME.
No, so you'll value what? Shares that is received by the firm, correct?
Income value, that is
Correct, which is 11 UA value. Because income tax has no other valuation. You will do DCF on issuance of shares. So today when it's receipt of shares, you will apply the book value method under 11 UA. You will do the NAV adjustment. Let's say there is no immovable property, there is no fair value required there. So it's plain vanilla asset minus liability and you got the 11 UA value. Can you allege or can you say that the value at which the asset got recorded is the consideration that's discharged? The answer is no. It is only for the purpose of 45(3) is where the relevance is of the book value of the asset which is recorded by the firm. For 56(2)(10), I am giving, or rather the firm is discharging the consideration by way of partnership interest. Now the asset which is received could be, let's say, you can say it's impaired absolutely immediately after acquisition in other case scenario. Now what the firm is recording in its books of accounts for the purpose of its books and for accounting purpose can't be looked at as the consideration that is discharged by the firm to the transfer of shares. Because the consideration in this case would be by way of giving them partnership interest. Now you need to first quantify the partnership interest and justify or tell that the distribution or the discharge of consideration is inadequate. And then 56(2)(10) becomes applicable. One is receipt of asset and the second event is discharge of consideration. Receipt of asset, I am not receiving for free of cost. I am discharging consideration. So we are on the same page there.
What exactly is the interest in the firm?
Correct. That's the point I was trying to get to. You pay what? You're giving partnership interest. You're giving additional entitlement to the partner in the firm. That is something you need to quantify first. To say that that is inadequate.
If that was relaxed, so 56(2)(10) would become ineffective for all partnership firm, these kind of structure, whether it's share or not.
Yeah, I mean there are a lot of these cases also, right? Supreme Court also in a lot of cases, I think Siddharth Sarabhai also they've held. In case of partnership interest, so when let's say partner contributes his asset, even before 56(2)(10) became applicable to all parties, it was only for individuals and HUF earlier. So if you were to contribute assets to the firm and you get partnership interest out of it or you hold partnership interest from it, there was no valuation methodology for this. One couldn't quantify what the consideration is that the partner is getting in terms of partnership interest on receipt of the partnership interest, and therefore 56(2)(7), 56(2)(10) today, all these were becoming inapplicable. Even if you were to look at capital gain. So the reason why we have 45(3) today as a deeming provision is because the computation mechanism was failing. I would transfer the capital asset and then I would get partnership interest. How are you even bringing this to tax under 45? How are you quantifying what the gain amount should be? And therefore a deeming provision was introduced specifically to say that 45(3) is specific to partner contributing assets to the firm, and hence that will become the fair value of consideration for the partner who's contributing it. So I think if you take principle wise, there's enough principle to support that 56(2)(10) can't apply. But again, I've highlighted here saying that you need to evaluate this further. So, we may all have clients who are, ultra conservative. We may have clients, or we may be doing it for our own, benefit, where we want to be very conservative. And there are clients who would want to take the, judgment call, and also, maybe take a conscious call, get a tax evaluation done, approach a senior counsel. understand if it's a real risk or it's a risk which we perceive that exists. Once we've done this diligence, I think we are in a better place to take a judgment call. Do we want to err on the side of caution, or do we want to really be very aggressive? Or it depends on your commercials, right? So therefore, these provisions will have to be evaluated. You'll have to look at 50CA applicability also. Though it may sound very simple to say specific over general, but it's good to have that evaluation done, understand the real application of these provisions, and then implement the structures depending on the intensity of the transaction. Good. And we can also apply the same principle in case of asset transfer, right? So I've kind of put the same example. So if, let's say, there's a partnership firm that we hold. Mr. A and Mr. B are partners, and they have, they run a partnership firm together. And over a period of time, the partnership firm has done well, the business has done well. They've acquired a few more properties in the firm. And there's one such immovable property, I'm using immovable property because it's easier to explain. So one immovable property is identified, and that needs to be distributed to both partners in the ratio of their holding, 50% each. Now, if it was a direct transfer, if it was an outright sale, we all know that there are multiple deeming provisions when it comes to immovable property, right? One is you will apply 50C, you will look at 56(2)(10). Okay, you will look at what is the fair value that needs to be considered on sale. There's also stamp duty payable. So all these things become applicable on sale of an immovable property by the firm to its partners. And this could also be with a lot of you guys, right? A lot of you also have partnership firms under which you do practice. And if that firm becomes larger, you also want to buy assets in the firm. Maybe for business purpose, you have your own office set up, you acquire the office premise, you want to maybe compartmentalize or also want to distribute those assets to the partners. How would you do it in the best possible way? One of the ways you can adopt is, Mr. A and Mr. B or the partners concerned can start a partnership firm, a separate partnership firm. This partnership firm can contribute asset as its capital contribution into the firm. Again, same theory what we discussed earlier, right? So, on contribution there's 45(3) that triggers. There's a deeming provision. So, you can't apply 50C, which is, the deeming provision for sale of an immovable property. You will apply something which is more specific over a general provision. Likewise, 56(2)(10) we already spoke of, what the interplay is. And, it's just not transfer of shares anymore. It's also if you were to distribute assets from the firm, this could also be a method that can be adopted. Now, let's say this was just a company. It was not a partnership firm. This land is held in a company.
Sorry, I was losing this connection. So, Indian partnership firm, it will contribute that land
to
firm A and firm B.
That's right.
As a 50% and 50%.
That's right.
In alternatively, Mr. A, what he will do to firm as a capital contribution?
Firm A will give partnership interest
to Indian partnership.
That's right.
So, Mr. A, what he will do?
Mr. A will not give
no capital contribution, nothing.
We continue as it is.
Partnership firm become a
Yeah.
partner?
So partnership firm can become a partner in another firm so long as it's a registered firm. If it's an unregistered firm, you can't be a partner. So your partnership firm can become a partner, and the interest will be held by the existing partners on behalf of that firm. That's how all the assets of a firm gets held. Even if you were to transfer an immovable property or acquire an immovable property into a firm, it has to be a registered firm. That immovable property is actually held by the partners in the firm on behalf and as a representative of the firm. So partnership is not a body corporate. Yes, its assets will be held through the partners. That's how all the assets get acquired in a partnership firm. And that's precisely the reason why even under Karnataka Stamp Act, you don't have stamp duty that you pay. When, let's say, a company or an individual contributes land into or an immovable property into the firm, you only pay 1% registration fees, or you register the contribution deed with 1% registration charge. You don't end up paying 6% conveyance stamp duty on contribution into the firm. The reason is because you're not mutating the khata. You continue with the same records. What you're doing rather is you're holding the asset on behalf of the firm. And hence also Stamp Act, under Karnataka Stamp Act, has a particular entry which says if the contributing partner retires from the firm with the asset continuing in the firm, there is a reconstitution of the firm that triggers, which will require 5% stamp duty payable on retirement of the partner from the firm. So the general hack or fix is that you convert that partnership firm into an LLP, where that particular entry, I think it's Article 40 that applies to a partnership firm, 40A is for LLP. So Article 40A of Karnataka Stamp Act will not be applicable, or rather doesn't have a similar entry of 5% conveyance being payable when partner retires from the firm after contributing in a more property. So these are specific points that we'll have to maybe look at.
Now Form A they will form. So they will give a 50%. Now if they want to sell a land, how it will go? I mean further?
They can sell land from the firm.
They can sell the firm from land. Then again capital.
It becomes short term. So the intent here is to get the immovable property between the partners, right, in the hands of individuals. The intent is not to monetize it further. If I were to monetize, I would rather monetize it from the partnership firm, which is India Partnership Firm. And it would still be a long-term capital asset. I would end up paying taxes and then distribute it as a profit to the partners. If the intent was to monetize the land.
So if the intent is not to monetize the whole land, then why they want? I mean,
the intent is to get it in between the partners. So if we put the partners, division, that's right, yeah. So you want to divide it, you want to segregate or distribute the asset to the partners. If I were to distribute the asset directly from partnership firm, it would have been possible earlier, but today there's 45(4) trigger, which we spoke of some time back. When the asset gets distributed, you deem it to be a transfer of asset from the firm to the partners under 9B. That's the first event of tax trigger. And a subsequent event of tax trigger would be under 45(4), where you look at the partner's capital contribution amount. You will look at the fair value of the asset which is getting distributed. You will take that as the consideration that's given. Reduce it with the partner's capital balance in the firm. And that way you will again end up paying taxes. So distribution from the firm to its partners today is not possible because of 9B and 45(4).
So we are when you're transferring it from India PF to firm, the registration which is at 1% will be in the name of the
You'll end up registering the contribution fee. That's right.
Contribution fee and the land will be named after Mr. on the registration.
It will be held by the partners. So if Mr. A is a partner, so I can say that Mr. A, representative of the firm, is holding this on behalf of the firm. That's how most assets get recognized. And the same thing can be even worked out if it was a company, right? So if India PF was is a limited company, and that company wants to distribute assets, now it has to be either by way of an in-specie distribution on capital reduction or direct sale of an asset. All these are taxable transactions. So then what ends up happening is, that company can actually contribute that land into the firm. It can have two partners who are identified or shareholders whom you identified. Partnership A will get 50% of the land parcel as a contribution from the company into the firm. And likewise, the other firm will get some bit of a contribution into the other firm. So while I've said India PF here, this can be done even if it was a company which held the land or immovable property which needs to get distributed between the shareholders. That's also doable. That actually is a more prevalent way of how these structures are evolved.
Can dividend be triggered in that?
Dividend will not be triggered in that case. Now, if land is distributed, so if I'm getting partnership interest in the firm, right, so I'm not distributing it. Again, you'll have to look at how much am I eventually holding and who is getting the partnership from. You're right. So it could be a scenario where I hold more than 10% in the company, and if I'm directly having the firm, where the company is contributing as an asset or as capital into the firm, there could be deemed dividend trigger also in that case. So I would rather than say I'll maybe induct another family member as a partner who will hold the firm on my behalf. Someone who is not, directly associated with the company or not a director in the company. So I'd rather make some other family member, extended family member to initially start the firm and maybe gift it onwards to me later on when, there's a partition that takes place. So what's, again, important here is to understand a few specific points, right? One is, one is the deemed dividend aspect if you were to do this. The other aspect is, if you were to do it through India Partnership Firm or if it was a company in any case. It's important to, again, going back to the same point, to check if 50C applies. While it's simple, we can say it is not applicable, but it's good to do a critical assessment of this provision being applicable. The other is 56(2)(10), of course. We need to also test the applicability of 56(2)(10). The last point is, when the contribution happens, it can't be for a very nominal consideration that the company or the firm is holding. So, it could be looked at as a sham transaction, even if they don't dispute on the lines of 50C or on the lines of 50C or on the lines of 56(2)(10), tax guys can always come back and say, fine, you win, 56(2)(10) doesn't apply, 50C doesn't apply, but It's a sham transaction, I'll invoke GAR because you did this for a tax benefit. So this could be a repercussion. There could be other repercussions when we implement these structures. So the more aggressive the structure is, I think the better diligence that needs to go into it to implement these. It's always better to have multiple levels of check, get a senior counsel opinion, understand the real risk of implementing these transactions. Again, from a stamp duty standpoint, from a legal ownership standpoint, get a diligence done from lawyers to understand how does the title of the property get transferred, is it fully kosher, can I hold the property in my personal capacity eventually, and is the title free of any risk? Because if the title has other issues in terms of its transfer and how it's trickled down to the ultimate holder, then you won't be able to monetize the asset further and give it to others at a higher value. So there'll always be a bargain, and there'll be a discussion on value reduction because your title is not clean, or it's not come down to you in a proper way, which can be challenged in court subsequently. So I think it's important from a legal standpoint and from a tax standpoint, we cover these points, understand the impact, and then probably implement these structures. Any questions?
All this arrangement is done. So now we come to that point where India PF has to retire from both the firms. I just want you to explain in monetary terms, like now suppose they have contributed 50 crores, 50 crores to the plant.
Sure.
Now after retirement, like how?
So what happens in a firm typically when you contribute, let's forget India PF. If anyone contributes any asset into the firm, the capital can get recognized in two ways. Okay, the entire capital can be broken down as a fixed capital and as current capital. Right, your current capital essentially is a representative of your P&L balances and all your additional contributions that you make in the partnership firm. So assuming the contribution happened at a nominal value, which is the let's say cost base or index cost base. Now the retirement of the partner from the firm in case of more property was not recommended because you end up paying stamp duty. Which we did discuss. If it was Karnataka, you'll end up paying stamp duty on retirement of a partner if the land is left behind. So then what you need to do is either look to convert this partnership firm into an LLP or a company. So when you convert this to an LLP or a company, it's a statutory vesting of assets from firm to an LLP or firm to a company. This is how it will work. So if you were to look as a statutory vesting, then there is no stamp duty. You will only have to apply for a name change. So you'll have to, approach the sub-registrar, you approach the SRO. SRO will do the name change basis your application. There is no conveyance of an asset from firm to LLP or firm to company. So so far we are on the same page on the conversion bit. Now when the conversion happens, if it was conversion to a company, we'll have to of course look at 47 exemption. See if you are not triggering any clauses which make it a taxable conversion. Now we can look at TechSpin and other case laws which very categorically say that conversion of firm to a company is actually not a taxable transaction itself to start with. It's not a transfer, it's a registration of a firm to a company, and therefore even if I did have an exemption under the Act, there shouldn't be any tax payable on conversion itself. So there's enough merit to say that I can convert firm into any other form of legal entity. So once we do that, we have taken care of two aspects. One is stamp duty on retirement will not trigger. The other aspect is if I'm converting it to a company, I will either retire the shareholder by acquisition of those shares, or what I can do is if it's an LLP format, I will retire them by paying the consideration that's outstanding against their contribution. So if they've contributed anything into the firm, let's say they have about 50 crores, which is appearing against the current account and the capital account balance. Will pay off the capital account balance or their capital balance, which is between fixed and current. And upon their retirement, when they get their cash liquidity or their cash exit, you don't end up paying taxes as a firm because you've not distributed anything over and above the capital balances. So this is the walkthrough of a contribution happens. Upon contribution, subsequently you convert to a firm or a company depending on how we want to hold it eventually. Now, if you are converting to a company or into, let's say LLP, I would rather first want to make the other partners majority partners, make the contributing partner a very nominal or a minority partner so that the 5-year lock-in condition is not tripped because the 5-year lock-in condition under 47 for tax exemption. So, sorry, I'm going in a little more detail, but there are a few conditions you need to satisfy on conversion also. So you need to plan this accordingly. Have majority share in the firm, convert to LLP or company. If you're doing LLP, you then retire the contributing partner from the LLP. Then you can, as a step 2, again convert that to a company, depending on how you want to hold this asset. So, any questions? So, I think we have limited time, so I'll quickly, enhancing cost base. So, this is this is something that my client reached out recently, and they asked, they also acquired an more popular huge land bank that they had acquired through a company route. Because naturally most of these aggregators who aggregate more property or land will not do it in their personal capacity. They would rather aggregate in a legal entity because it's easier to transact that way. So one of our clients acquired a huge land parcel through a company, and the objective was to do a commercial development there. There was no problem if they did a... Sorry. So, let's check mark here. So, has this screen always been this way?
No, just now.
Yeah, okay, okay. Thank God. Right, sir? Yeah, so they acquired a huge land parcel, and they paid a substantial amount to acquire that land parcel through a company. And it was supposed to be a commercial project, a really big landmark project, but for some reason everyone wants to buy a house. I don't know what's happening, but everyone just wants to own a house, and people are going crazy about it. And sorry to use that term, but so what my client thought was it's better to actually do a residential project vis-a-vis a commercial project, because rental yield is good. In commercial, we probably can monetize it further to a REIT or to a PE investor with 6-7% cap rate. The NOIs are great, but Resi made more sense. Residential project made more sense for them because that was a lot more juicier in terms of return. So if someone were to do a residential project on this land, there's no cost base available. It's a land parcel where it's acquired at only guideline value by someone else, and most of the consideration, I don't know how they discharged from the original landowners, but they haven't held at guideline value today. So the substantial amount being paid on the shares. So they said, if you do a Resi project, then we're bound to pay tax, and there's no cost base available. How do we ensure that we benefit from the cost base? Can I do a revaluation or fair valuation of the land? Will I get benefit of reduction of the fair value? Unfortunately, no, because revaluation or fair valuation could be only limited to your accounting. You may probably only do the fair value for your accounting purpose. Your land can represent the true value. But it will never give you a tax deduction when you sell the land or when you construct a residential house and start monetizing it. So therefore, the solution that was very simple, and what we offered was, it was held through a corporate entity. The shareholder again was a company, and what we thought, why not do a liquidation? Let's liquidate the asset. Let's liquidate the company itself. So what happens in a scheme of liquidation is, or rather, let's see where is the capital gain benefit in this case, right? If there was supposed to be a Resi project, if someone had to benefit from the cost base, they either had to acquire the land itself, which would have made it a non-starter for the seller. So they bypassed that, acquired through a company. Now if they were to monetize this post-development, the reason why we are looking at the structure, this is what ends up happening in today's scenario. So when you do a liquidation, the asset directly goes to the shareholder who holds the company or who holds the asset. In a scheme of liquidation, the way taxes work is, the fair market value of asset received becomes the full value of consideration for the recipient of the asset, and the cost base that is available to the shareholder is the value that he has invested, which means whatever cost base that he has on the shares can be swapped against the land parcel. So the land value will then represent whatever was invested in the company. So that's how the scheme of capital, that's how the scheme of liquidation works. Sorry, any doubts here? Should we go over the liquidation tax mechanism again?
This is one-person company, eh? I mean, single shareholder.
Single share.
One-person company.
No. When I say single shareholder, it's that shareholder and the representative. It's a private company, a limited liability
Private
company.
company.
Two shareholders, one is always a nominee shareholder holding, yeah. So, in liquidation, section 46 becomes applicable, which very clearly says any asset distributed by the company in the process of liquidation shall not be treated as a transfer by the company to its shareholder, which means there is no tax trigger to the company, right? However, on receipt of the asset by the shareholder in the process of liquidation, you, as a shareholder, will first test the accumulated profits in the company. To the extent of accumulated profits in the company, there is deemed dividend trigger, and anything that's received over and above becomes capital gain. Now, the way capital gain will work is you will take the fair value of asset received. Now, fair value in this case is not defined for that particular section, but is defined under section 2, and that doesn't speak of 11 UA in specific. So you can take any fair value. You don't have to restrict yourself to the stamp duty value or the guideline value under 50C. You can of course record this as a full value of consideration at the full value which you have paid on share purchase. So you have a higher full value of consideration. That full value of consideration minus the cost base, which is also about an equivalent amount, and then you have no gain, no loss situation. And in this case, what happens is whatever the value you've considered as full value of consideration, on the computation, the 46, that becomes the cost base of the asset that you receive under 46. Now in this case, again, we can look at, it has to be through an NCLT process. You'll have to go under an IBC process, voluntary liquidation. This may take about 6 months as a timeline. You'll have to file for a IBC voluntary liquidation. A fairly simpler process, because here the company which is going under liquidation will be the company appointing the liquidator. Once the liquidator is appointed, liquidator decides who to distribute the assets. Once the report is drawn, the report is filed with NCLT. NCLT approves the process, and that's where the entire liquidation process gets completed. Now, on receipt of asset, Karnataka at least doesn't talk about it being conveyance, but one can look at it as a conveyance of property, but it's happening through a statutory process where NCLT or a court order is received. So even on stamp duty terms, we can take maybe a legal opinion on this, and also maybe take a view that only registration should apply, 1% registration in this case, and not really a 6.6% stamp duty applicable on conveyance of remote property. So by this, what happens? There is receipt of asset. There is higher cost base that someone will enjoy on the asset. Now, when you go for residential development, naturally it's a business income for someone who's doing the project. So you have a cost-based benefit on sale of this asset. If it was a company, you would monetize the asset, get the cash flow stuck in the company. You will have to then figure out how to take the money out. That's step number 1. Step 2 is there's no use of the cost base itself unless you do a buyback or a cap reduction, which again is, it's post facto. The company has already suffered taxes, and post facto it's a distribution mechanism. So there's one way where you can,
So why did the company get the land in the first place in the company's?
It's a commercial asset. So the intent was to do a commercial project before. So a lot of times when huge land banks get aggregated, it happens in a company or in a partnership firm or in an LLP. Individuals don't hold assets of 20-30 acres. Very few guys do it, but most of the times you'll see it being held through a formal entity. So that way it becomes easier to transact. You're not paying multiple conveyance stamp duty each time that you're selling and buying the asset. You're simply buying shares of the company, you're transacting on the shares of the company. And a lot of times it's also better for you to kind of raise liquidity or get loan against a particular asset which is there in the company. So your personal, if you were holding asset in your personal capacity, to mortgage the asset, take loan, or to take loan in the company is easier, the other way around. So there are multiple factors, and also raise construction finance, for example. You would always prefer to be in a company, you raise construction finance to do the development, as opposed to keeping the entire asset in your own name. development and from an exit standpoint, it always makes commercial sense to keep it in a company format or LLP or any other corporate structure.
So, sir, just to rephrase, sir, I had a 10 acres of land. Okay, just I want to develop and I want to construct a plant. So for that, the cost of land it is not required. So that's why I created a company and then I purchased the shares of entire that company or a nominal of my friend, and that company will buy a land from me. Is it so?
No. So are you talking about this example?
This example.
No, in this example, it was someone just acquired land, which was held in a company.
So,
okay?
Which was
held in a company. Yeah. So the entire land was held in the company, and that's how most of these large developers will end up acquiring land parcels. Now, when they acquire, the intent was to do a commercial project. So when you do a commercial project, let's say you do an office space, you do an office park. An office park, you will develop over 20-25 acres land parcel. You do a fabulous office park, and then when you monetize, when you exit to, let's say, REIT, when you sell your shares to, you don't sell the assets from the company. You sell shares of the company. So when you sell shares of the company, that's your eventual exit, right? So you acquire 20 acres land. You've done a beautiful office park. When you're selling the office park, you don't sell the office park as an asset from the company. You sell shares of the company. When you sell shares, it's better for you to have cost base on the shares of the company vis-a-vis cost base on the underlying asset. So that's the intent why someone will buy in a company format and not in any other format. Now, the plan changed to doing a residential project because that micro market has a huge demand for resi. So then they were thinking, okay, we have already paid enough money to acquire shares. But when I do the plot, I'm ending up paying full taxes because there's no benefit of cost-based land. So that's when we thought, let's apply for liquidation. We'll liquidate the company, get the asset, get our cost apart.
This liquidation process, how long does it take?
I would say it takes about 8 months, 7 to 8 months. Yeah. Because if this company has no creditors, or let's say they have creditors who have consented, you're going for a voluntary liquidation. I see no reason why this will be held back by NCLT or it wouldn't pass the test. It's fairly quick if it's a cleaner entity. Sorry, someone had a question.
The liquidation process, the liquidator realizes the asset.
No, it can be a distribution of asset or it can be realization of asset and distribution of proceeds of that asset.
Is it the prerogative of the liquidator or
Yes.
is it the prerogative of
See, in a voluntary liquidation, you are appointed the liquidator. So, by your terms. Yeah. So, yeah, you're right. So, most of the times, when you go for a general liquidation, or the way it's understood is, liquidator who NCLT appoints will liquidate all the assets, pay off all the creditors. If something is left behind, you will be given the residual amount. But in an entity which only holds a land parcel or any other asset, liquidator can actually distribute the assets itself upon liquidation to you. So you can take the assets upon liquidation, and also 46 provides for that specific scenario also. If you're receiving an asset on liquidation, you will take the full value or rather fair value of the asset as a consideration. So that's a envisaged scenario and that's prevalent. This happens when you go for voluntary liquidation. If you have like too many creditors and if it's a proper IBC event, then I don't think it's possible for you to do. So let's take a last case study and maybe we can wind up on that. Investing again, so someone was looking to do a inbound investment, they were getting money or rather getting FDI from a non-resident. So I hope you guys all are familiar with how FDI works. So any investment that's done in an equity instrument falls under FDI. An equity investment an equity instrument could be equity shares. It's also defined to include compulsory convertible preference shares, compulsory convertible debentures. So while debentures are debt in nature, but if it is CCD, compulsory convertible into equity, it takes the color of an equity instrument for FDI policy. So under FEMA regulations, you can get investments under, through CCDs and still qualify for to fall under the equity investment term. If it's an optionally convertible instrument or any optionally, or non-convertible instrument, it becomes ECB, which is external commercial borrowing. Now ECB has its own regulation where the ECB regulation governs who are the parties who are eligible to make the investment. You have minimum maturity period or lock-in period of holding that particular debt. And you also have a restriction on how much distribution can happen against that asset in terms of interest, which is an all-inclusive cost which is defined in the regulation. So most of the investments which come through and under an equity format are either CCPS or CCDs. Pure play equity is very rare. Now when investments are made, inbound investments are made, of course one is you do a jurisdictional analysis of where the investment should come from, what geography is most suitable, and also you look at what format can investments be made or how would you raise funds. In this case was, I mean I wouldn't say it's a tax planning structure, but also it had some tax angle to it, but the investor already had substance. He had enough business. It was a full-fledged fund which was doing a investment activity. So what we thought, we thought investment from Singapore is better. Let's make investments from Singapore, and also let's do this equity investment by way of CCDs. It might be counterintuitive. Yes, I'll be interchangeably using equity and CCD because both are same for FDI. So we thought we'll do, CCD investment in the Indian company. Now, any investment that's made in an Indian company, and you make gain on transfer of those assets or those investments, there is going to be a gain, and that gain is taxable in India. There is going to be a gain always. Now, if you do an equity investment, like pure equity shares in India, it can be looked at as asset held in India under section 9. 9.1 talks about it being any shares in an Indian company or interest in an Indian company will be a capital asset held in India. So on transfer of those capital assets or shares, you'll end up paying taxes in India. Now that therefore people went under Mauritius Treaty, Singapore Treaty to avail capital gain tax exemption and benefits, where sale of shares historically were taxable in the country in which the alienator is a resident, which means the investor, if he's coming from Mauritius or from, let's say, Singapore, ended up not paying taxes because those jurisdictions in the treaty provided for the taxes to be paid in Mauritius or in Singapore, sorry, and those particular jurisdictions did not tax capital gain as such. Today the situation is different. India-Mauritius Treaty is amended to a really large extent, where you need to look at substance tests, so I'll keep that discussion aside. Again, Singapore also has similar provisions. You will have to look at the LOB clauses, limitation of benefits, and so on and so forth. But the benefit is, if you invest through CCD, it doesn't qualify as shares under India-Singapore Treaty. So what we thought, if we were to get investment as CCD in India, and when we sell those CCDs as an investor from Singapore, we can fall under India-Singapore Treaty and also not fall under the taxation bracket which requires to pay tax in India on sale of shares held in an Indian company, because CCDs are debt by nature for the purpose of, let's say, income tax. And therefore you will fall in the residual category under India-Singapore Treaty, which requires taxes to be paid in the country in which the alienator is a resident. So therefore, Singapore had no taxes hitherto, but today there is a new section 10L that's introduced in Singapore, which requires taxes to be paid on sale of foreign assets. But the best part is you only pay tax when you get consideration in Singapore. So if you have a bank account outside of Singapore, you can receive consideration there and technically still not end up paying taxes in Singapore on sale of CCDs. So that's one interesting structure. Maybe you guys.
Double taxation DTA.
Yeah.
Even though it is received outside Singapore, it's
no, this is not a treaty benefit. Treaty only is saying that you need to pay tax when you sell CCDs because it's held in India. Now, where will you pay tax? Whether if you go on a treaty, you would have still paid tax in India if it was sale of shares.
Yes.
Because sale of shares, it says that you pay tax in India itself. If it's sale of any other asset, then it says in the country where the alienator is resident. So you will take a treaty benefit, assuming you check, you satisfy all the conditions to take the treaty benefit. And you will test whether it's taxable in Singapore or not. In Singapore, assuming it becomes taxable, right? Because you're not a investment vehicle, or let's say you don't qualify for the exemption in Singapore, then you would have paid tax in Singapore anyway at the applicable rate under section 10L of Singapore Act. Now, what they've told us, you will pay tax if the consideration is received, and it's defined to being received in Singapore. If you don't receive it in Singapore, you receive it in some other jurisdiction where I can have a bank account in any other country, right? So if Singapore is a corporate entity, can open a bank account in Dubai and receive money in Dubai, there's no tax payable in Singapore because it's not received in Singapore.
So what I was telling, no, since the money is received outside Singapore, whether the DTA plays
It is vis-a-vis the holder of instrument and the country in which it is held. You will not see where the bank account is located for treaty benefit to be available. So you will still have the India-Singapore treaty, not India-Dubai.
CCD, is there any limit on the number of years that it is?
10 years.
10 years is the maximum.
Under Companies Act.
You have to pay regular interest. It is
Sorry? No, you'll have to convert it into equity.
Eventually, some interest has to be paid to the entity.
You can pay, you can choose what percentage you want to pay. If that's the question. You can pay 0.001%, you can pay 10%, you can pay any percentage. So that's totally fine. As long as you're not tripping on the TP provisions, and if it qualifies as an AE and you pay exorbitant interest to that AE, then you have a problem. Unless you don't trip on that, you can choose what interest you want to pay. It could be very nominal, it could be high. Correct. It's a commercial, because if I'm doing an equity investment and I'm only structuring it as a CCD, as an investor I'm not expecting to get liquidity or cash out from the company in the form of interest, because I'm holding it to make gain, I'm holding it to make a capital gain on eventual transfer, not to make interest return out of it. So by default or commercially, they would not want to charge interest on this.
Then you have the time frame you have within which you have to.
Correct, that's right. So this is the end of at least my session. Any questions so far? Sorry? Share warrants? Yeah. So share warrants also you can. Depends on whether it's partly paid, fully paid share warrants that you have. I think there is a 25% minimum paid up. You need to have a minimum 25% paid and 18 months to make it fully paid. So you can do share warrants as well. That's one of the ways you can restructure it, because it forms part of equity and FDI policy. But the point is, when the exit event occurs, right, no one will buy share warrants. So it has to be in form of some instrument. You need to either hold it as CCD, CCPS or equity. So that's where it's not very prevalent, where it doesn't perennially be held as warrant. You will have to convert it. So that brings me to the end of the session. We can do a tea break quickly and come back for a nice case law session thereafter. Surya's here. Thank you guys.
So, good evening all. I know it's Saturday evening and I can understand the vacant chairs, because when I came in the lunch afternoon, I think most of the class was full. But now, essentially I can understand, I think it's the end of the module for you, right? The capital gains the last session. And that too with Saturday evening coupled with exit polls and all. Now, I'm at least glad that the strength is so much. So, I'll not waste much of your time. Let's just quickly dwell into. I know you've been through capital gains sessions for almost a week now. I think week or 3 days. It started from Thursday, I could say, if I'm not wrong. Friday. So it's been a couple of sessions that you must be much more well versed in the capital gain laws for now. So I'll just touch upon few basic things. Those again particular sections which are only relevant for the case laws which I'm discussing now. There are multiple sections in the capital gains area of much more dwelt in detail. So just starting, again the charging section is section 45. I'm not going into the details of 45, just in a layman terms if you want to put it plain and simple. The 45 says any profits or gains arising from transfer of capital asset is a capital gain. Now if you see the section 45 subsection 1, there are a couple of words which you find there. One, there is a profit or a gain. Second, there should be a transfer. Third, it should be of a capital asset. Now only when you trigger all these three conditions is when it is chargeable to capital. That's a starting premise which is there under 45 subsection. Now if you continue to go on, as you see, there is one capital asset which I have told, then there is a transfer, and then there is any profit or gain that is coming. So the next obvious question is, what is a capital asset? This again you would have dealt, multiple speakers would have dealt it in detail as to what is a capital asset. So again the definition plain vanilla is very simple. It says any kind of a property which you hold is a capital asset. subject to certain carve-outs. Now if you see the definition, the important thing for you here is, it is an inclusive definition. It says capital asset includes any kind of a property but excludes certain other things which are given as a carve-out. Now just again moving ahead, we have seen what is capital gain. It essentially says transfer of capital asset. We have seen capital asset, it's an inclusive definition which says a property of any kind. And then coming on to transfer. I know transfer is a plethora of a definition where it says this includes that includes this, transfer, sale, extinguishment, relinquishment, everything. Now just put it simple, given the definition, simple terms, again transfer means any kind of a sale or any kind of giving up of rights or any sort of things which you deal with a capital asset essentially gets covered as a transfer. Now with this background, I will not take, as I said, I will only touch upon those things which are relevant. As I told, the capital gain charging section is one which is relevant for most of the case laws, and it has only pretty simple three things. One is profit, one is capital asset, one is transfer. Let's just directly jump into, one more thing which is relevant is again for just for the tax rate purpose, whether it is a short term or a long term. Again, short term is a definition which is exhaustive, which is given in the Act, and long term asset is any asset which is other than a short term asset. It's again a plain simple definition. Let's just go into the first case now. So what I'll do is I'll not deep dive into the case or anything. I'll just put out the facts here. Let us discuss and agree as to what should be the position. Then let us go and see what courts have ruled based on the case. I think this approach works. Okay. Now let me set out the background for this. I'll not read it. I mean, it's there in the slide anyways. Let me just give you a background of how the deals happen or how the transactions happen. In the last session also you've seen that one wants to transfer shares to another person. How does a normal process work? Let's say an investor wants to acquire shares of a company. Preliminarily, there is an intent or a communication which is there from an investor to the company or the shareholder saying that I want to acquire your shares. This basic starting point of the discussion, they capture the terms, it's called a term sheet. Now, after the term sheet is formalized, there is a diligence process and everything that goes on. Finally, they reach to some conclusive stage called SPA. What the SPA says? The SPA says, I'll acquire the shares of your company subject to these terms. Before acquisition, you'll have to comply with some conditions. After acquisition, you're giving me certain indemnities or anything. All those are captured as a part of an exhaustive legal document which is called a share purchase agreement. Now the next step, what happens once the share purchase agreement is entered into, there is a timeline which is mentioned in the share purchase agreement. So there are two documents which you have seen. One is a term sheet, second is a share purchase agreement. The main difference between a term sheet and the share purchase, term sheet is an intent letter rather, and share purchase is more a definitive document. Both have timelines. And term sheet is more a non-binding. When I say non-binding, both of us are free to walk out at any time which we want to choose. If you are not interested in the deal or anything, we are free to move away. It's not binding on the other party. SPA can be binding, or some cases, rare cases, it can be non-binding in SPA also. Now the main thing which is there in the SPA, and then there is a share transfer that happens finally on the SPA. Now from the date of SPA to the date of share transfer, there is something called a closing date. They call the execution date and a closing date. So closing date is what actual share transfer takes place. Now this entire case study is about the first question which we have seen in the case of a capital gain charging. There has to be a capital asset, there has to be a transfer. Now when do we say that a share is transferred? Is it on the term sheet date? Is it on the SPA execution date? Is it on the SPA closing date? Or is it somewhere else? So what do you think could be the possibility? No, whatever I said has nothing connection with the PPT. You can ignore that. Whatever I have asked you is what based on what I have told you. SPA date. So the SPA execution date is what you are saying. Or the SPA closing date, because I said SPA has two dates.
It should be transfer date only. If it is, it should be between before the closing date only.
Okay, so what do you call as a transfer date? That's the question.
The day on which the shares are registered, transferred.
So you are saying the date on which the board takes the, the note of the share transfer?
No, in the SH4 is side.
So the date could be one date is the share transfer date. Any other date that you could think of? Okay. Now let me come back to what department is saying first. We said there are a couple of documents which you have seen. In this case, what department said is, the share transfer should ideally be on the signing of the share purchase agreement, which is the second document which I have mentioned. Now question is why?
Why it should ideally be the SH4 date as you are saying. But why is it the SPA date and why not the SH4 date? So the reasoning department gave us. In the share purchase agreement itself, you have finalized all the terms of acquisition including the acquisition price. There is nothing that changed from the share purchase agreement date to the share SH4 date. So materially all the terms are finalized on the SPA date. So the SPA date should be the date of transfer. Now simple question would be, how does it matter? 30 days. I mean SPA could be on one day, 30 days later could be the share purchase. That's the precise reason we see in the period of holding. Because what was happening in this case is, if you take the SPA date, it was becoming a short-term capital asset. If you take the SH4 date, it was becoming a long-term capital asset. So now you have got the crux of the issue. Now this is the reasoning which the department gave. Any counters that you have?
Execution didn't happen, transfer didn't happen, and transfer actually happens when the share instrument is in my name.
Funds have to be received.
Funds can be received later also, and for your question I can say I have materially entered and gave all the powers on the SPA date. Only the share certificate transfer is happening at a later date.
But I have still got, in the agreement, I can still terminate in case of certain non-compliance.
So that's what I said, term sheet is a non-binding, SPA could be a binding.
This also, okay, in this also if there is some conditions which are not fulfilled before closing, I can terminate that.
Precisely, that's the reason. So in SPA, generally whenever a SPA is drafted, so the way it is drafted is, there is a agreement that we will purchase the shares from particular shareholder or the founders, subject to certain conditions which we call as a CPs to the deal. These are conditions precedent. So what does a condition precedent mean? It says, before I acquire shares from you, you are supposed to do A, B, C, D sort of thing, which could include your passing of board resolutions, or if there are any tax defaults, I may ask you to clear those defaults. Or it could be if there is a 281 notice which is typically there, I may ask you to get a 281 certificate. So these are the things which I typically keep it as a CPs to the deal. These are very much important for me to have a proper title of the deal or get indemnified from the tax dues. So in this case what happened, the Supreme Court also was in line with your discussion. What it says is, when you say a particular asset is transferred, you should have a right to receive the money from that particular person. Now just because I signed an SPA and I have not lodged a shares transfer certificate or I have not lodged a SH4, I don't have a recoverability of collection or money from you. And the SPA very clearly says subject to the conditions precedent is what I am agreeing to sell it to you. If the conditions precedent are not fulfilled, I am at my free will and wish to back out from the deal. So now just coming back to the case, we have discussed most of the case, it's just that there are dates and few more names that are there. So the issue before the tribunal in this case is what is the date of the share transfer, which we have discussed. So the SEC was saying it was this thing. There is one more CBDT circular which says that in case of a listed share, it is the share. Now how do you evidence a share transfer? One is SH4 and I have said there could be just we both could have entered into a share purchase agreement, simply kept the share transfer pushed to a next year where I might actually get a long-term benefit. That could also be the intention. So what CBDT has come up in a circular is, in case of a listed share, it will be the date when I give my broker a notice to sell the shares or transfer the shares to a particular person. In case of an unlisted share, what it said is where the contract for sale has been entered into. Now that is where the problem has come, because it says it's a contract of sale as declared by the parties. Now the contract of sale could as well be the SPA also. Now if you see the rationale that the Supreme Court has given, if you see the point 2 that is there, it says, point 3, it says that the essential date between the transfer and transfer is when I actually have a right to receive the money or right to collect the money from the other party. Only then I will be able to exercise my right in full, and that's where I have said that I have transferred a particular capital asset, in this case shares. So having said this, let's move quickly to the next case law. I think this is clear. Any questions or anything in this? I'm not saying that, I have not said that receipt doesn't matter, because in certain other places in capital gains where you have received money in advance, you are also supposed to pay. What I am saying is, when is the transfer trigger happening? Now transfer trigger, how do you evidence the transfer trigger? Now anyone can say I have transferred asset on a particular date, but you could have actually said transfer is happening on another particular date. So in this case what was happening, we entered into a SPA to say that I will transfer the asset to you, but the share transfer happened at a later date. which is the SH4 signing date. Now let's take another case where we have entered into an SPA. There are no conditions, precedents, nothing. I've given in confirmation that we'll acquire shares from you, and you have been starting to exercise powers where you have become the director of the company and all. Now we both not executed the share transfer, that SH4 forms, we have not done it. But in essence, operationally, let's say you're controlling the full company, you're doing the business activities as usual. This case, then it could be a challenge, potential challenge, because if the SPA does not have anything to prove that why shares were not transferred, or any condition that was supposed to be complied with, then it can become a challenge. Otherwise, it's normally the SH4 date which will be the evidence. And this will more so trigger in the case where it is going to be short term vis-a-vis long term, so that kind of cases where this rate of tax is different. Now again, just coming back, the question you have asked, right, whether receipt of money, whether it will be a capital gain or it has to be some other event, whether it will be a capital gain. So the second question, if you see the again capital gain definition, what you have seen is transfer capital asset. Now transfer is done. I have a right to receive the money. For some reason, now let's say in this case, I will give you again, just taking the same case law, what is there. There is a company XYZ which has transferred the assets to another company. Now what happened as a part of the agreement, what we have agreed is, you pay me certain money, let's say 100 crore today, and you put some 50 crore in a escrow account. The escrow account was subject to certain conditions saying that I have to do certain conditions, and if each year you will release some part of the money to me from the escrow account. Now in this case, what the income tax has come and said is, you have done a transfer today. Everyone has agreed that transfer has happened today. You have got 100 crores. And SSC has paid capital gain tax on 100 crores. Assuming the sale consideration is 100 crores, whatever is the cost that is reduced. On the net gain, they have discharged the capital gain tax of 100 crores. What the assessing officer said is, the total agreement value for you is 150 crores and not 100 crores. 50 crores is parked in an escrow account which is upon your instructions, because both the parties have agreed and 50 crores is parked in the escrow account. This 50 crores was again going to come back to you anywhere in the later point of time. That was not dependent on you getting the asset transferred or anything. Now, the main reason for the dispute is whether the sale consideration should be 150 crores or the sale consideration should be 100 crores. So the precise question, again just going one step lower, is when do you say that the consideration has come to you? Whether once you have satisfied all the conditions of the agreement, do you say you have a right of the consideration? Or even if certain conditions are pending or conditions have to be complied with, whether we say that the consideration is coming to us. Because this could also be the case where I am saying this is, the agreement could also be like this, saying that 100 crores I will receive upfront, 50 crores I will receive after 2 years, which could be a part of the agreement saying that if 2 years the business works properly, if the 2 years the asset works properly, I will pay you 50 crores. The difference between the first and the second case is, first case there were certain conditions linked to the transfer of asset or me getting the 50 crores. Second case, it was just passage of time, which is nothing but a deferred consideration. Now in this case, what do you think? When should be the consideration? The first scenario and in the second scenario. Second scenario is not captured in this case, but in the first scenario, when do you think should be the point of taxation? For the 100 crores or 50 crores or 150 crores or different points in time?
Should be split over different points as and when the conditions are fulfilled and I have right to receive probably.
Okay. And
so you split the cost of acquisition, because there you will get zero as cost of acquisition. Practically we are facing this.
No. Okay. But when there is, but all the shares are transferred.
so this is a case of asset transfer.
Asset transfer. Okay.
Because share transfer, if you have already transferred the shares, there cannot be any other further performance related conditions.
No, sometimes even the shares are with the escrow.
Shares are in
Sometimes
Having this
they will take 1
Okay.
month.
that 3 years became 8 years, and now we have received 8 crores this year. Cost of acquisition zero.
Oh, this is a machinery.
So this is not even a machinery, it's a case of slump sale,
Slum sale.
where they have transferred a particular business division altogether.
No, but when you got the constitution now, was your agreement always specifying that you are entitled to X consideration always? Or was it split between upfront consideration followed by performance linked or a
Because
contingent
there were
consideration?
performance linked
Okay.
parameters.
So it's performance linked, then you will not get cost.
Yeah, the time when you get the funds, you will feel let's reduce my capital as much as possible. So you will set up entire cost of acquisition at that point in time and pay these tax. 3 years we'll see later this. Now obligation, now it is 8 years, now we got 8 crores, now it's like almost zero cost of acquisition. What to do?
No, well, if it's contingent, that's how it will work. Someone can also say that this is not even your capital gain. This is your income from other source. So you're at least not getting cost based, but you can still pay 20% tax and more.
Yeah, so, right, I mean, anyway, you answered half of the question. The balance half for the scenario one, let's go. So, what is the view that you think, whether it should be 100, 50, 150 or anything else? Or you will simply say, because in this case the SSC has also argued saying that there should be zero capital gain. So, why do you think there could be a scenario of zero capital gain?
Upfront amount received is equal to the cost received.
No.
Slum sale computation.
No, it's because of the same point which assessing officer took against this. So I'll tell you sequence how it has happened. So the SSC sold business, which is let's say of 100 crores. Same example continuing. 50 crore was a deferred consideration, which was payable over 5 years, subject to the SSC doing certain performance-related conditions. So what the SSC did is he has offered 100 crores today as capital gain, and 10 crores in the next 4 years is offered as capital gains with zero cost. Today he has set off whatever the cost is. Assessing officer came back to the SSC and said, your consideration is not 100 crore. Today you have entered into an agreement for 150 crore. You replace it entire 50 as the sale consideration. So your sale consideration will be 150. Whatever the cost that you reduce, net will be a taxable gain. This is what the assessing officer told. Once the SSC has replied, CIT has not agreed for the SSC reply. So when it went to the ITAT, what SSC said is, if we were to accept the assessing officer condition, 50 crore was supposed to be paid over 5 years, which is dependent on performance, and if it is performance and not satisfied, I will not get money. So if I were to include 50 crore today, technically I will not be able to determine what is my sale consideration. If I am not able to determine what is my sale consideration, there is a Supreme Court case law which says that if you are not able to determine what is the consideration or determine what is the cost of acquisition, computation mechanism itself will not work, and hence there is no capital gain on not either the initial 100 nor the next 50. So this is what is the SSC's argument. Now what do you incline to? I have put up all the possible arguments that are there. Okay, I will just take it up in the interest of time. So the position that is there, at least as per the case today, what we are seeing is whatever the consideration that you are receiving upfront, there is no doubt on it, you have to pay tax. Whatever is the deferred consideration that is there, if it is only a deferred consideration without any performance linked conditions, then the deferred consideration also you have to pay upfront tax. But if there are any performance linked conditions which are there, based on which the consideration is dependent on, then once you satisfy those performance related conditions is what you are going to pay the tax. So I will just move ahead. Now again coming back to the same 45 where we are again trying to test whether it is an asset transfer or something. So I will just give a brief background of this case. Let's say there are two companies. In this case one was a non-resident, other was a resident company. Non-resident company gave loan to a resident company, let's say of 100 crore. Now what happened is that resident company was not doing well at all, so the value depleted. The today's value of recoverability of that loan is only 70 crore. What the non-resident company did is it transferred or assigned the loan to another group company at 70 crores. And what they did, they came 30 crores as a short-term capital loss. Assessing officer said, loan is not a capital asset to begin with, and assignment is not a transfer, so this loss cannot be allowed. Now what do you think? Let's say a company has given loan to another company. Would it satisfy the definition of capital asset? Just for information, I'll just take it back. Though it's not an exhaustive definition, but it can be figured from this. Would loan satisfy the definition of a capital asset? If yes, why? If no, why? Okay.
Cannot be properties.
So you're saying loan is not a property. Let me tell another example. Let's say I have a receivable in the balance sheet. Is receivable a property? Trade receivable, normal trade receivable. So asset is generally a property is what we understand. But why receivable is a property, why not loan?
That becomes a bad debt for you, right of the receivable.
But this is not a case of write-off, this was a case of transfer. So what the SSE is saying is I've sold my loan to another party at a discount. So let's assume I have a share of 100 rupees cost. I've sold it at 70 rupees. What SSE is saying, this is exactly akin to the same transaction. I have a loan of 100 rupees, I've sold it at 70 rupees. I'm claiming a loss of 30 rupees.
Sold is right to recover.
So it's like, so if you know these factoring businesses or any other businesses, they purchase the loans or receivables. It's kind of a purchase of a loan. So the other group company technically purchased my loan, which is the loan which I gave to my subsidiary, at a discount to whatever the loan value I gave. And the discount was justified by valuation report in this case. So if yes, where is it falling under the capital asset?
It's not.
Just a property.
No, it's not a property.
So there is no just a property under the section. So that's what actually CIT appeals said, where he said it's not a capital asset but a property. So
Relinquishment of right to receive that.
that's transfer. So that's the second leg. We are in the first leg asking whether loan itself is a capital asset. See, if it is a current asset that is transferred, then it's a business income. So it's a business loss. If it's a capital asset, it is transferred, it's a capital loss.
It's not a capital asset. Loan
It is
is
a
not
capital
asset.
So I'm asking or you are asking me?
I'm telling loan is not a capital asset.
Okay. So you're saying it's a business asset. Is it?
Yes.
But where is it excluded in the capital asset definition?
Does it have to be here?
So if you, that's what we
It says capital
read in the
asset.
starting, it says defines capital asset to include any kind of a property. It's an inclusive definition. It's not an exhaustive definition to say only these are capital assets.
You don't have, it's not a property. No, loan is not a property of holding.
So the same question which I've asked earlier. So is receivable a property or receivable an asset? So is asset a property?
Specific to this.
Is, or rather put it very simple, is cash a property?
Yes.
Then why not receivable or not? Yes.
So except these four which you have excluded, anything is property.
So you're saying loan is also a property.
Yeah.
So it's a capital asset. And it can be transferred.
If that was fall under these four exclusions, then we had to exclude it. I mean, those are not properties.
Okay.
Anything other than those four, we have to.
Okay. So does this line make any difference whether connected to business or profession?
If that was not there, then business assets would have been excluded.
So if I transfer a receivable, will that be a capital asset?
Should be.
Okay. So any transaction which is done on assignment of receivables for factoring and all is all a capital loss. Because they technically do the factoring for a discount. So okay. There are arguments which are kept on both sides. Exactly these are all the arguments that have come up. Where CIT appeal said it's not a capital asset and SSE said it's a capital asset. So if you just, I'll just go back. So SSE said it's a capital asset because the definition of the word used is includes property of any kind. And it says whether connected or not with business or profession. It's not in business or profession, it's whether connected or not with business or profession. And excludes stock in trades, consumables, raw materials and those exclusions list which is given there. And there is a Supreme Court judgment which says from the Wealth Tax Act point of view, not under the Income Tax Act, which says that if it's an inclusive definition, it says property of any kind is included. So everything is included in that except for the exclusions that are provided for. So considering that, we say that loan is a capital asset. Now once that loan becomes a capital asset, if I assign a loan to another person, the second question that needs to be addressed is whether it is a transfer or not. Now again, transfer definition we have seen earlier, it's a very wide definition. It says sale, exchange, relinquishment and everything is covered there. So it inherently becomes a transfer. So the issue entirely was whether loan is a capital asset or not. How do you interpret the word property that is given here? Now, because it's an inclusive definition and it says the words preceding the property are any kind of property. It's not a restricted or a limited property. So that gives it a very liberal meaning where it says that any kind of property under that can be included as a capital asset unless you exclude them by way of an exclusions. So that's a Supreme Court rationale which said that in this particular case. So if you see the first paragraph, this is a ruling under the Wealth Tax Act, which was similarly imported to the Income Tax Act for the purpose of this case, where they have said that it's already a little definition that it's the widest import that is possible, and hence loan also gets covered within the definition of property. So again, just moving ahead. So this case law, what I'll just again tell you. So there is a loan, this case not a loan, it's a debenture that is given. So we've just translated from an agreement to a security. Now what is happening in this case is, to put it very simple, there's an individual who is holding debentures of a company. The terms of debentures are something like this. Debentures will be issued at face value. They will be redeemed at a premium. And that premium, there is no interest or anything that is paid. It's a zero coupon non-convertible debentures. So only thing you get at maturity is your premium component that you get. Now the simple question here is, if I redeem my debentures at the time of maturity, whatever the money that comes to me, is it a capital gain, or is it an interest income, or is it a business income?
Capital gains.
Okay, again, why? Because that's what SSC said. Department has the same question, but why? So.
Yeah, because I think I'm getting something as premium on redemption, appreciation in the value of it rather than interest, as my motive is not to get interest frequently at all.
So you are saying the premium that is paid on the debenture is a capital appreciation.
Yeah.
So let me ask you another question. If I book a FD today of 1 crore, I get 10 crore after 5 years. You say that balance 9 crore is capital appreciation and it's capital gain, or you say that it's an interest and you classify?
No, but in FD I can withdraw, right, even in between.
In this case also it happened. So what happened is the NCD was initially issued to one person, later on they are transferred to another person for an agreed consideration. So NCDs are in essence transferable as well. But because these are unlisted company NCD, you will not be able to frequently transact in them. But NCD is also a security which can be traded. So will this change your answer if it is an interest?
It's an instrument, separate instrument which can be transferred.
It's like interest.
Okay, but to this answer is to why it's not a capital asset. Can't it be a capital appreciation? Because I'll tell you where this is coming from. There's a new section.
And there is a debt instrument. You cannot have anything in the company, right? I mean, there is no interest in the company. So whatever company does in the business activity, your asset will not be appreciated. That's why it should be an interest.
Okay. So there is one
different way.
Agreed to your logic. I'll just give you one new section which has come very recently under the Income Tax Act, which says that there is something called a term as a market-linked debenture. Now what does this mean? A market-linked debenture is essentially with a nil interest or a nominal interest at the time of issue. Your exit, the premium payable on the exit, will essentially be linked to the performance of underlying security, which is essentially a market security as per the section that is there currently. It's anything linked to market index. So just to give an example, let's say there is a company, it can give NCD today. It says that your coupon rate is 0%, but the amount I will pay you after 5 years, let's say today BSE is 14,000 or 15,000, whatever it is, NSE or BSE. But if it goes to whatever it goes, the differential I will pay you as a premium. So it's my company's NCD which is there. I am taking the money, I am issuing the instrument. But the return on this instrument is linked to some underlying metrics, which can be market metrics, which can be company's metrics. Now there are two possibilities. There is a new section which has been introduced recently under the Income Tax Act, which says that if you are investing in these kind of NCDs, if you are redeeming those NCDs, the money you get at the time of redemption is a short-term capital gain. That's because of capital appreciation point which you have mentioned, where it says that I am not looking in the NCDs as a fixed return giving instrument or an instrument which provides me a fixed return, whereas in the FD case which I have just asked you, I am very much sure as to what is the return that I am going to get at the end of the tenure. But in this case of NCD, it can be up, down, or I may not receive anything as well. So it's a more like a speculative instrument sort of, where they try to tax it as a short-term capital gain or short-term capital loss. Now given this reasoning, do you think that the premium payable on redemption of NCD is an interest or a capital gain? Okay. Anyone thinks capital gain? Or any scenario which it can still be a capital gain?
But it should have been agreed while issuing the debentures.
Okay, in this case what they have agreed is, they have agreed, okay, let's put it specific to the facts. What they have agreed is, they have agreed at 12.5% IRR, which is payable at the end of the NCD term. This is what is agreed. Interest. So that's what the court also said. So it's a capital asset. And the reasoning why, there is one other judgment which is of importance here, which we need to understand. See, if the same redemption would have happened on the preference shares with exactly the same terms, I would have still claimed it as a capital gain, because if what I am giving up is an extinguishment of share. In this case, what I am giving up is also can be considered as an extinguishment of NCD. Any extinguishment of a capital asset is a transfer, and NCDs and preference shares are capital assets as per section 2 subsection 14. The only distinction between a share and a capital asset, because share is a very well settled position, there is a Supreme Court ruling where it says that if you are extinguishing shares, the money that you are going to get on extinguishment is going to be capital income in nature. The same SSC tried to argue with the case of an NCD, where he said, I am extinguishing an NCD. So the resultant income or the money which I am supposed to get should be a capital income and not an interest income. Because the event that is happening is extinguishment of the instrument. Because there is no more, that instrument is not going to be there. But the reason, the key line of difference between a debenture and the preference share is, if you see the definition of Companies Act as well, debenture is also a security, but it will evidence a debt until it is converted into preference share. So technically what happens at the time of redemption is, I am repaying a debt. It's not that I am extinguishing the shares or cancelling the shares sort of and paying money. What I am essentially doing is, simply I have taken a loan, I am repaying a loan. But if the CCD or NCD was converted into preference share, and then they would have done the same transaction, it would have been essentially a capital gain. So that's one line of difference, but essentially the judgment was the same way as you mentioned. It's an interest income because the IRR was agreed upfront. Now the second scenario which I was asking, in case of a market linked debenture, now the provision is anyway very clear, where it says it's a short term capital. The only other scenario which you can trigger a capital gain in case of an NCD is when you even have an IRR and it is not fixed upon or it a regular paying installment, where it is payable on maturity. You can still transact or sell the NCDs to some other person. So when you sell these NCDs and make money, that will still be a capital gain. Rest of all the cases, if it is on redemption, if you are getting a fixed IRR, it's an interest.
The kind of differentiation here usually is, when you transfer these debt instruments, it needs to, you will get two tests. One is there already interest agreed upfront? Is it obligatory on the borrower to pay that kind of return, or is it not obligatory? So if it's not obligatory in nature, where it's paid out of the company's own risk, it's a redemption fee. It tantamounts to be more of a capital gain sort of a scenario for the SAP, as opposed to agreeing to pay a particular return on an instrument, which takes a care of interest, because the definition of interest under the Act includes any premium paid there. So that's the only line of differentiation, whether it's agreed and obligatory on the company or not obligatory. But if it is not obligatory, if it's not obligatory on the company, you could actually take a view that it's a capital, because the company was never required or not an obligation. How does it? SP something outside. Yeah. I've given you a debenture and it's not obligatory for. Okay, I've agreed to pay 12% return on your debenture. That 12% will always get taxes interest. That's obligation. That's obligation. Now let's say I give you a redemption premium which is taking your IRR to 18%. That additional component delta which is there will be higher than its capital.
We are essentially trying to convert it from a basic instrument to a hybrid instrument to say that the company does not have an obligation to.
What was fixed is to be paid. That's right. So then it becomes a borrower-lender relationship between the two. And that's where you end up paying as an interest. So when there is more than what is agreed, it becomes capital. Now investors will never agree to not mention in the document how much they need to recover. So just to save taxes or to have a lower tax rate of 20% on a capital gain, They will not do away with mentioning in the contract saying you don't pay me 80. Just mention 12%, but you can give me 80 and all that. It's an oral agreement. It's then it becomes either oral or what, I think Surya can talk more about this, but generally what we do is we structure it by way of a call put option. Yeah. So we exercise a put option, and if it's a premature put option exercise, then we get a 80%. That's it. So then it doesn't become an obligatory instrument. If it's a 10-year paper, like let's say NCD has a 10-year tenure, and the commercial intent was to only keep it for 6 years. But I'll extend it to 10 years, and I'll give them a put option at the end of 6 years. So when they exercise the put option, let's say it's a premature redemption, you pay 18% return. Yeah.
That's what we can mindset. That's open rate, they don't accept. That's why MLD concept is very difficult to sell up.
Okay, so just moving ahead, next case again. So again, I'll just briefly put up the facts. So let's say there is a company which has taken land on lease. So this happens with all these SEZs and all, where they would have taken land on lease from any of the development authorities. Now what the SSE is considering is he's planning to transfer this lease or assign this lease again to a related company. Now the question there is whether assignment of lease right is a capital asset. And the second question there is, if it is a capital asset, will this be akin to a immovable property or lease is a separate right? Now when I say akin to a immovable property, which is when let's say I have a land, instead of selling to you, what I can simply do is I'll give it to you on lease for 999 years. So it's as good as you are having the property with full rights, enjoying the property, just that legal title is on me. So there will never be a scenario of capital gain here. It will not be a transfer of a capital. I'll say I have transferred the right. This is mainly because there is a section called 50C, which I think you would have been aware by now, where it seeks to replace the consideration with the guideline value. So in case if the guideline value is higher than the consideration that we are dealing with, so as per the 50C, what we will do is we will replace our consideration with the guideline value and we compute the taxes. Now in case of a scenario transacting between two related parties, we would not obviously want to do it at guideline value and we would want to transfer it at book value, so that we don't get a tax implication here and rather continue the business from that end. So in this case also what happened is, the SSE has got a lease right from the Maharashtra Development Authority and it has planned to transfer this lease right to another firm, wherein that firm would undertake the development of the property. Now the question here is whether, firstly, is lease right a capital asset? If yes, will it be subject to capital gain? The second question is, if we see the wordings of 50C, it says where any asset being transferred which is land or building or both, and it is less than the guideline value, then the guideline value will be considered as a full value of consideration. Now considering that the wording says that land, building or both, can I replace the right to say that it's land transfer but not a right transfer? Because it is for a substantial amount of time. So any preliminary thoughts? So at least on the first question, is lease a capital asset? Lease right a capital asset?
Yes.
And then because of the same interpretation or any other interpretation?
Is a right.
Okay. No, I'll just ask that. So the next question is, if lease right is a capital asset, if I transfer or assign the lease right to some other person, will it be considered as transfer of land, underlying land or underlying property, or will it be considered as transfer of right? Why not underlying land? So if I take a land on lease from, let's say, another party for 999 years, so is it not that I am getting a perpetual benefit of perpetual land? Just one more thing, there is another section called section 53 of Transfer of Property Act, which says that if upon a contract, if you are giving another party a performance or if you are giving the other party possession of a property, it will be construed as transfer under the Transfer of Property Act. So now in this case, the essential question is whether if the lease is for substantial period of time, whether if you are transferring the lease, can it be construed as transfer of underlying asset itself, or whether it is a separate right in itself, whether it can be transferred. The one more issue which is coming out of this section is because in the same income tax act there is one other place, section 269, where they have defined immovable property, and the definition of the immovable property there includes the rights in the immovable property also. So the assessing officer's contention in this case is section 269 includes the immovable property, And section 50C says that if you are transferring land or building or both, you have to replace the guideline value. In this case, essentially I am transferring lease rate, which is almost akin to, because it includes the underlying land value as well. The assessing officer said, I will replace the guideline value with your consideration and pay tax you on the guideline value. What the SSC tried telling is, 269 gives immovable property definition to include the rights and all those things. But 50C uses the words land or building or both. It doesn't say anywhere that rights in the immovable property are included. So you cannot bring the definition here to say that for 50C purposes you can include the rights as well. Now what do you think? Can that definition be used here as well to say that the lease rights are also included for 50C, or should it be done in a plain literal reading saying that only land or building or both are covered? Okay, but in the same income tax, one more place they are saying that it's immovable property and rights are also considered there. Any right on immovable, so the word is used there, any right in the immovable property is also considered as an immovable property.
That is for the limited purpose of cash collection.
Okay.
That cannot, because SDV value, applying the SDV value is only because of this.
Okay. So just for the first point where you said it's for a limited application, if you see section 54 where it says the rights in the immovable property is also considered for the purpose of section 54. So that's a capital gain section which you are looking at. Okay. Anyways, the essential thing is we cannot interpose the definition of 269 here, and the main reasoning that was given is that whenever the statute is drafted, it is assumed that it is drafted with the full intention which it is being sought of. So where they have included for the purpose of 54 and excluded for the purpose of 50C, the understanding is that legislatures wanted only land or building to be replaced with the guideline value and not any other place where the rights are being included. So that's the reason why we don't replace that value with here, and we essentially limit it to the land or building itself under 50C. So any other questions until here? So I'll just take a couple of case laws on JDA. So I know we had a JDA session I think yesterday evening itself. So I'll just keep it light on just 2-3 case laws which are important and which have been recently ruled also. So again, considering the JDA scenario, again the fundamental question comes as to what is the date of transfer. It could be similar to the share transaction which we have discussed, where I'll be entering JDA on a particular date. But actual units or the actual flats which are getting developed will be sold at a later date. Now which date should I consider as a date of transfer under the JDA?
After receiving the OC.
So that's, I mean, excluding 45(5), where, because if you are saying from 45, let's say it's a company which is doing JDA with another company.
Also, at receipt of OC only is actually completed. What yesterday we heard.
I know, I mean that's the ultimate answer as well, but more reasoning was why date of OC and why not the date of JDA, or is it even possible to say I've transferred a particular asset on date of JDA? So what is the difference that is there between date of JDA and OC? I mean of course money is there, but putting that separately, what is the difference that is happening contractually?
So actually my transfer is complete only when I get, when that OC is completed only then I am also receiving something.
Okay.
And then it is only agreement.
You don't enjoy the property ownership.
Okay.
Consideration is received only after, because you will transfer the land, after some time you will get the developed portion. That is what consideration is.
Till then I am only the owner of the land actually.
Okay.
I have not actually transferred that part. When that comes only that the actual transfer is happening. Till then he is developing only on my land. Those were the grounds.
Agreed. All these points make sense. I mean, these are the actual points which makes difference also. But how are they put in the JDA is what actually matters. So the JDA agreement says, if let's say plain vanilla JDA agreement which doesn't have any clauses and it simply says, I am entering into a development agreement with a developer. He is going to get certain share of land or certain share of constructed property. I am going to certain share of constructed property. This is a plain JDA structure. Now what actually matters in this is, what rights am I giving to the developer? Am I giving him full rights on the property, or am I limiting his rights only to construction work, or am I giving him certain additional rights? Now depending on these rights is what is the point of taxation. Let's say on the date of JDA itself, I give him full rights to come into the property, develop the property, including the mortgage of land, general power of attorney I give, saying that you can act on my behalf to do everything. Then it could be as well a case that I may have transferred the property today itself on the date of JDA, and date of OC actually doesn't matter for it. Because though the agreement says the consideration is coming on the OC date, technically I have given away everything. This was the example I was telling for the share purchase also, where I don't have any consideration or anything which is linked or performance or anything that is linked. It is essentially as good as the date of the agreement itself, where we are going to consider it as a transfer. So the moot point that lies there is, when are these powers getting transferred? And this is specifically included. I'm just going back to the definition of transfer. You see this particular line, any transaction involving or allowing the possession of the property, I think the last but one point there, that essentially came in to capture all these kind of transactions only, where they would have given away all the rights or all the land, the underlying development, everything, but still could have said that the consideration of the property is coming only at a later point of time and I will only pay. So this is the one where I said it is coming from the Transfer of the Property Act, wherein it says if the performance is reasonably measurable. Let's say developer, there is no doubt that, or there is no assumption that he will not be able to develop the property, and there is no doubt on my part saying that I will not be able to transfer the land or anything. Under the Transfer of Property Act, it says that if you are parting away or giving the performance, giving the underlying land for development or anything, it is as good as you transfer the property in itself. So that is where from 2 subsection 47 it is saying that if you satisfy the conditions that are given under the Transfer of Property Act, the date of signing the JDA itself will be the date of transfer. Now only case if you are not complying with this condition, saying that I still have doubt on the developer, I have not given him full rights for mortgage and all those things. It depends on how the JDA document is drafted largely. So practically how does it work is, to the extent of developer share whatever is there, we will give him power of attorney or power of things to say that he can mortgage his share. Landowner will have the right on his land parcel to say that he has the control right. And we specifically include a line for whatever reason it is to say that this is not a transfer and a transfer property. So that is one standard line that is there. Whether, see, that's only a safeguard, right? I mean, if you are putting that line or not putting that line, the essential condition that needs to be seen is how or to what extent are you giving away your powers on the land. If you are essentially giving up everything on the land today itself, it is as good as a transfer.
So if you are drafted loosely, you end up paying the tax on the rate of individual.
Correct. But if it is individuals or someone, then there is a specific section under the capital gain itself where it says it is the date of OC where you pay the this. But otherwise, if it is corporates or something, then it will be then it is obvious that it depends on the language of the job.
Practically, actually, what happens is you end up being most rights on the date of JDA. So most times, while in the contract, you say that the developer is entitled to go mortgage his share in the property. When you go to the bank, that doesn't matter. So you have to go keep the property documents and then I need to take home. So floating. If you are allowed to take, let's say, 100 crore on the entire property, you will rather restrict to take 60 crores. If it is 60/40. But you can't carve out and say that I'm not pledging the land, it's only the development rights I'm giving. But you are also required to go keep the documents of the land right documents with the banker. So if you're giving a right to mortgage, right to pledge the land, that's I think in my view a trade-off for good transfer. The second point is what Surya mentioned, you can have a standard line saying it's not a figure of CPA, but it doesn't give you immunity from not making it a taxable event on signing of JD. Because today practically most developers are raising money only on the land. They get the identified land, they go pledge the land, they raise money and they start the land. And you also be given a POA, power of attorney is very critical for them to go sell the land to the home buyers or to lease it later. And also to go get all the approvals. They won't let the landowner even enter his own land until they have completed the project. So if that's a scenario, in my view, I think transfer triggers on the date of signing JD. Unless, like Surya mentioned, is an individual or ensure where you get a deferment under the policy.
So this this also, I think the previous session was this on 54F only, I think you should be able to answer this now. So the simple case is that I am a co-owner in a residential house. Let's say my wife is also owning the same property, the 50-50. Now I purchased one more house. Will I get a 54F exemption on it? That's a simple question. So, but the judgment is actually interesting. So, any views? I think the answer should be straightforward is what I think.
In case if both are invested, yes, both are owning one house.
Okay.
But in case if the wife has been just introduced cosmetically, then no, she will not be the owner of the house.
Even if you make her a co-owner, you are saying that she will not be a owner.
And she is not invested anything.
Lovely will lovely, but is that ownership not jointly held because both will have the house? It's income from the house that lovely will have. But is the asset owned by you or?
So, what you are saying is, let's say I give the entire house to my wife, just as an example. You are saying still she will not be owner. Because she is not invested. I have just given a gift. So the thing I am trying to say is, as long as she is being stated as a co-owner and it's a registered document where it is saying that she is a 50% ownership in the property, legally at least that should be sufficient for her to at least sell the property or do anything. I mean, 50% obviously she can't sell, she will be tagged along with me only. But the essential underlying thing that we need to see is, as per the registration documents or the building deeds or everything, what is the ownership? If there is joint ownership that is prescribed or it is registered in a joint name under the stamp duty records, then it is generally considered to be a jointly owned property. Now the question in this case is, if I am a joint owner in a property and I am investing in another property, will I be able to get the 54F exemption? Because the point there is, if I am already owning a property, I can't take 54F for another property. The question therefore is whether part ownership or a joint ownership is considered as a full ownership.
Yeah, it is full ownership.
Okay. But why full ownership? Or
You
rather,
are owner, you can't really divide which part is yours in that, right? You are enjoying the house as a whole.
let me tweak the example. If a 0.1% owner and the other party is a 99.9% owner, and I invested in one more property to claim 54F where I am 100% owner, do you still think I should not be eligible for 54F?
Still be eligible.
I should be eligible, is it?
Sorry, can you repeat?
I am saying if I am a 0.1% owner, a 0.01% owner, and the other party is a 99.99% owner in the property, I am still a joint owner.
Yeah.
I am going and investing in another property. Now, should I get a 54F exemption or not?
And you already own one. You already own two.
I am only a joint owner in one property.
That's okay. You are owner.
Yeah. I am a joint owner.
But you are an owner. That's what I'm saying.
So you are saying you will get an exemption or not?
I think if you are an owner, you should not.
I will not get an exemption is what you are saying. Okay. But sadly the problem today is if you are in Karnataka you will not get, if you go to Chennai you will get. That's why I said the judgment is interesting, because what happened is there is a Karnataka High Court judgment which said that if you are a joint owner, it is considered as an ownership and you should not be eligible to get a 54F exemption in the other property because it's considered as you are the owner. This is a case of Mumbai judgment where Chennai High Court in another case has given a ruling saying that if you are a 50% owner, you are not a full owner. You are only a part owner, you can't be said to be having a full house. Only if you own a residential house, you will not be able to get another residential house exemption. So the Chennai High Court ruled that you should get an exemption. So the issue in this case is in Mumbai. So what ITAT of Mumbai has ruled is, so the law of precedence follows like this. So if there are two High Court judgments which are contradicting each other, if any lower court is generally delivering a judgment, if it is the same jurisdiction, they have to adopt the same High Court judgment. If it's a different jurisdiction which is there, if it's favorable to the SSC, that is to be adopted. So because this case happened in Mumbai, there is a favorable Madras High Court decision which is saying that you can get a 54F exemption. Though there is a Karnataka High Court judgment which is saying that you can't get, Mumbai ITAT has still gone ahead and given the exemption to the SSC saying that you can give it. So sadly, first time I think for the revenue they were able to get a Karnataka High Court judgment, but they are not able to get a Chennai High Court judgment. So the ITAT actually, if you see the order, it actually asks the revenue if they can produce a Tamil Nadu or a Madras High Court judgment which is against the SSC. So if both are against the SSC, then the ruling goes against the SSC. So it's not an issue of, so the issue still remains whether if it's a joint ownership you can get an exemption or not. But it is very much jurisdictionally dependent as to which place are you claiming the exemption.
Continuing in this example itself, the husband and wife both are the co-owners. But at the time of purchase, the husband has invested the entire amount. Wife has not invested a penny into it. And now wife is claiming exemption under 54H. So will that house be counted or because it is not appearing in her balance sheet also?
So there is a judgment on this particular ruling where if you make another person a co-owner in a property, they will be treated as co-owners. But whether you get an exemption or not is again dependent on the same thing as to, now it's jurisdictionally dependent, where in case of Karnataka, it's an adverse ruling currently that is there. But in Madras, it's the same example where there is a husband and wife who are doctors, where they have invested 50% each, and their wife has not invested, but she was using 50%. She is a co-owner in the property. And Madras High Court has given a judgment saying that you can get a 54F exemption. So it's a similar case.
Generally, in purchasing a house or something, his wife invests a little and husband invests more. It doesn't matter, both are equal owners.
Both are equal owners. So that's what I've said. Essentially depends on.
Specify who wants 25%, 25%.
It depends on how the stamp duty records are placed. I mean, whether you are entitling the other person as an equal owner or what share you are giving to the owner. Because intersect between husband and wife, it could be today 50, tomorrow 70. It is just a gift of the property that is happening. So essentially what matters is that how the stamp duty records or the land documents or building documents are placed.
Under the Transfer of Property Act, you are owner.
So Transfer of Property Act you are owner. So that I am not getting into that, I am limiting it to income tax. Okay. So one more question again on 54F. I think this is the last one. So I will not stress you more on 54F. So the question here is.
I have one question that 54F, suppose for third apartment.
So if you are co-owner in both, then you may try for third. But if you are not a co-owner, if it's only a one, then very much then section itself says you are not eligible.
No, if according to Chennai and court, if you are eligible for second, why not for third?
That's what I'm saying. If you are a co-owner in the second as well, you may still try for a 54F exemption for the third property. But now
you will always keep this exemption. So each time you acquire it with some other party or family member as a co-owner. Then that's Tamil Nadu. In Tamil Nadu. Yeah. Even Bombay also the same.
No, Bombay is still a ITAT judgment.
It's still an
ITAT judgment it is. But I think it's still, very much soon going to be settled as to whether we can be or not, because if obviously people here are not getting exemption, they'll appeal. So it's just a matter of time. So the last question on 54F is again taking a typical JDA scenario where I have given land in the JDA and I am getting constructed apartment. Let's say I am getting 10 apartments or 10 flats in a building as a constructed apartment. Can I claim 54F exemption? Is it counted as one apartment or is it multiple apartments? So you're saying 1 unit I can claim out of 10?
Yeah, 1 unit.
1 unit out of 10. Anyone who thinks I can claim 10, because I'll at least give you the reasoning. It's only a single purchase document, rather it's a single JDA agreement which I'm using. It's only a JDA. Out of JDA my consideration is so much. I've not gone ahead and individually acquired. So whether acquisition of 1 unit consequently or concurrently across all the units will be treated as 1 unit, because you can't practically differentiate which unit you have acquired first. Out of the 10 flats, can you tell which flat was acquired first or which flat has come next? That cannot be done. Now because that cannot be done, will your argument change to say that it's full together as one, or is it multiple units?
At the option of the assessment, we can keep it one house. Otherwise,
Other 9. So you're saying I can choose which one has.
Yeah.
So it doesn't anyway matter because I'm only getting one.
Yeah.
It will be pro rata value. Unless it's not a distance.
If they are adjacent or connected, probably you can have multiple units.
Okay. That's one High Court judgment actually. So there was a position saying that if it was a adjacent or connected properties which can be linked. So even if there are some 3-4 flats which you can connect, so the entire thing will be treated as one property. So this case I just put more from a recent amendment point of view in 54F, where I think you would have covered it, where it's the word has got amended. Earlier it was a residential property. It has now been changed to one residential property. So now all the earlier rulings which said that, so there were rulings where they actually said that in JDA if you are getting 10 you will claim exemption on 10. Because it was a residential and the singular always includes plural. So that was the reasoning where they were able to claim the exemption. But I think now after 1st April 2015 where any of the JDA things are being done, the max you can get is one exemption out of the 10 flats. This is more a change in law, so I just thought to just bring it up.
JD, what is the cost of acquisition to this property? What is the cost?
So it will be the underlying the land cost. So whatever the property that you are giving up, so there is a computation mechanism which is given for transfer, where it says the value of the land given up or value of constructed property whichever is acquired, whichever is higher is considered to be the sale consideration. And that sale consideration once you pay the tax will become the cost of acquisition for the properties. Correct. Those all have to. Those are subsequent conditions which have to be satisfied. Correct. So I think this is the last. Maybe if you have some 5 minutes extra. So again, this taking back this thing. So what happened in this case is, which I think we were discussing some time back also. There is a capital reduction which has happened in the case of Tata Sons, where the company has. Tata Sons Limited has invested into one of its subsidiaries. There are some X number of shares. What happened is they have formed a scheme of arrangement wherein what they have done is they have extinguished certain number of shares in full, say, and has offset it against the losses. What the holding company has done is it has shown it as a capital loss. Now again the question is whether it is a capital loss first of all to begin with, and if it is a capital loss, will it be allowed? Okay, I'll just go into the conclusion. I think Vivek anyway has clarified in the last listing, saying that if it's a pro rata, there is still some sort of an ambiguity whether you'll get a capital loss or not. But if it's a full extinguishment of shares, which is happening on account of capital reduction, and you are not getting any consideration, then it is an allowable capital loss which can be claimed and set off against the capital gains that are there. Okay, thank you. I think I've not exceeded the time that I was given. So, have a great weekend. Thanks a lot.
Please sit, sir.
Thank you, Vivek and Suri Prakash, for coming and then sharing your knowledge with the members. And I request our chairman to hand over the memento to both the speakers. I hope all of you had an insightful session here.
To have an exit poll together, so that's why we thought we'll conclude it.
But the number has dwindled out. I mean, most of them have gone left already, and it's raining also.
We requested the speakers to cut your breaks and you guys can be ready.
Thank you, members, and see you all again on next Thursday. Good day. Have a great weekend. Thank you.